What's happening, guys? I hope you had an awesome Christmas and you're enjoying a well-deserved break at this time of the year. Welcome to the podcast. You're listening to episode 53, and this week I interviewed an active Bitcoin trader who goes by the alias of BTCVix, but for the purpose of this interview, we'll refer to him as Vix. It rolls off the tongue much easier. So, as you can imagine, it's a little different. This is an area, or should I say, a market we haven't explored on the podcast in past interviews. But with that being said, I found this discussion to be really interesting, and I'm sure you will also. Some of the topics we spoke about include why VIX went from initially trading stocks and options over to Bitcoin markets, and we spent plenty of time discussing the landscape of Bitcoin. So going into how it's mined, how inflation is managed, the risks involved, and much more. Plus, another point VIX highlights towards the end is changing the way you may think about consistency and understanding non-linear outcomes within your own trading results. But that's just a quick sample of topics ahead, so let's jump right to it. I'm your host, Aaron Fifield. This is the Chat with Traders podcast, and please welcome my guest to take us inside the world of cryptocurrencies, BTC Vix. Hey Vix, how's it going, buddy?
Good. Busy day in the crypto space.
Nice, good to hear. Well, we probably should explain the name situation. So I get that you want to keep the alias, which is totally fine. So I should just mention that you go by BTC Vix on Twitter, but most refer to you as Vix. Is this correct?
Yes, that's correct.
Okay, awesome. Well, another thing I should probably point out is that I am very green when it comes to Bitcoin. So I don't know a great deal about the space, but I do find it super interesting. So throughout the discussion we're about to have here, we'll of course speak about your trading in detail, but I'm also keen to learn more about the landscape of Bitcoin. It's a side that I haven't really been exposed to, and I presume that's probably the case for many listening as well. Not all, because I know there are some listeners who tune in regularly who are Bitcoin traders, which is awesome. But I think it'll be a really interesting discussion. So thank you very much for coming on, and let's jump into it.
Alrighty.
So you weren't always a Bitcoin trader. So could you share with us how you very first got started trading? And let's go back one step further. What were you doing before this?
Before this, I came out of college after the financial crisis, kind of not knowing what I wanted to do. So I spent some time basically doing foreclosures and stuff. And I think that's what kind of initially got me interested in, hey, what's all going on behind this in the financial markets? So if you kind of progress from there, I think a lot of traders they're trying to discover themselves in trading. So, many of the guests that you've had on previously have kind of touched my life in some way. So starting with Tim Sykes and penny stock trading, and even through him, the bio run-up guys and biotech stocks that led me into the options space, and those guys over at S&B Capital. So it's taken quite a few turns to end up where I am today, but I think a lot of that, is just a maturation process as a trader, trying to find your specific niche that kind of suits your personality with the trading style that is successful. So if we then I just was kind of curious in Bitcoin philosophically, this uncontrolled nerd money that is able to be sent across the internet, doesn't know borders and stuff. So it got me interested initially just as kind of a curiosity from that standpoint. And for a long time, I never did trade Bitcoin. I was always kind of skeptical of the exchanges that Bitcoin trades on, that they would run off my money. And if some of the listeners might be familiar with, a lot of exchanges have run off with people's money. So it wasn't really until after you had the run up to 1200. It was November 2013. Then we ended up losing the largest exchange at the time, Mt. Gox. Mt. Gox stood for Magic the Gathering Online Exchange. And I mean, it's almost like a running joke that, this exchange, which ended up at one time being the largest exchange for Bitcoin, $1 billion company at one point, started off as a playing card exchange company. So by no means were they able to handle the kind of influx of users and the volume and the demand in that very short period of time. There's still a lot of controversy over what the fall of Gox was caused by, whether it was an inside job. Mark Capellas is a very kind of hated or infamous man in the Bitcoin space. So that's still to be determined as we sit here. But there's a lot of people currently out of money, out of Bitcoin. But it was that specific event that really got me trading Bitcoin, because I found an exchange called Bitfinex. And the interesting thing about Bitfinex is they actually allowed you to short Bitcoin. So some of my biggest profitable trades on Bitcoin in the early days was actually shorting it. And that's kind of what has sparked this whole finding of my niche into Bitcoin.
Okay, great. Yeah, that's a really interesting story. So let's unpack that a little further. I want to go back to when you very first started there. What type of success did you have with penny stocks, and what were you trading? Was it mostly the type of pump and dumps that most people trade when they go to penny stocks?
Yeah, I really tried to learn as much as I could from mostly Tim and his programs. I think one of the biggest things I ran into is trying to find borrows for those penny stocks to short. I was a losing trader at penny stocks. I think I blew up my account twice doing that. So clearly that wasn't my niche. And, then it just kind of snowballed, and I just was a lost lamb, basically, trying to find, what it was that I could actually trade successfully. Because I wasn't doing very good up to then, but I had such a passion for the market, I didn't want to give it up.
Okay, yeah, and I mean, I think many can relate to that right there. I understand you also dabbled in options before switching to Bitcoin, and you may have even touched on this before, but I think you also touched biotech stocks. Can you tell us what sort of success did you have with biotech stocks, and how were you approaching options as well?
The biotech trading phase that I went through, I think more than anything taught me what implied volatility means in an option and how that can really affect the price of it. And I think from there, even though I wasn't successful at trading biotechs either, I had some big wins, but I also had some massive losses because I was just basically a long premium options trader. I didn't understand spreads or anything like that, so it was very unsophisticated. And I think, there's that progression of when you first get introduced to options, you're buying basically lottery tickets. And that's a strategy that gets you in the poorhouse very quickly. So after, aimlessly wandering around through that, I came upon options spread trading. SMB and those guys at the Options Tribe did a great job of showing me successful strategies, and I still do trade some of those strategies today with my Thinkorswim account. It's still just more of a passive account because I focus mainly on Bitcoin.
Okay, so I mean, it sounds as though you really did try a whole range of trading styles and even markets. When did your results begin to change from sort of being an average trader or a lost lamb, like you called it earlier, to becoming profitable? When did that start to turn around for you?
Yeah, even beginning in Bitcoin, my P&L was was swinging around very wildly. And it took some time to get a grasp of the Bitcoin market, but I feel like it's a much more fluid market. It doesn't have opens and closes. It's a 24/7 market, so it just seemed to suit my personality more. And I was able then, after blowing out my account several times, learning the hard way that risk management is number one. So that's really what ended up being making me profitable, is just managing risk. And it sounds so easy, but as you know, it becomes a very slippery slope with that kind of gambling mentality a lot of traders get into.
Okay, so you've mentioned a couple times now that you've blown up multiple accounts, in the earlier years. If you had to summarize that for us, why were you blowing up these accounts? What mistakes were you making over and over again that was causing this?
Mostly it was just too large of positions for my account size. And then you couple that with, once you have a number of losing trades, you get into that revenge trading. And I think those two things were the most toxic to my trading profession in those early days. Is I would get on a losing streak, my position size would keep increasing, the losses would add up, and eventually my account would be gone, and I have to take a break. And I'd always come back saying, "Hey, you need to manage risk," and then there'd be one big loss that would put me on tilt again. So that's really been a big learning curve for me in both trading and just life in general, is to kind of understand when emotions are affecting my trading. Not to take emotion out of trading, because we aren't robots. That'll always be a part of it. But when you recognize that emotions affecting trading, you have to have some defense mechanism.
Yeah, I think that's a really great point you highlighted there, actually, is just having a great level of self-awareness can be a huge benefit in knowing where you're going wrong. So yeah, great point you highlighted. So tell us, what was your first encounter with Bitcoin? Like, how did you first get going in Bitcoin? Did you take, tell us about maybe your first trade, if you remember that.
So I did... early 2013, Bitcoin was at about $30, and I took some money I had laying around and just bought Bitcoin. I put Bitcoin in the corner and kind of didn't really think about it. Bitcoin then went from $30 to $266, crashed back down, wandered around 100 for 6 months, and then we had the bubble to 1200. So all during that period of time, I wasn't trading Bitcoin at all. But the real first trade that I had was when we started to see the real problems come out of Mount Gox, and I felt like I had a real opportunity there to short Bitcoin. The exchange had been having withdrawal problems for the better part of 6 months, and they had just at the time, it was like late January, early February, they had then stopped Bitcoin withdrawals as well. They had their fiat withdrawals suspended for 6 months. So the writing was on the wall that there was going to be volatility coming into the market, and it wasn't going to be net positive for Bitcoin. So that's really when I started looking at where can I short Bitcoin, and I came across this exchange called Bitfinex, and I placed my first trade. And I remember the next day, Mark Capellas came out and with a letter saying that the exchange problems were due to this bug of Bitcoin. And it wasn't a bug in Bitcoin. It was just basically he did a shitty job of implementing it into his exchange.
Right. Okay. That's really interesting. So, I mean, from the little bit I know about Bitcoin, I sense there are many Bitcoin enthusiasts doing this, like operating with Bitcoin, whether they're trading or just buying into it. They're doing this for political reasons. Was this the case for you in any way?
Yeah, I mean, I certainly came out of that kind of libertarian gold bug camp at one point in time. That the idea that gold is money, and I kind of look back at it now and realize how bad how bad gold is as money in the digital age. And I think that was really the missing piece of once I found Bitcoin. I was like, wow, like this is kind of what many libertarians and sound money advocates have been looking for. So that was really what captivated me in those early days of when I found Bitcoin, and I just dove into it. I wanted to know everything about Bitcoin.
Right, okay. So before I ask you about how you trade, I should probably ask, what is Bitcoin and what's so significant about Bitcoin? I think it's probably good that we bring this up because we have to think there's quite possibly people listening who might be hearing about Bitcoin for the first time right now. So just give us the 30-second summary, if possible, to explain what is Bitcoin. Sure.
I mean, the 2-second version is digital cash, but if we extend that out, we're really looking at there's a ledger that basically lives across many different computers, and it's just a software program. And, that's how basically value is transferred. It's just an entry on the ledger, and it's software that we've all agreed upon. So that's really kind of it in a nutshell. And that's how the value is passed, is this ledger is not controlled by any central party. It can't be shut down by going to the office of Bitcoin Inc. There is no Bitcoin company or Bitcoin CEO.
Sure, that's a great explanation, actually, and we'll go into this much more as we go. But for now, let me ask you, how do you trade? Like, what's the best way to describe your trading approach?
Sure. I would start out with basically when I look at the Bitcoin chart, kind of at a basic level, we hear people talk about horizontal support and resistance. And I would actually take that a little bit further and call it kind of like order block theory. And you're basically looking at, where clusters of orders are going to be, and the market makers or the larger players are going to push into those areas. So that's kind of what I look at as a roadmap with Bitcoin. Now, that when price is basically channeling, I'm looking at the Bollinger Bands, and I'm looking for breakout conditions. So that would be range expansion, and I'm going to try and go with the trend and have a take profit into those order block areas. And then on the other side of things is Bitcoin, when it trends, it tends to trend very hard. And then it'll have a period where it consolidates, a range contraction. So at that period, I'll go into more of a scalp mode, and that's kind of really my basic strategy of Bitcoin.
Okay, so the block areas, like, how do you identify these? Like, how do you see a block area on a chart? Is it where price is consolidating and it's hitting horizontal support and resistance, or is there something more to it?
It's kind of hard to describe it without a visual, but you're looking basically kind of like where a wick of a candle is, and then a body of the next candle or the prior candle, and you're going to be able to draw a rectangle, a horizontal rectangle across the chart. And it's really amazing how often Bitcoin will hit those targets. It's kind of similar to Forex. Forex does that a lot, being a 24/5 market. There's a lot of order block theory with Forex as well. And I think Bitcoin trades very similarly in that way.
Okay, so what's your average holding time? You said there that in certain situations you sort of go into a scalp mode. What's your average holding time when you're, scalping Bitcoin and when the conditions are more normalized?
My hold time is actually pretty low. I would say between 4 and 8 hours. However, the interesting thing about Bitcoin is you can take a long position or take a position that's in the direction of the trend and then basically scalp the counter trend or those periods of consolidation if you think the trend is going to continue. So I do that as well. But I'm actually a pretty short-term trader, mainly because I like to actually go to sleep. Bitcoin doesn't sleep, but I like to sleep. So I usually try and flatten out. And, 4 to 8 hours is pretty average.
Right. Yeah, that makes sense. So essentially, it's safe to say that a lot of the sort of the basic technical analysis theory that we're taught as traders is just as relevant to Bitcoin markets as it is to stocks and futures and Forex and across those markets.
Yeah, I think it's almost more applicable to Bitcoin. And I know you've had Sang Lucci and Haim on, and they talk a lot about how basically all of retail strategies have been put in an algorithm and are there to defeat retail traders and take their money. Now, Bitcoin still in its virgin state, and the markets don't have those kind of algorithmic and HFT players. I think the technical analysis of Bitcoin is a little bit more pure in the sense of those indicators that we learn at the early stages.
Right. Okay. Yeah, that's really interesting, Vix. If you had to break it down for us, what would you say are some of the important trader characteristics you have learned and adapted over the years that have helped your trading?
All right. Well, I think it may sound kind of funny, but I like the idea of having trader amnesia. So, waking up the next day and really having no idea what the last day brought, whether it was good or bad. Because I think either way, if you're bringing the prior day's trading emotions, whether it was a high or low, into your current state, there's potential there to basically be disrupting or influencing, and ultimately it's going to lead you astray of your plan.
Okay, I like that. So essentially that helps you to show up every day without having any bias about how you'll trade, over the next few hours.
Yeah, and I think, kind of on that same line of thought, it's I take kind of a contention with when somebody says they want to be consistently profitable in trading. And I guess I should clarify. It's kind of when I hear somebody say that they want to make, $300 a day and they can quit their day job. I think weekly goals are good, but if you get really caught up in that P&L paralysis, where you're trying to hit a certain dollar amount each day, you're gonna stop listening to the markets and your TA and all of those order block theories and stuff. That's really your trade plan, and you're gonna start staring at your P&L because you're at 280 for the day and you want 300 as your goal, but the market might not be giving you any more. So I think that's one thing that I wish consistently profitable is kind of not talked about as much.
Yeah, again, that's a really valid point. I mean, it's about not trying to sort of push your beliefs onto the market and just kind of trading what's in front of you, I guess. Now, we don't normally talk about sort of current market events, like what's going on in the market right now, normally on the podcast, but I do know that Bitcoin has been putting in some big moves recently. Not that I follow it too closely, but I am aware that it has been putting in some big moves. What's been driving this? Are there any underlying technical or fundamental factors behind it?
Sure. So I want to be very careful with kind of applying any narrative fallacy to Bitcoin because, um, personally, I find that a lot of times price action happens and then, people apply some story to it being the reason. So fundamentally, though, I think at kind of the global macro way, it is that we're seeing that China's devaluing its currency, the yuan, and China has very strict capital controls of the mainlanders getting their cash out of China. So with those kind of that perfect storm going on there, I think Bitcoin is being used as a vehicle to get capital of China. It's not the only way. It might not even be the best way, but it is a way. And I think we're seeing some bleed over from that. And then technically, coming back to the Bollinger Bands, we've had a weekly Bollinger Band breakout. We spent all of 2014 basically going down. We spent the last 10 months of 2015 going range bound sideways between $200 and $300. And just in the last month and a half, we've broken out of that 300 range and currently sit at 450 today.
Okay, so just while we're on the topic, are there any sort of, how do I say this? Are there any types of news events that come out around Bitcoin that have an impact on the price? Like if we bring that back to stocks, you've got, your company news, your earnings reports. Is there anything similar that affects the price or has an impact on the price in the Bitcoin markets?
Bitcoin is interesting in that sense. I know the first time that it was announced that the U.S. Marshals were going to auction off. At the time, it was the largest dark market, and they seized the Bitcoins from it, and they said, we're going to auction these coins off. The Bitcoin reacted very violently. I think it went down like $50 to $100 in that day. So, that seemed to affect it, but we've had 3 other Marshall auctions since then, which doesn't seem to have as much effect when they announce it because it's kind of priced in. We also have kind of when merchants, very large retailers accept Bitcoin, that's initially used to spike Bitcoin, but the one thing is the merchant is going to ultimately take their Bitcoins and convert it into fiat. So that's net selling pressure on the Bitcoin price. So it's kind of like a very murky way of looking at things if you're trying to play Bitcoin news. I've felt, at least my trading style, I try and tune most of that out.
Okay, and sorry, I forgot what you called it there at the beginning, the Marshall auctions. What's that about?
Yeah, I should probably, let's take one step back and just quickly talk about that. There was a drug and dark marketplace bazaar known as the Silk Road. You could buy, it was mainly for drugs, but illegal IDs and such. And one of the very early uses of Bitcoin was basically to use that as payment to buy, this merchandise off of this website that lives under Tor. That's a hole where all the dark markets live. And anyways, the U.S. authorities were after, the operators of this bazaar for quite some time. And eventually, there's a whole huge story that you can read that's almost beyond like what a prize-winning writer could come up with as far as the plot line and the twist goes. But they seized, I think it was 120,000 Bitcoin, which is pretty significant. So after seizing them, anytime a government agency seizes property, they end up selling it off and taking the proceeds from it.
Okay, and yeah, there's a really cool documentary about the whole Silk Road situation. Just on a side note there, I know it's totally off topic from trading, but Deep Web, very cool documentary. Have you seen that one?
I have not seen that one yet. Still on
Okay.
my to-watch list.
It's really cool. It's made by the guy, I'm forgetting his name, it's totally slipped my mind, who made the
Ted, right? Bill
No,
and Ted?
no. It's made by the guy who made the documentary about Napster as well, called Download.
Oh, okay.
Yeah, so check that documentary out. Really interesting. All right, so where were we? So Bitcoin is obviously the largest, most common cryptocurrency that does exist, but there are many others as well. Do you trade other cryptocurrencies as well?
I usually don't. I guess that kind of puts me in the Bitcoin purist camp, mainly because I tend to find that my niche is Bitcoin, so I rarely go into what we call the altcoins, and there's actually thousands of these. Probably the most famous being Litecoin, which is kind of Bitcoin's little brother. And Litecoin is actually traded on many of the major exchanges as well. But me personally, I tend to shy away from trading those coins. Some of them, you have a couple individuals that literally hold, 90% of those coins. So it's not something that I really see I have an edge in. So I just shy away from it.
Right. Okay. So why do these other cryptocurrencies exist? Like, what purpose do they serve?
Sure. So basically, the nice thing about Bitcoin being a completely open source project is anybody can fork the code, take the code, make some minor tweaks, and release their own coin of whatever it is. So some of it, just to compare Bitcoin to Litecoin, is one of the major differences is block time. So Bitcoin has it at 10 minutes, Litecoin has it at 2 minutes. It just basically means your transaction gets picked up by the miners faster and is on that ledger that we talked about at a faster pace. So that's one area that's kind of differentiates some of the altcoins. Just trying to think of some of the ones that have gotten popular. One of them is like more of an anonymous coin that mixes the transactions, so you can't really tell what's on the blockchain. It's everybody trying to kind of get the right tweak of Bitcoin that Bitcoin never had, basically.
Okay. And do these serve any purpose outside of, I don't know, holding a digital currency? Like, I know with Bitcoin, there are places around that accept it as a form of currency. You can actually purchase goods and services with it. What purpose do these smaller cryptocurrencies serve?
Well, I might offend some of the altcoiners that are listening, but I see it just mostly as a speculative vehicle in entirety. I've looked at some of the altcoins, and I still don't really see a bright future for those as far as mainstream use. That's not to say that there can't be one, but I don't have as much interest in those altcoins.
Okay. Yeah, fair enough. And a word you used in your last response there, which I wanted to ask you about, block time. What does the word block refer to? I mean, this is often associated with Bitcoin. What does it actually refer to when you say block?
So basically, you have, I think it's kind of, they came up with the term mining Bitcoin, which I think everybody in their mind comes up with the idea that you're going into this dark hole and you're trying to extract Bitcoin. And to kind of a simplified version, that is what's going on. But the miners are basically providing the hash power that's securing the network of Bitcoin. And they're taking all of these incoming transactions and they're bundling them up. And in order to incentivize these miners to give hash power to the Bitcoin network, because there's a ton of electricity cost there, hardware cost. Basically, if they solve this arbitrary math problem fast enough, they get what's known as the block reward, which is basically like money creation. So that is why the miners do what they do. And then once they get it all bundled and they solve this math problem, that's what's known as a block. And with Bitcoin, there's some really deep math with it, but basically the difficulty can adjust to that. We know roughly that it takes 10 minutes for each one of these hard math problems to be solved by these miners. And it adjusts. If the hashing power goes up, the math problem becomes harder to solve. So that's what's kind of keeping basically that inflation in check.
Okay, so so this gets complicated really quick.
It does.
How does who's creating? This is probably a really dumb question, but who is creating the math problem? Like, where does that come from?
So we all agreed to basically use the software. And the software has rules in it, right? And the rules, state these kind of math problems that are going on. And it was all basically in the code originally when it was created by Satoshi Nakamoto, this figure that we don't know who it is, which is a whole nother story. But it's just ultimately in the code that is what's determining those math problems. And it knows the hashing power and it adjusts accordingly for the difficulty.
Right. Okay. So it's forever evolving. Like, just because you crack it once to create one Bitcoin or one block, like it then changes again for the next Bitcoin or block that you want to create. Am I following that correctly?
Yeah, you're on the right line. And every time a block is solved, all the miners, basically it's a really hard problem to crack, but it's really easy to verify. So once the miner has solved it, it propagates this, global network, and the nodes that are running basically say this is properly solved. All the miners move on to the next block, which just means the transactions that are coming in, they're bundling them up and they're trying to solve the next hardest problem.
Okay. I think I'm following along. So how many Bitcoins, like can the guys who are mining Bitcoins, can they just keep going forever, or is there going to reach a limit where there can only be so many Bitcoins mined? Like, is there only ever going to be a certain amount in circulation, or will it forever increase?
So it's what do they call it? Like an asymptotic curve, where basically 21 million is the hard limit of Bitcoin, but I think it's every 4 years, the amount of block reward gets cut in half. So if you think about it, if we started at 50 was the original, 25, 12 and a half, 6.25, and so on. Eventually, it gets down to where the block reward is just ever smaller as we keep going on. But they can still collect the transaction fees off the network, which is part of the incentive. But the inflation, as far as kind of like the limited resource aspect of it, does have that 21 million hard-coded limit.
Okay, 21 million, right.
Ever watch a stock rip and think, I could have nailed that if I had real capital? The truth is, many capable traders never reach their potential, not due to lack of skill, but lack of scale. Trade the Pool was built to solve exactly that. A firm designed for serious individuals who want access to the U.S. equity markets with meaningful buying power, up to $200,000 without committing their own capital. Get access to virtually every stock and ETF. Go long or short freely with the flexibility professional traders expect. You're evaluated on one thing: your ability to manage risk and execute with consistency. Meet the standard, and you trade at scale. No subscriptions, no ongoing commitments. Whether you're still refining your strategy, a trader with experience who hasn't yet broken through, or a seasoned professional simply looking for more capital, Trade the Pool is built to meet you where you are and take you that next step further. The markets have evolved, access has evolved, now so has the way traders operate within them. Trade the Pool.
So, you touched on the creator of Bitcoin there, which you said is a whole nother story. What do you think was his motive for creating, or her? I mean, we don't know who it is. What do you think was their motive for creating Bitcoin?
I have to say, I'm definitely not an expert at kind of his writings. I know many people have tried to kind of analyze what he had written on Bitcoin Talk in the early days when he was corresponding with Gavin Andreessen and some of the people that are actually known in the community. And it seems to be that he was somewhat politically motivated, kind of coming out of the financial crisis of 2008. That's one narrative that I've heard, and it seems somewhat plausible. Also, the fact that the internet, it doesn't really have a native payment gateway. I mean, we use credit cards in kind of this makeshift manner, but Bitcoin kind of is the internet cash, which we haven't had up till Bitcoin.
Okay, interesting. Yeah, I mean, it's quite a mysterious world, isn't it? I find it really fascinating. Let's bring this back to trading a little bit. Why would someone want to trade Bitcoin over the listed markets? And also, what are the barriers to entry like?
One of the biggest advantages or curses is that it's the only true 24/7 market that is out there. There is no downtime other than the exchanges that you might be on going down for some reason. So that's one thing that I can see as an advantage. Maybe some people want to trade on the weekends, and they work 9 to 5 Monday through Friday. So that could be early entry for them into trading. Secondly, is as far as barriers to entry, once you have Bitcoin, Bitcoin doesn't really know how old you are. It doesn't require documentation or anything like that. So you can send it across the world and fund your trading accounts. And that's from email sign up to sending your Bitcoin to an exchange like Bitfinex is going to take you one block confirmation, so 10 minutes. And you're up and trading with whatever amount that you want to trade. That's a huge advantage, if you ask me.
Okay, so I guess you wouldn't come across the problem of the pattern day trader rule. I know that's an issue for many traders sort of starting out in the States there. Is you obviously get around that problem as there's no account minimum to start with?
Yeah, there's literally, I think the smallest is like 0.01 is like what you can, is the smallest trade amount, which I think is $4 now. So anything from there up is the limit. So there is no account minimum. There is no restrictions as far as you can't do 3 day trades. You can go through as many trades as you want. There's none of those kind of things that go on in Bitcoin.
Okay, cool. And we may have already touched on this just a little bit. I'd like to dig a little bit deeper. Who are the market participants in Bitcoin? Like, who are you up against? Who are you competing against? Obviously, you take this very seriously, but do you find there are also like many participants who are just there to sort of punt and try their luck? And yeah, who's on the other sides of your trades?
I think the interesting thing about what the Bitcoin market is currently is we have kind of the natural market participants, which I would consider the miners. The miners need to exchange some of their Bitcoin to pay, electricity, server cost, hardware upgrades, as well as the merchant processors that are, when you send your Bitcoin to Expedia, they're using a merchant processor like BitPay, and BitPay is giving Expedia US dollars. So they have to source that liquidity somewhere, and they're doing it off of exchanges. So there's some kind of natural, I'm using air quotes, users of the exchange in that way. And then there's like a huge gap where we don't really see a lot of like institutional activity in Bitcoin, whether it be just kind of like your buy side, taking large positions, or hedge funds. We basically then have a very heavy active retail segment, which is very on lines with kind of like a degenerate gambler mentality.
Okay. So in that case, I mean, I'm not sure what sort of volume is transacted on a typical day, but how easy is it for a participant with a lot of Bitcoin to push around the price and essentially manipulate the market? Is that a risk?
It certainly is. And Bitcoin is definitely driven by, kind of whale wars of sorts at times that move price on different exchanges. Sometimes one exchange is leading, and then other time it's following. So these participants aren't confined to one specific exchange, and depending if you're on that exchange, it can be advantageous or a disadvantage too. Sometimes a big move will happen on a different exchange, and your exchange hasn't moved yet. So there's an opportunity for you to take advantage of that before the price, comes more in line with what we'd see at kind of an equilibrium.
Okay, so in that case, how many exchanges are there for Bitcoin?
I think there's probably 6 to 8 main exchanges. And for me, I primarily watch 4 exchanges that I consider really the leading exchanges in Bitcoin. And interestingly enough, none of them are in the US.
Really? Is that just the 4 that you watch, or none of them are in the US?
Well, none of the exchanges in the US I feel are very leading as far as an exchange goes. So I don't watch them very actively. Does that answer your question?
Yeah, so there are exchanges that do exist in the States, but you don't watch those ones. I probably should have said that. That's a more clear way of saying it. Okay.
Yes.
Cool. All right, so while we're on the topic of risks or getting into it, what risks are you exposed to when dealing with Bitcoin? Like we've spoken in the past a few times, and one of the things you mentioned to me was counterparty risk is very real. What do you mean by this? And are there any other additional risks that exist when dealing with Bitcoin?
So with Bitcoin, it has this history, as I was alluding to earlier, with Mt. Gox probably being the most famous example of the exchange going bust and the traders or account holders losing basically 100% of their principal. We don't know if through all the legal stuff if they're going to get any of that back. So many of these people have been sitting for a couple of years now with no reimbursement. So and that exchange wasn't built to handle the load that we see on Bitcoin. So you have a lot of like early tech geeks that built an exchange, and problems arise that they didn't see as far as scalability goes. Then your funds are at risk on these exchanges, which is there's no insurance, right? If you open a brokerage account in the U.S., you have FDIC insurance. So even if your brokerage goes bust, they'll still reimburse you your principal amount. Now that doesn't happen in Bitcoin. In Bitcoin, it's very caveat emptor as far as that goes. So some people manage that risk differently. And as far as other risks with Bitcoin, there is no Bitcoin hotline to call or customer service line if you send your Bitcoins to the wrong address. I've been guilty of this. Luckily, it wasn't too much, but I copy and pasted an address that I no longer had control of, and I sent the coins there. And then I realized, wow, that's an address I don't have the keys for anymore. So, that's a risk too. And I think that's kind of what scares some of the people with Bitcoin that aren't technical savvy. Some of those mistakes can be pretty scary.
Yeah, well, I'm sure the person on the receiving end got a nice surprise when they saw some of your Bitcoins come through. What about the threat of hackers? I mean, do hackers pose any threat to Bitcoin? You mentioned there's quite a lot of, or can be risk associated with exchanges. What about when you're just holding the Bitcoins in your Bitcoin wallet or your account?
Yeah, there's been plenty of Reddit posts about people getting their Bitcoin accounts hacked. It tends to be they have a hot wallet, which just means it's sitting on their computer that's plugged into the internet. They get a Trojan or something like that. Somebody sweeps the keys, and once they have the keys, if your wallet's not password protected or it's got a weak password, they now have control of your Bitcoins. And as well as the exchanges, they get hacked too. So that comes back to this idea of counterparty risk. So even they who have gone great lengths to protect their assets do on occasion get hacked. We haven't had a major one since Mt. Gox. I mean, I'm knocking on wood now, but it does happen.
Okay. And what about you? Do you keep all your profits in Bitcoin, or do you transfer them out into US dollars from time to time?
It depends. I like to keep most of my profits in Bitcoin, just because I think in the Bitcoin mindset. So I'm always thinking of, am I up or down X amount of Bitcoins? I don't often try and translate it in my head to US dollars, but on occasion, I'll make purchases with Bitcoin, take a trip or something like that.
Okay. So, I mean, let's start to wind this down. I've just got a few more questions here. Thinking big picture, like long term, where do you see Bitcoin headed in the future? Is it going to take over and make a huge difference in the world? What are your thoughts on this?
Well, one of the things that's being talked about a lot is you have the very large, well-known banks, Goldman Sachs, JP Morgan, Citigroup. They're trying to somehow incorporate blockchain technology into their business model, because I think they've recognized that that creation is extremely valuable. Now they tend to kind of throw away the idea of Bitcoin, but they focus on this blockchain technology. So I do think blockchain technology is not going away. Now, does that mean Bitcoin itself is going to be the ultimate success? That's still to be determined. I have hope for it. I think it has the largest network effect right now. Doesn't mean that can't change, but I tend to think that that'll just continue to grow as we see more of these large companies try and plug into it. It'll just keep growing that network effect.
Sure, okay. Yeah, I mean, there's definitely an interesting road ahead, and it's awesome to get your take on that. Now, you're part of a very active community/resource for Bitcoin traders called Whale Club. What's this all about, and how'd you get it started?
Sure. So basically, if we rewind back to kind of my early start in trading Bitcoin during Mt. Gox, the fall of Mt. Gox, many of us ended up on this platform called TradingView. And TradingView is a charting platform, and they were one of, not the only one, but one of the first charting platforms to have Bitcoin charts on it. So naturally, Bitcoiners that are trading Bitcoin ended up there, and they have a chat feature. So many of us kind of got to know each other. But ultimately, the markets would move, and you're sitting in, like a lot of day traders, in complete silence, alone. So we jumped on a Google Hangout one day, and it kind of snowballed from there. As we maxed out the Google Hangout of 10 people. We would go with live Google Hangouts, but there's a restriction of 8 hours, and many people would be logging in to hear what's going on with price action. So then we made the transition to a TeamSpeak server. We currently have 1,000 slots open. I think right now we have about 150 to 200 people on there. And really, it's just kind of an open squawk box of the Bitcoin price action that's going on. And it also provides a really interesting resource for the traders, because many of the exchange operators have ended up coming onto our platform, and they're just part members of the community, just the same, but they kind of dual as customer service reps too. And it's very important when things do happen to the exchange, downtime for whatever reason, that they're immediately on there saying, hey, this is what's going on with our exchange, this is why we're down. And we get that information faster than anybody else. I see, Twitter posts or Reddit, but I'm talking to the exchange operator, right as it happens.
Yeah, that's really cool, and it's awesome that you've been able to put that together. And you've got a really decent sized community in there. I think that's an awesome resource. All right, Vix, well, let's do one last question. I mean, I haven't asked this one in a long time, but I think you're going to give a really great answer. What's one book that's been really helpful to you that you'd like to recommend to other traders?
It's an interesting one, and I have to confess that I'm kind of a diehard Nassim Taleb fan. So he's famous for writing The Black Swan and more recently Anti-Fragile. But one of the concepts that come out of that book are kind of the differences of linearity versus nonlinearity. And I think that's very important for a trader, because our profession is about the nonlinear. Just as I referenced back to kind of that myopia mindset of I need to make X amount of dollars per day. You might have 5 weeks that you lose or make next to nothing. Hopefully you're at least a little bit ahead. And then 1 week that really defines a quarter, half a year, or even your whole year. So that's kind of the non-linear versus non-linearity. And Taleb himself is a former options trader. So I think that's what it did for me was kind of break my mindset of stopping to think in such linear terms.
Right, I like that. And that's actually one book I'm keen to check out. Jack Little, who was on a few weeks back here, also mentioned both those titles. Really keen to check that out. There's just so many books I want to read, just not a fast enough reader to get through them all.
Yeah, there are a ton.
Yeah. So anyway, thank you very much for doing this, Vix. Where can listeners go to find out more about you? So maybe your website for Whale Club and also your Twitter handle.
Yeah, just at BTCVix is my Twitter handle. We're working on the website, but currently we have quite a bit up on whaleclub.org. We have if you follow me on Twitter, there's a Telegram group. Currently we have about 600 people in there. And then from there, if you want to come on TeamSpeak, you can do that as well. We find a lot of people like the Telegram group for just kind of, they're always plugged in on mobile, because TeamSpeak's it's kind of an old, Counter-Strike era program.
Okay, so what's Telegram? That's just a platform, like a chat platform, is it?
Yeah, it's kind of like WhatsApp, if you're familiar with that.
Okay, yeah. I don't use it, but I'm familiar with how it works, yeah. Okay, cool. All right, well, I'll make sure to include all those links in the show notes at Chat with Traders. So, if you do forget those, they'll be all there in one place at chatwithtraders.com. Vix, thanks so much for doing this. You've exposed me and probably a whole lot of listeners to a side that we really knew very little about. So I really appreciate you taking the time to do this.
Thanks for having me on, Aaron.
No trouble. We'll speak to you soon.
You've come to the end of this episode of Chat with Traders, but don't worry, more great episodes are on the way. To stay updated with each great new episode, be sure to subscribe to the podcast in iTunes, and we'd love it if you leave us a rating and review. We'll see you next time on Chat with Traders.
What would your trading look like if capital wasn't the constraint? That's the reality for most traders. It's not skill holding them back, it's size. Trade the Pool changes that. Step into the U.S. equity markets with up to $200,000 in buying power without committing your own capital. Full access to stocks and ETFs, long or short, executed with the precision and freedom serious traders expect. Your performance is measured by one standard: disciplined risk management and consistent execution. Meet that standard and you operate at scale. No subscriptions, no ongoing obligations, just a clear path forward. For those ready to trade beyond limitations, this is the next level.
The biggest secret of the best traders in the world is that they're just like everyone else. However, they've worked hard to learn the markets and discover what works and what doesn't. But how can you hear about these journeys and get in on the strategies and tactics they use? You can do it by listening to Chat with Traders. Here's your host, Aaron Fifield.
Hey guys, what's going on? Welcome to the very first episode of 2016. To start the year with a bang, I have a very special guest on the podcast this week who I'd like you to meet. His name is Rishi Narang. Rishi has an impressive background and has been involved with financial markets for well over 20 years now. He originally started out as an analyst at Citibank prior to co-founding TradeWorks with his brother Manoj Narang. TradeWorks was a fintech company turned high-frequency hedge fund. Since 2005, though, Rishi has been the founding principal at T2AM, a fund of funds specializing in short-term quant trading strategies. He's also the author of Inside the Black Box and was featured in a must-watch VPro documentary titled Money and Speed, Inside the Black Box, which I'll include in a link at chatwithtraders.com/54. During our discussion, which went for well over an hour, we spoke about the non-textbook definition of alpha, the components of a black box, where humans have an advantage over computers and vice versa, and we also explore the subject of high-frequency trading and speed. So guys, this is a really big episode. There's a lot to take in. Let's jump right to it. You're listening to the Chat with Traders podcast. I'm your host, Aaron Fifield. Here is my guest, coming to you from LA, Rishi Narang. Hey Rishi, welcome. How are you?
I'm fine, Aaron. How are you?
I'm doing really well. Thanks heaps for joining me. I'm about halfway through your book, Inside the Black Box, which is brilliant. And I really enjoyed the documentary you did with VPro, which was also titled Inside the Black Box. So all in all, it's great to be speaking with you.
Hey, thanks very much. And thanks for the kind words.
No trouble, man. Now, there's a few things I'm really keen to discuss with you today. Black boxes, high-frequency trading, and your backstory within the hedge fund world. So let's start there. I know your involvement with trading and hedge funds dates back at least 20 years now, and prior to this, you went for a degree in economics. So share with us what motivated you to get an economics degree and what initially sparked your interest in trading.
They have two pretty different answers. I'll do the trading one first. So trading became an interest back when I was in high school. There was not quite required, but I can't recall exactly, but most everyone had to take economics class in high school. I had this old war veteran, I think from World War II, named Bob Berger, who was my economics teacher. And, one of the projects was kind of like a stock picking game sort of project. And in those days, just to date myself a little bit, we picked stocks by reading the newspaper. And so in the morning in the paper, there would be the tables of stocks in the financial section. And it would show you the ticker and what the price change was yesterday in fractions, of course, and what the current price was, and maybe the volume or something like that. And so my dad, who had been dabbling around as many dads do with investing, he and I kind of worked on that a little bit together. And the first stock pick I ever made was Nike. This would have been around 1987 or 88. So I think it was a pretty good pick. But that sort of sparked my interest. As far as studying economics, then, when I went to Berkeley, my plan was to be a constitutional lawyer. It turned out that, and I mean specifically like arguing cases about constitutional law in front of the Supreme Court. That was really what I wanted to do. I went into Berkeley double majoring, well, my plan was to double major in math and economics. And a lot of the aspects of constitutional law I was interested in related to economic aspects of the law. And so that seemed like a good path. The math thing quickly became self-evidently too much work, more than I was willing to do. And so I stopped taking math classes and stuck with the economics. And what I found in my undergraduate years was that econ is sort of like a very philosophical approach to money. It's a lot of thought experiments and closed environments that are manufactured just to play out thought experiments. Much of econometrics turns out to be just a lot of smart people almost wanking off because the assumptions are so silly to start with. So I didn't really like my degree that much when I was doing it. I didn't go to my classes all that much or anything. And then I wanted a job, and I gotten a job as a programmer, though I didn't really know how to program that well, and I was pretty sure I was going to get fired any minute. And instead, I'd had an internship previously at Citibank in New York, rather, and I was living in the Bay Area near San Francisco and wanted to stay there. Didn't want to take the job in New York. They were pretty keen to hire me in New York to work for this fixed income architecture desk that would have had me helping build the trading environments for fixed income traders on the prop desks and the sell desks at Citi. So I just used their intranet page and found what offices were in San Francisco, and it turned out that they had this group called Citibank Alternative Investment Strategies, or Citibank Global Asset Management Alternative Investment Strategies, and I didn't know what the hell any of that meant. But it had a phone number, and so I called it literally out of the blue. And as it happened, the managing director of the group picked up his own phone. He had an assistant, but she pretty much always answered the call and screened his calls very heavily. But he answered his phone. They were looking to hire a junior. The guy had a favorable opinion of Berkeley. And the fact that I was already a Citibank employee made it very easy for him from a human resources standpoint. So I sort of accidentally landed in my first job in the hedge fund business right out of school.
Right. Okay. So what were you doing at Citibank on a day-to-day basis? Like, what does a global market strategist position entail?
Yeah. So this was also a fund of funds business. And at such an entity, the idea was to look prospectively at different things that were unfolding in capital markets and ascertain how those things would impact our portfolio of trading strategies. And then my job was to make recommendations to the portfolio manager about how to position the portfolio to take advantage of those themes. So a couple of examples. There was in Japan at the time, or up till that time, this kind of culture of propping up really crappy companies just on like a cultural kind of loyalty basis. So let's say that you're a mentor and your mentee has set up a really terrible company. you feel some obligation to look out for him, so you back it, and then you keep backing it and pouring good money after bad. And so it was very difficult to short stocks and make money in Japan because they would just never go away. They would just keep getting more and more lifelines. And what happened was we started to see the pressures of a long, bleak stock market in Japan take its toll on that very old system of patronage. And so we made the decision that it would be a good idea to go out and find some Japanese long-short equity strategies. Also, at the time I was there, and it was really lucky timing in a lot of ways. So I joined there in 1996, right out of school. And in 97, we had the Asian currency crisis. In 98, we had the Russian debt crisis and long-term capital blowing up. And then in 99, right around the time I was leaving, was really getting near the peak of the dot-com bubble. So we got to see lots of interesting. Oh, and by the way, also in there was the introduction of the euro, this Japanese stuff. So there was lots of fun events to try to figure out. And we did make some interesting decisions during that time. But it was very much a discretionary thing. Now, I was pretty good at math and some very rudimentary kinds of programming. And by that, I mean like Excel formulas and some really random other crap. And so I was kind of the resident quant as well in that shop.
Okay, so where did you acquire, a lot of your programming knowledge? I mean, you mentioned earlier that you did take on a position for a very short amount of time, and you weren't a very good programmer at that stage. Where did you acquire sort of most of your knowledge on programming between then and sort of this point we're at right now?
This was a combination of inside the family. My brother, 5 years older than me, went to MIT majoring in math and computer science. And this was back when Indians were meant to either become doctors or engineers. They were really not meant to be computer programmers or go into finance. And my brother did both of those things. And much to the dismay of my parents at the time, not realizing that he was in fact a bit of a vanguard among many thousands of Indians who would follow those footsteps later, in the US anyway. Somewhat in school, more in high school, frankly, even than in college. Sitting down programming was never really something I was excited about or interested in, so I never got good at it. And having to, especially in those days, the programming languages were so specific about syntax, and that always tripped me up because I'm just not good at that. I don't care enough about where the period goes.
Okay. So at what point did you decide to move on from Citibank, and what was your next move from there?
Yeah, so the aforementioned brother, he called me in the beginning of the year of 1999 and said that he wanted to start a fintech company, financial tech company, and that I had to do it with him because it was such a crazy good opportunity. He wanted to bring me along for the ride. He wanted somebody he could trust. He wanted someone competent. Bear in mind, I was 24 and really happy. I was doing well at Citi. I was making more money than I ever thought I would make as a completely terrible student in college. And with a great career path ahead, my boss really liked me at the time, and but he was quite insistent. And so eventually I capitulated and quit. So that was in March of 1999 that we started what was then actually called StatArb Inc. StatArb being the street name for statistical arbitrage, which is one of the earlier quant hedge fund strategies. We quickly ditched that name and called it TradeWorks instead. Even then, it was hard to find good names and good domains, so we had to spell it with the X at the end. And so that got going as a company that was really trying to do something that was way ahead of its time. Today, it would have been a better idea because of things like Quantopian and the World Quant trading competitions and so on. But basically, the idea was to make professional investing and trading tools and analytical tools and decision support tools, and make them available to just straight up retail investors, people who trade for a hobby.
Okay, so were you doing any trading internally at that firm?
Not until much later. So at some point, we developed a lot of really interesting tech and decided, well, we were having kind of trouble. This is just before the peak in the dot-com bubble, right? So we were having a bit of trouble with the business model. Our customers were meant to be places like E-Trade and Ameritrade, and they were losing business really rapidly and not taking on new expenses and so on. So we said, well, look, we've all come from my brother was a prop trader at Goldman and had previously launched a reasonably good, though very small hedge fund before TradeWorks. So we decided it made sense to try to monetize the technology a different way. If we weren't going to do it with like software or online licensing services, then maybe we would do it as a hedge fund. So we launched our first hedge fund back in February of 2001. And after 9/11, really the fintech business, especially in New York, really just dried up completely. Deals that were all but inked didn't get inked. Business just stopped. And so we shut down all the tech and when we were just a hedge fund. And I actually left TradeWorks about a year after that and went to work for back on the fund-to-fund side, what was then TradeWorks' largest investor, which is a small fund of funds based on the coast of California. So it was great for me. I wanted to be in California. TradeWorks was sort of changing gears, and they had enough quants on staff, and I wouldn't have been the strongest among them anyway. So I left and worked, and I became a client instead of TradeWorks's. And I was there for a couple of years and then set up my own shop at the beginning of 2005.
Okay, cool. So I'm really keen to dig into that. But just before we do, up until this point, I mean, it seems as though your trading background is entirely within the professional space. Has there ever been a point where you traded on the retail side?
Yeah. Actually, so around the time I was in Citibank, I had a bunch of friends from college who were really active punters in stocks and just like highly addicted to trading stocks and stuff. And so almost just out of being social with them, I can't remember if it was a Daytech account. And I punted around quite a bit as well. And I did so fucking poorly in those early days, excuse my language, but so poorly as a stock picker. And a lot of it, to be honest, was just I didn't pay that much attention. I was sort of just picking stocks based on how I felt the wind blowing, and that's not a really terribly clever way to do it. And what's pretty funny is all these years later, and I should be clear, like after that, I did put on some really successful and thoughtful personal account trades. I remember I went long Best Buy and short Sears and made money on both legs of that. I made money being long Schwab and short E-Trade. And so I got better at doing the personal trading later, but it was always in these kind of very specific constructed trades. It was never just, I know which way Sears is going and I make that bet. I was never any good at that. Never showed any evidence of being any good at that anyway. But all these years later, I now run a firm that's got a few employees and, as a registered investment advisor in the US, you have to have personal trading policies. And so those, you can kind of have just about any valid sort of policy you want. And we have one, which is very standard. It requires pre-clearance. So someone has to ask our chief compliance officer 2 business days before they want to make a trade. They have to hold the trade for some number of days. I don't even know what it is, maybe 30 days or something. And then they have to request pre-clearance again to get out of the trade. And while that's our policy, the unofficial policy is don't fucking trade. And the reason is I don't want my people trading is that we're professional investors. And all we do all day is make sure our traders are really, really careful about how they invest money on our behalf and on our clients' behalf. It doesn't really seem very consistent with that to have people spend a tiny fraction of their time punting around in stocks or anything else. It's sort of like a chef at a 3-star Michelin restaurant, spending part of his time cooking at McDonald's or something. It's not okay. It seems an insult to our clients and an insult to the profession to not take it seriously when you put on a trade. But if they have time to take it seriously, it means they're not doing their job. So I don't trade anymore.
Sure. Okay, so let's talk a little bit more about the fund that you operate these days. So you founded it in 2005. I think you might have already mentioned that, and it's T2AM. So at this point, I was going to ask you, what's your trading approach? Like, how do you trade today? But
right.
I understand that you guys are a fund of funds. So would you mind explaining what actually is a fund of funds?
Sure. So fund of funds have been around for some decades now. They are effectively, and their role has evolved over time. In the early days, investors in hedge funds were primarily high net worth individuals who were clients of like the big Swiss private banks, as well as some Asian institutions like Japanese insurance companies and stuff like that. There wasn't that much U.S. money in hedge funds in the early days. And so the job of a fund of funds was really to find out, like to basically broker for capacity. So there were middlemen who would find good managers. The best of them would also conduct a lot of due diligence to see which of these managers are really good, which of them are frauds, which ones are really talented, which ones know how to manage risk. And the really best ones would also try to be very thoughtful about assembling a portfolio of these things that made sense together, as opposed to just picking a bunch of things that might each be good, but maybe are all very similar. And so as institutional investors have become much more sophisticated in this space over the last 20 years, and especially over the last 10 years or so, it's very difficult to go out there as a fund of funds with that generalist kind of approach. When I started this company, I had left a firm that specialized in investing in quant. TradeWorks was a quant hedge fund. I have a reasonably good grasp on both math and programming, even though I don't like programming. I've managed teams of developers and stuff. We really have always been interested in having a much more narrow style. And still to this day, it isn't easy for investors to pick quants. And the reasons are several. They tend to be pretty opaque about what they're doing. They don't like sharing a lot of information about what they do. They're notorious for it. It's actually why the space is called black box investing. Whenever you see a breathless article in the Wall Street Journal or something, it inevitably says complex formula, complex algorithms, etc. And so that is certainly the perception. I think some of that is true and some of it's overblown. I think the space is easier to grasp than many understand, but it's not that easy still. So we set up as a niche shop that focuses on systematic quantitative trading strategies. Mainly, we're interested in shorter term holding periods, and I don't mean by that necessarily high frequency holding periods, but a few days instead of some months or quarters or years. And there are systematic styles that go out much longer. There are systematic strategies that are truly fast, and we're sort of in between.
Okay, so how do you evaluate the trading strategies and the traders that you allocate funds to?
There's a bunch of pieces of it. The part that's kind of probably interesting for a conversation like this isn't the operational due diligence, like how do they do reconciliations the next morning, and what are their personal trading policies, and are they staying compliant? That's all there, but it's sort of legwork at the end. The part that's kind of more fun is picking the strategies and choosing the practitioners and seeing if we can pick good ones. That's the really challenging part. Effectively, it comes down to good engineers with good judgment. That's really what we're looking for. The level of impact that the discretion of a human has on the building of a quant strategy is enormous because the computer doesn't know anything. The computer needs to be told everything. And that person who tells it everything, its teacher, as it were, has to be really good. They have to have good judgment about research methods, about data cleaning, about all sorts of stuff. Some of that stuff ends up being really mundane and monotonous and detail-oriented. Some of it's really philosophical and more fun-sounding. But a lot of it comes from experience. Some of it is probably innate. And it's hard to say what brings good judgment to some people and not to others, but it isn't that hard if you're willing to do the work to find out who has good judgment and who doesn't. And it's a lot of just asking tons and tons of questions and tracking the information really carefully, cross-referencing earlier answers with later ones, asking the right questions too. So if you look at the chapter headings in the book, those are the areas that we focus on, actually. We ask about their alpha models. We ask about their risk models. We ask about their transaction cost models. We ask about their portfolio construction models. We ask about their execution algorithms. We ask about their kind of risk management and monitoring. We ask about their research and development and their data. Those are really the areas. If you look at the headings of the sections of questions in our standard in-house due diligence questionnaire, those are the headings.
Okay, sure. So where do you find a lot of these traders? Are they working within other firms already, or are they just sort of guys who are out on their own? Like, where do you find most of the traders?
Yeah, it's a good question, and the answer is all over the place, both geographically and in various sort of situations. So we have one of our traders is literally a one-man band who works from his apartment. He has no employees. He doesn't manage very much money. I think he's got 15 million under management, which I know in the real world is a lot of money, but in asset management land, to put it in perspective, he's too small for the regulators to want him even to register for oversight. So he's a very small shop. On the other hand, money with a couple of guys, and had over the years money with a couple of guys whose assets under management are in the billions. They have large teams. They have their own floor in some fancy skyscraper in New York. I mentioned to you I was in Australia just recently, and that was to do a site visit on a couple of managers in Melbourne and Sydney that are more on the emerging side. So because of how long we've been doing this and our reputation in the space, most shops that are setting up a professional kind of hedge fund, systematic hedge fund, want to talk to us because they know that what we do is specialize in quant. Other investors know who we are, and so if we've made an investment and if we're willing to act as a reference, that can be a handy thing for a manager, for a guy who's setting up. So we get a lot of flow just naturally. But we have to work very, very hard. So I do, between me and my teammates, we do something like 30 or 40 calls per quarter with various contacts who are also looking at managers and are in the flow of managers and just sharing ideas to make sure that we can cover everything as much as possible.
Yeah, okay. That's really interesting. One of the things I saw on your website when I was looking at it before we got on this call is you say one of the key components of your strategy is described as pure alpha. What does pure alpha refer to?
Yeah, so it's also a good question. The kind of textbook general definition of alpha is sort of the returns above the market, assuming it's positive, or below the market if you have negative alpha. I've never really loved that definition of alpha. It's sort of a definition by elimination. So it's whatever the returns that aren't from the market are. That's not a very satisfying definition for me. To me, it strikes me as being really intuitive and clear that alpha is actually just about timing. And it's actually a very specific kind of timing. It's so I'll give you my formal version of the definition of alpha, and then we'll kind of talk through it. So to me, the real definition of alpha is the returns generated by skill at timing the selection and or sizing of your holdings. So if we unpack that a little bit, I'm interested in skill-based returns, not luck-based returns, right? We try to ascertain skill by virtue of, again, interviewing these traders really thoroughly and trying to ascertain if they've gotten good results by luck, or if they've gotten good results by a combination of good judgment and a lot of hard work, which is what it really takes. There is luck as well, but you don't want that to be the main thing or the only thing. The timing thing is really the centerpiece, though, of this definition. And I say that alpha is all about timing because let's imagine that I know some company inside out, and not because of inside information, but just because I'm really a good analyst. I know this company inside out, and I know that it's a fraud. I know that it's going to go bankrupt. But I'm so far ahead of everybody else. And so I go short it, right? I'm so far ahead of everybody else that I'm wrong for a really long time. I mean, I can go out of business before the market realizes that I was right. And so from a return standpoint, I wasn't right. I was wrong. Yeah. I went out of business. I lost all my money on a trade that I was somewhere down the line correct about. So I've not shown skill at timing. Skill at timing comes from being able to anticipate, roughly speaking, a couple moves ahead. What are other investors going to demand? To illustrate this a different way, think about Warren Buffett. Warren Buffett, when he picks a stock, he doesn't say, well, Walmart or whatever is a great company all the time in perpetuity at any price, right? His bet is that, no, right now is a good time to buy this company. Maybe the company has the right management for now. Maybe its price has come down enough that it's a good value. Maybe there's enough margin for safety, and it's whatever his factors are. It's a timing decision. Well, if other people come around to his way of thinking not long after he's got that way of thinking, and not long is subjective. It's up to his strategy how long that needs to be, how long he's willing to hold something, and how much he's willing to see it suffer before he's ultimately proven right. Then he's got alpha, right? And if other people end up disagreeing, if the consensus is no, this was a crappy company and it was cheap because it deserved to be even cheaper and it was on its way there, then it would not be said that he has alpha. So to me, alpha is just about timing. So when we say we're after pure alpha, what we mean is that we don't want any returns just from the one-way bet on a market, because a lot of that's just luck. When did you happen to get into the market? Are there any events that force you to sell at an opportune time? There's just so much that is random about that. And what we were after was much more, as we say, skill-based returns. We want our returns to be generated by skill at timing.
Yeah, I really like that response, Rishi, and that actually kind of reminds me of something Peter Brandt said when I interviewed him, and he said to be right on a trade, you need to be right on both direction and right on timing. So, yeah, I think that ties in really well. Now you literally wrote the book on black boxes, so these next few questions will branch off of this, as well as some general questions about quantitative trading in the mix. So, first of all, the way you see it, how do you define a quant trader, and what is a black box?
Sure, yeah. So I'll kind of answer both things together, and then I'll give a caveat at the end of the answer. To me, a systematic trader or a quant trader or a black box is simply a systematic implementation of some investment strategy. So again, to unpack that, let's start with the investment strategy. And while I'm not a big fan of wars, they give us terms like strategy and tactics. And so we can kind of borrow those terms from that arena. So, a strategy is sort of your approach, right? It's more of a philosophical guiding direction. So in war, there's things like, taking one strategy for war is taking airplanes, bombing something, and then following with ground forces. Another strategy is guerrilla warfare or urban warfare and using human shields and that kind of stuff. And so a strategy in investing, it doesn't have quite the same bloody connotation, obviously, but something like value or GARP, growth at a reasonable price. These are approaches to investing. And so you can take a style like value, a strategy like value, and codify it. Well, what do you mean when you say a stock is cheap? First of all, what do you mean by a stock? Is it a U.S. company? Is it every U.S. company? Is it just large cap ones? Is it just small cap ones? Are they in all sectors? You have to feed a universe into the machine. And so the first thing that you're encouraged to do is think about what universe. And then the style, what does cheap mean? Are we talking about some ratio of some fundamental quantity, and if so, which, to price? Or some substitute for price? Is it today's price? Is it an average price over some period? So by codifying, you have to specify a lot of stuff. And that turns out to have really interesting and important consequences as you go out building a strategy. The next part of it really relates to the caveat, right? So a systematic implementation just means that you've taken the emotion out of the day-to-day buying and selling decisions. You've done a brain dump of your idea of how to invest in the markets into a piece of code. That code is running on a computer and coldly making buy and sell decisions on the back of that instruction. The caveat is that this is not a binary thing, right? So there are levels of systematization. For example, would we call someone a quant who does all of what we just said, but at the end, before he pushes a button or before a button gets pushed or trades are sent out to the market, he kind of goes through the trade list and says, well, is my model missing any information about one of these names? Like, let's say a company's moved up a lot today, and it's moved up a lot today because Warren Buffett said he's just bought a bunch of shares of it. And so on the back of that, lots of people are buying it, and it's a really highly bullish thing. Let's say that that's a real thing. Like, you really expect now that company is going to go up. Well, the model doesn't know that necessarily because you didn't feed it that data about Warren Buffett's words, understandably. And so maybe it wanted to short that stock because now suddenly it looks like the price has gone up, the fundamentals haven't changed. So maybe you take out that trade from the list. So is that still a quant or not? Well, I mean, it's arbitrary to say. So we don't have to worry about it. What we're after is mostly, generally speaking, systematization, taking the emotion out from day-to-day buy and sell decisions.
Okay, and when you say a black box, does this differ in any way at all from what many would call a system?
Well, so the connotation is different, but I don't think the term means anything different when you really boil it down. So the term black box really comes from a sense of not knowing what's inside. It's this opaque process, like a Rube Goldberg device, where you take an input in on one side and then all kinds of machinations just happen magically inside. And then there's an output, which is a buy or sell decision at the end. And that's how a lot of investors feel, and how a lot of reporters and even until not long ago, regulators felt about what systematic trading was. But I don't know if it's generational and people are just increasingly comfortable with programming computers to do things that we didn't think they might do before, like drive cars, or what. But we are seeing a less fearful approach to the space over the last couple of, well, even less than the last couple of years, quite recently. We'll see if it lasts, but it seems to be the way things are headed. So yeah, to me, the black box thing is almost a pejorative term, saying, well, we don't know what the hell's going on in there. It's inscrutable. So we're just going to call it a black box. But anytime you hear that said in trading or in finance, they're really referring to just systematic or computerized or quant trading strategies.
Right. Okay. Cool. So,
ever watch a stock rip and think, I could have nailed that if I had real capital? The truth is, many capable traders never reach their potential, not due to lack of skill, but lack of scale. Trade the Pool was built to solve exactly that. A firm designed for serious individuals who want access to the U.S. equity markets with meaningful buying power, up to $200,000 without committing their own capital. Get access to virtually every stock and ETF. Go long or short freely with the flexibility professional traders expect. You're evaluated on one thing: your ability to manage risk and execute with consistency. Meet the standard, and you trade at scale. No subscriptions, no ongoing commitments. Whether you're still refining your strategy, a trader with experience who hasn't yet broken through, or a seasoned professional simply looking for more capital, Trade the Pool is built to meet you where you are and take you that next step further. The markets have evolved, access has evolved. Now, so has the way traders operate within them. Trade the Pool.
This is something you cover at length in your book, is the typical structure of a black box. But for the purpose of this interview, would you be able to give us just an overview of the individual models that come together to form the components of a black box and how they interact with each other? I know this might be a little bit tricky without visualizations, but just if you can give us a brief overview.
Yeah, sure. It's actually not all that tricky. If you think about it, the trading system is, like any other economist, an allocator of scarce resources. The scarce resource in this case is capital. You have only so much, and you want to earn a good return on it. Think about it the same way that the CEO of a company thinks about it. If I've got a company that does fasteners, because that's what I know, I have some business strategy for that, et cetera. When I'm going to make business decisions, I need to take in various kinds of input and then think about how to transact. And I don't mean this in the stock buying and selling sense, but in the real world, rubber meets the road, buying equipment, hiring people, opening an office kind of sense of transaction costs, legal documents, and so on. What are the kinds of inputs that you would take in, right? You would take in, what's the opportunity here? What's the upside? That we think of as coming from the alpha model. So the alpha model is the first and in some ways most important piece, because without an alpha model, without a forecast of the future, without a timing model, in other words, all hope is sort of lost that you're going to make money. So why do any of this other stuff if you don't have alpha? Well, the alpha model is forecasting the future. It's telling you, here's how you can make money. Maybe. Here's your best shot at making money. But if we just compartmentalize it, it's ignorant about risk. And so then you want, your lawyer, to be your risk manager, right? in a company, to say, well, wait, we could try to sell this sort of product to so-and-so, but here are all the licenses we need, and here's how much that costs, and here are all the downside risks of this. And so a risk model is really about controlling unwanted consequences as much as possible. And then the third piece is a transaction cost model, which you can liken to the sort of accounting department, who are really telling you, if you're going to do this, this is how much it's going to cost. So is the upside worth it? Right? So now we've got opportunity, we've got risk, and we've got cost. And these are, roughly speaking, the three major kinds of inputs that any decision maker takes in when they're deciding how to allocate resources. So those kinds of inputs go into a portfolio construction model, the most typical of which is an optimizer. Is not a really useful term because depending on your approach, everyone uses an optimizer, even if they're equal weighting their positions. They're optimizing for something. But anyway, there's a specific kind of optimizer that people mean, a mean variance optimizer, the kind that Harry Markowitz sort of invented some decades ago. And this thing is trying to balance upside, downside, and cost. Those three kinds of considerations. Upside coming from the alpha model, downside coming from the risk model, and cost coming from the cost model. So we have three models that feed into this portfolio construction thing. The portfolio construction model says, right, given those pieces of information, this is the best portfolio to own going forward. That then gets compared to what you own today. And the differences are what you have to trade. So if you don't have any positions today because it's your first day on the job, then you run your optimizer and it takes in all these inputs, and poof, out comes a list of things to buy and sell, and the whole thing is your set of trades. If you had a portfolio yesterday, it's pretty likely it's pretty similar to the one you're going to have today. And so just the small deltas, the small differences are what you would then go out to market and trade. And so the last part of a quantitative sort of a black box approach would be then these algorithms that actually place orders in the market. Now, this is all kind of girdled in research because each of these areas can be researched, and in the best cases are researched very thoroughly. When we talked about at the very earlier part of this topic, how when you codify a strategy, you're forced to specify a lot of stuff. That act of specification, again, in the best cases, encourages a good practitioner to be not arbitrary and to try to do research. So what do I mean by value? Well, let me conduct some research and find out what I should mean by value. I have some general ideas, maybe even some pretty specific ones, but it turns out I can test those ideas. And a well-made test is, not a bad way to kind of get a sense of whether this idea just sounds good and turns out not to work, whether it sounds good and could work, but only in unrealistic implementation assumptions like costless trading or something. So research really drives everything. What risks should I control? Well, it depends on what bets I'm trying to make. And all of that kind of needs to be studied very carefully. So that's this sort of cloak over the whole thing of research, or an umbrella over the whole thing of research. And then in turn, both each of these pieces and research itself, of course, require data. And so these are the things that are outside of the black box itself, but totally crucial to it. I mean, data are like the blood in the body. You can have muscles and a skeleton and organs, but without blood, nothing's going to happen.
Yeah, I think that's a brilliant answer. I really like how you broke that down. So thank you very much for going into depth and explaining that. Obviously, you go into it at greater lengths in the book. So if anyone wants to check that out, Inside the Black Box. Now, are there any special risks inherent to quant trading, like risks that may not be a factor to other trading types?
Model risk. What we have then is a situation where we might have said, okay, I think that valuation is what drives future prices. Well, that's a very elementary thing. Lots of other things that aren't value might affect future prices. Growth, sentiment, a company's balance sheet, and whether it's taking on tons of debt, whether it's been downgraded by a credit rating agency. I mean, all kinds of things affect the future price of a company, not just the thing I modeled. And so that is really at its heart what model risk means. It means that I've simplified the world, and sometimes things I didn't account for will drive prices and cause me to lose money. And lots of times this stuff happens. After 9/11, airline companies went down and the defense companies went up. And if you just happen to have an accidental bet on airlines and defense companies in the wrong way, you would lose money. And by the way, if you accidentally made money, that's better, but it's not a lot better, right? It's still an accident. And so what we think of as being a specific risk to quants is model risk. Now, humans, when they have a strategy, have this same problem. And I can give you an example from right now. One of our clients is a wealth management firm. That means they have a bunch of rich people as their clients. They have other sorts of managers and other sorts of spaces. So they have some like long-only stock pickers. And one of these long-only stock pickers was long casinos in Macau. Okay. And seemed like a great bet. Fundamentals all lined up. They didn't account for the fact that China was going to make it really hard to kind of get money out of China by sending it through casinos in Macau. And when they did impose serious restrictions on doing that, and I don't know all the mechanics here, but when China did make some change to its capital flight rules, the casinos in Macau started losing business really quickly, and their stock prices suffered as a result. Well, that's model risk too. It's just we don't think of it that way. In the case of a human, the human can identify that much more quickly and often prospectively and avoid it. In the case of a quant strategy, it's very hard to do that because what data could you feed into your machine about China's arbitrary policies? It's very hard to handle that kind of stuff. And so you can't really conduct any research about it because there's no historical precedent to look at, and even if you can find analogies or analogs for this thing, it's not easy, right? So model risk is perhaps a risk to anyone who's got a disciplined investment strategy, but more of a risk for quants than for even a disciplined human, because what machines are good at is mass production of a concept. What they're not good at is nuance, and that's where the human mind is a better tool.
Yeah, that's a really good point, and I think this question may tie into that somewhat. This is another topic you write about in your book, and that's common criticisms of quantitative trading. One of which is those who say trading is an art, not a science. How do you respond to this point?
I'd say that it's both, and that's the response. And by the way, lots of things which people thought were an art, not a science, including certain actual arts like writing, creative writing. There now are interesting pieces of software run by some of the R&D houses like IBM Research and so on, where they're writing poetry. Computers are writing poetry in an automatic way and doing like tests with English professors to see if they can really tell what was written by humans or what. Anyway, leaving that Turing test aside, medical records are being read by, images, right? Like X-rays and CAT scans and that stuff are being read by computers now more than doctors. And no one would have thought, like if you asked a doctor if that sounded like a good idea 5 years ago, they would have said, hell no, that's terrible. Will never work. Driverless cars, et cetera. I mean, so I guess the reality is that there's room for both approaches. It's fair to say that computers can't understand nuance, but it's also fair to say that humans are really unreliable practitioners. Human pilots, when they're in charge of airplanes, sometimes take the plane to the wrong airport because they were busy, distracted playing a Sudoku puzzle. This is a true story. Pilot error is a big thing, right, in causing plane crashes. And leaving aside pilot error, and not to trivialize important examples of life and death, but there was that flight in Europe where a depressed pilot crashes the plane full of passengers into a mountain. I guess that's the findings that they had. I mean, it's really hard to say that humans are so great. We're good at coming up with ideas. We're not so good at implementing. If you think about it in sports, and I don't know if it's the same in some of the sports that are more popular in Australia, but in the US, for example, there's baseball. And when a pitcher's having problems, or in American football, when a quarterback is having problems, a lot of the time you'll hear the coaches and the commentators pointing to his mechanics. What does that mean? It means he's not doing the exact same thing over and over. He's changed his arm angle slightly and it's screwing something up. Or he's changed his release point slightly and it's screwing something up. This is not something that computers generally have problems with. They have the same release point pretty much every time within mechanical tolerance.
All right, well, let's now narrow in on the subject of HFT. As someone who is a great advocate for HFT and you believe there is a lot of misinformation flying around, I'd love to get your take on this. Probably the first thing I should ask is, what is high-frequency trading and how do these firms make money?
So there really isn't a canonical definition of HFT. The definition I use is really a strategy that has three defining characteristics, or three characteristics, I should say. One of them is that it tends not to forecast out further than a day. In other words, it's not trying to time things further than the end of today. Secondly, it tries generally not to take home positions overnight. So it's mainly active intraday and then goes home what we call flat, which is to say largely just in cash. Both of those characteristics are more optional. The third part of the definition is really not, and I think is the most universally accepted part of it anyway, which is that the strategy is sensitive to the amount of latency between, and the latency really is referring to how much time it is between an event happening in the market and your systems being able to process that, and then in turn, how quickly that decision that you've made on the back of, in response to the market, is going back out to the market. So the kind of round turn of information into you and then back to the market is the sort of latency that people care about. There's a bunch of subcomponents there that we can talk about, but that's the short of it. So if a strategy really needs to be implemented on a very fast infrastructure in order to make money, then it's a high frequency strategy. So beyond that, it's a very poorly defined term because a huge number of things are conflated into this term that aren't any more similar than car is to driver.
Yeah, okay, that's really interesting. So would you mind expanding on some of those subcomponents that you mentioned there?
Of latency?
Sure, yeah.
Okay, so the first thing that there's a bunch of them, right? So one of them is that an event happens in the market, and that piece of information has to reach your server. Okay, so that's the first node, and connection between those two nodes, the connection between the event happening and the first node, which is your machine finding. That's the first amount of time you want to minimize. Then you have to process that event, meaning your computer has to make sense of how does this message fit in with all the other messages and what type of message was it, and make that information available to your internal decision-making algorithms, right? That's the second node. And then your decision-making algorithm has to process, so the start and end date, time stamps of that's the third segment of time you want to minimize. And then your order has to go back out to the market and be in the market again. And so that's another. So there are a few of the major. Those are the major sources of potential latency, which as a high frequency trader you'd want to minimize.
Okay, so what you're saying, just going back to your first response there, was that there are various types of HFT. You can't really put every firm who trades within fractions of a second and who relies on latency to be minimized as much as possible. You can't put everyone in the exact same category.
I mean, you could, but it's just ill-defined. And so it'd be like saying vehicles as a category. I mean, there are many types of vehicles and different types do different things. So, not to be too coy about it, let's just dive right in on what types of things are. I mean, we can do some subcategories of types of HFTs that are sensible. So one type of HFT, and one that I think is the most familiar to people, is what we call like a regulated market maker or contractual market maker. And so these are folks who, for example, if you have an Ameritrade account, this is one of the big online brokerages here, and you place a trade, the odds are quite good that trade is going to a big market making shop, part of whose existence is to take the other side of your trade and to do it quickly and at a very fair price. They're required to take the other side of small trades. They are required to fill as best they can larger trades. There are some shenanigans in that area that we can get into, but one of the practices that I think is at least fair to say questionable is this practice of payment for order flow. So I'm some broker. That broker has a bunch of clients, and those clients have a bunch of orders. And I, as the broker, rather than connecting those orders directly to the marketplace, I'm routing them to a market maker. Well, why am I doing that? Partially because the market maker is going to pay me. And so one of the line items of revenue on like Ameritrades and E-Trades, most other brokers, statements, ironically, Schwab also. If you look at Schwab, who were very outspoken opponents of HFT after the Michael Lewis book came out, ironically, they engage in payment for order flow, which is to say they receive payments from HFTs for routing those trades out to HFTs. This is a practice that I think deserves some scrutiny. It's a very old world practice. It's an old school practice. It predates HFT as we know it. HFT as we know it, especially in the U.S. equity market, really didn't exist in anything like the form it does now until about 2007. But this payment for order flow stuff goes back way further than that. Kind of wholesale market making operations go back decades. The next kind is a non-contractual market maker. So there are strategies which sort of loosely provide liquidity to the marketplace. They're very skittish though, because if you're not very careful, it's a highly unprofitable thing to do. It's a great way to lose money. And so you want to be very careful if you're going to provide liquidity to the market that way. A third kind are what we call just fast alpha traders. And so these are taking the same kinds of strategies and concepts that a slower trader, someone who holds positions for days or weeks, might use. For example, mean reversion. It's a bet that similar things will have their price converge. So if you have, two airline stocks that are both large cap in the same country, like American and United, all else equal, especially on a short time scale, any divergence in their price is likely to be some short-term liquidity-driven thing. And so if you fade that move, if you buy the underperformer and sell the outperformer, you have a fairly low-risk trade, and maybe you'll make money on it. And so there's some of this kind of stuff that goes on in the sort of fast alpha category, and lots of other little games and trades. Ideas for alpha, they just have a short horizon. And the last are the most latency sensitive, which are the true arbitrages. So things like index arbitrage. Funny enough, they're the most latency sensitive, but also the ones which violate the first two components of the definition of HFT I gave earlier, especially the one about, particularly the one about not taking home positions overnight. So in an index arb trade, let's say you have an index of 50 stocks. I think the EURUSD has 50 stocks in it. So there's an index that trades on a futures market. There are ETFs that track this index as well. And then it has the 50 underlying components. Well, if you can see in real time that the index isn't tracking its components properly, then you can buy the underperformer and sell the outperformer, and you've effectively locked in a riskless profit. The problem is you may never be able to exit that trade, because when you go exit, you're going to have to pay transaction costs to get out, and that will wipe out the profit. And so what you see often with index arb is it builds up really huge positions, but they're riskless because you're long A and short the components of A, which is the same thing. The sum of them is the same thing as being long A. So you're long A and short A and riskless, but you've locked in this little profit by being very, very, very fast. So those are the most speed-sensitive traders. The second most speed-sensitive traders are the voluntary market makers, the sort of non-contractual market makers. They have to be fast because one of the ways that you have to be very careful is leaving stale orders out. You get what's called picked off, which is to say you've put up a bid to buy at $100, and if you're not really careful about getting rid of that bid as soon as it's time to get rid of it, then someone will take very serious advantage of you, and you'll be buying at 100 when you should have been buying at 99 or 98 or whatever.
Okay, so just to help us better understand those last two types of HFT, the ones that require reduced latency, what type of volume are these firms transacting on sort of a daily basis, and how much money are they really making? I know it's a very broad question, but just to give us some sort of idea.
Well, I've never seen a breakdown of any of these subcategories because they're categories I sort of came up with in thinking about the space and trying to decompose it in a more helpful way than just some monolithic title of HFT, which doesn't even really make much sense given the heterogeneity inside that label. That being said, there's a group called the Tab Group. I think they're based here in the States. Larry Tab is the guy at the head of it. And they've done as good a job as anyone, I think, at trying to tabulate results on both questions. And so, the kind of expectation is somewhere between half and 60% of volumes in U.S. equities are done by HFTs of various types. And in terms of profitability, that number has come down, pretty dramatically over the years. So, according to the Tab guys, and this is from 2014, in 2009, the aggregate profitability, and this is in U.S. equities only, but that's a pretty big market, obviously, was $7.2 billion in HFT. It has declined every year subsequent, and the most recent figures they had in 2013 were $1.1 billion for the exact same thing. So it's, 1/7 the size it was, something like an 80% or so reduction, 85% reduction in profitability in the industry overall. And to put it in per share perspective, we're talking about $0.001 per share. So a tenth of a penny per share is the aggregate profitability of HFTs relative to the volume that they do.
Okay, interesting. So, sorry, just one thing you said there. Did you say $7 billion in 2014 and then...
No, 2009.
Oh, 2009. Okay.
Yeah, down to $1 billion in 2013. The study came out in 2014.
Right. So why do you believe that number's on the decline?
Well, a few reasons. One, volume's on the decline. And especially through that time point. I mean, I haven't tracked exactly how volumes have evolved this year, but secondly, competition. There's so much more HFT going on than there was, that so many more players competing to provide liquidity, as it were, that the price of liquidity has come down. If you think about it in basic Econ 1 supply and demand stuff, in that framework, liquidity is a thing for which there should be some equilibrium price. And as there's more supply of liquidity, that price goes down. As there's less supply of liquidity, that price goes up. And sort of a secular trend over the last several years has been an increase in the supply of liquidity relative to an actual decrease in the demand, as you can see from volumes having gone down. So that's a bad combination for the price of liquidity, right? Which is the price that HFTs kind of get paid. Now, episodically, when you have a panic in the market, the price of liquidity can temporarily shoot up. So this kind of accounts for that on average, right? So for example, the flash crash, which happened in 2010, that was still a less profitable year for HFTs than 2009. And 09 was less profitable than 08 and so on. So it's been a pretty much one-way street. And to be clear, there are some interesting public pieces of information out there. If you look at the financials that GetGo, which was one of the biggest couple of HFTs in the world, they had to make their financials public when they acquired Knight Group, which was another of the biggest HFTs. Both of these are large market-making houses. And so when Knight sort of blew up in the last couple of years, and then GetGo came in and bought them to form what's now KCG, they made their financials public, and I don't remember the figures offhand now, but there was something like a 90% decline in their profitability over the course of a few years.
Right, that's pretty huge.
Yeah, and so it makes one of the things that was particularly annoying, and I mean that in the sense of like a fly is annoying about the Michael Lewis book, was its timing. It was sort of like, 4 years ago, this book might have been interesting, but today you're looking at this hyper efficient market where you basically don't get paid to provide liquidity anymore, or you do, but it's very hard to do it anymore. And there's been a lot of consolidation of businesses, a lot of guys going out of business, et cetera. No one's crying over that. I'm just saying that the timing was a bit funny.
Yeah, and that's one of the things that you've spoken about a little bit in the past was Michael Lewis's book, Flash Boys. You disagreed with many of the claims that were made inside that book. Could you share an example of what you thought lacked evidence?
Almost everything. The idea that HFTs are front-running, as an example, is on the whole completely idiotic. And even the people he cites as having the expertise making that claim, IEX, don't make that claim, have severely backpedaled from that claim in the year or so since the book came out, and have actually got HFTs on their exchange / dark pool. It's a completely ludicrous claim. It's a bit technical to get into exactly how, but not that technical. If you think about why he says it because an HFT can pay the exchanges an extremely expensive cost on the order of a couple $100,000 per year to get access to direct feeds that show how those order books on the different U.S. equity exchanges are evolving in real time. Someone who wants to not pay that couple $100,000 a year can, for something like $1,000 or $2,000 a year, get what are called real-time feeds. And this is really the national best bid offer. So it's a consolidated market across all of the books, all of the order books at all of the different exchanges. And it just gives you the best bid and offer in the last trade. The relatively poor architecture of that national best bid offer feed, that real-time feed that costs only a couple grand per year for a professional investor. And to be clear, many retail investors, like if you go on Yahoo Finance or Google Finance, you can get the real-time price for free. So a professional investor pays $2,000, a retail investor gets this for free. That thing is delayed by about 1 millisecond versus what you could do if you went direct to all of the exchanges, processed it as fast as possible. You'd be 1 millisecond faster than the national best bid offer. Now, to Michael Lewis, this means that you're front running because when an order happens on exchange A, the $2,000 feed doesn't see that for 1 millisecond. The person who takes the feed at exchange A sees it right away. Okay? The problem with this being called front running, besides it just being stupid, is that it's like saying that I read the newspaper before you this morning and therefore I knew what happened. I know what's going to happen today. The newspaper tells me what already happened. So the fact that I'm making a real point about finding out what already happened faster is like totally different from front running. And by the way, the reason that I have to do that as a market maker is what I referred to earlier about the perniciousness of leaving stale orders out there in the bid offer book. And so a stale limit order is just an invitation to get fucked. We at TradeWorks did a pretty interesting study on this, and there's a pretty huge cost to being slow. It's something like a penny per share over something like a 2-minute period Actually, I have it in front of me now. It's 1.7 cents per share difference between being first in the order book and last in the order book. And bear in mind, that's more than 10 times, like 17 times, the expected profitability of a good HFT. And that's not a good way to make a living, right? So it makes sense that you want to be fast, because if you find out you've placed your order and you're not near the top of the queue at that price, and then you get hit, you're almost certainly going to lose money on that trade. And if you do this over and over, you'll be out of business in no time, and you'll have paid hundreds of thousands into the millions of dollars in infrastructure for that. So this is why these guys have to be fast. It's nothing to do with front running. The irony is the only kind of HFT that could front run is the contractual market maker. And to my knowledge, not one contractual market maker has ever been sued, not even in all of the noise after the Flash Boys book, for misusing their clients' information to front run them.
Okay, so I mean, Haim Bodek was on the other week for episode 49, and he, from what I understood about his story, was that certain HFT firms were using special order types that did allow them to jump queues. I mean, I understand those order types might have been called hide not slide orders, which have now been taken away. Was that the case, like in your opinion, was it the case that when HFTs were using those order types, they were able to jump queues, and they're now not able to do that? What's your take on that?
It's not exactly the case that it was queue jumping. And it gets really technical. Like a discussion between me and Haim on this would go over just about everybody's head who isn't like a hardcore practitioner. And by the way, it would be a discussion, not a fight. We agree entirely, by the way, he and I, that hide not slide orders and all of these, there are many exotic order types, are pretty much a direct result of certain inefficient aspects of market structure, like a slow national best bid offer, like a totally arbitrary ban on locked markets, which is saying that you can't have the best bid and best offer both exist at the same price without them interacting. So if the best bid is $100, 100.00, the best offer can also be 100.00. Those two orders would have to interact and both players would have to trade. So the minimum bid offer spread is a penny. Well, that's pretty arbitrary, because if we like a penny spread, wouldn't we like a 0-cent spread even better? And because of the way that the NBBO is, the National Best Bid Offer, is created using this outdated piece of technology called the SIP, which just stands for Securities Information Processor. You have to find workarounds for the situation where you haven't locked a market, but the SIP thinks you've locked a market. And so most of the funky order types are a direct result of working around this flaw in the structure. That being said, the term queue jumping is a little loaded, I think. What it means to jump a queue is there was a line there, I show up later, and I hop to the front of that line. That isn't actually what happens. What happens is my order is there, it's hidden, and then when it gets to a certain price, it lights up and is first in line. But the order was there, right? So it's not the case that someone got to put the order in later. There is a timestamp, and time priority is given. It gets into some technicalities. I understand why Haim doesn't like them. I don't like them either. But I don't view this as being some big problem.
Right, okay. Yeah, and I mean, this is sort of starting to get over my head a little bit. But no, I really appreciate you trying to explain that, and I think you've done a really good job of that. Just to summarize for us, is there anything about high-frequency trading that you believe, in your opinion, is unethical, or are you totally for it?
Well, I don't mean to be a pain. I just don't think it's a well-defined question, and so what I mean is that there are aspects of market structure that I think need improvement. And by improving those, a lot of the bad behavior that exists would go away. There are bad players, right? There are people and shops who contract with data vendors to lock out other players from getting data faster so that they can have first mover advantage on certain data types. There are players who make orders without any intent of getting those orders filled. It's called spoofing. And they're just placing these orders rapidly and canceling them to try to make other people make mistakes. This stuff does happen. It's just the vast minority of the time that's what's going on. Even in specific instances where the regulators have, and they now have the technology to do this, have looked at instances that look like bad behavior. They go in and find out there's no bad behavior. There are just some inefficiencies in the system. So, I mean, I can give you a few sort of things that I've talked about as being areas for improvement. One is getting rid of the ban on locked markets. It's something I just referred to. The second is make the SIP as fast as getting direct feeds. And by the way, that's entirely possible. You would just have to do what HFTs do when they do this. They get all the direct feeds. They process them well. If we had a central order book that did that, we wouldn't need to do that on the HFT side. And then there wouldn't be any advantage to having the direct feeds. Get rid of payment for order flow. Get rid of off-exchange transactions for exchange-traded instruments. This is something that's, again, a little technical, but there are things like wholesalers, these contractual market makers, and dark pools, which got lots of press. One of the really funniest ironies about the Michael Lewis book is he touts how two-tiered and clubby the markets are because HFTs have this great advantage, and poor institutional investors with their billions and billions of dollars and hundreds of employees are like the second tier. The irony is that institutions interact largely on dark pools, like the one run by IEX, who are the heroes of the Lewis book. IEX is a dark pool, which means it's an invitation-only club, effectively, for doing transactions in exchange-traded securities that will never hit the tape on the exchange. So they do the public no good. They give off no information. They can have rules that are not actually that fair, and so on. Like to me, if you have an exchange, the purpose of the exchange is that's where transactions are done for those kinds of instruments. We don't have dark pools and futures. We don't have dark pools and lots of other kinds of exchange traded instruments. We just have them for U.S. equities. And this has been something which is really a response to special interests, large institutional investors, in this case being the special interests, who've clamored for this kind of market structure. It's been this kind of two-tiered structure for decades. It used to be called the upstairs market. Now it's dark pools, same thing. It's a computerized version of the upstairs market. So I'd get rid of all that stuff. At least I'd seriously take a look at it. Flatten rebates for liquidity provision. They're currently tiered. And finally, vigorously prosecute insider deals where a data vendor is giving special access or an exchange is giving special access to data or technology to one kind of player than another. On the whole, though, Aaron, I would say that it is absolutely to fly in the face of all of the evidence to say anything other than the following, at least about the major US markets and the major European markets and other modern markets out there. We have easily the most egalitarian, fair markets we've ever had in our history. So to bring it all the way back to the beginning, you asked me how I got involved in the space, and I pointed out that I was picking stocks by reading the newspaper the next day. The guys who were trading on Wall Street had quote machines in front of them that told them prices in near real time. That was a big advantage over my dad and me making stock picks. The advantage that the most fancily outfitted HFT has in speed, just in plain speed, over the average mom and pop investor today is measured in milliseconds. Liquidity is cheaper than it's ever been. It's abundant. The kind of bad practices of manipulation and so on still go on, but they're less and less every year. We have like much bigger problems as a society than HFT and fixing market structure. Like I'm all for rounding out the corners, the rough edges on the inefficiencies, but to be clear, all of this, like, if you want to talk stock market problems, I think short-term incentivization of CEOs to manage earnings in the near term without really worrying about the long-term consequences on their shareholders, on the planet, et cetera, of their actions. These are really big issues in capital markets regulation, not sort of some ticky-tack nonsense, and it is mostly nonsense, about how HFTs aren't fair because they have to invest millions of dollars a year in infrastructure for the privilege of, maybe if they're good at it, making a tenth of a penny per share.
Yeah. All right, Rishi. Well, this has been a fascinating conversation. Thank you very much for coming on. Let's leave it at this. I mean, I know we've gone a little bit over time here, but I really appreciate you, making the time to do this. It's been a lot of fun speaking with you. Where can listeners go to find out more about you?
Well, as hedge funds, I'm not really allowed to advertise anywhere. I do have a Twitter, but I don't tweet very much. And I don't really write anything that's allowed to be consumed by the public. So sadly, maybe it's not sad. There's not that much fun to learn more about me anyway.
Well, I'd definitely encourage listeners to check out your book, Inside the Black Box, if they'd like to find out more about, quantitative trading and, algorithmic trading, that type of thing. Awesome book. I'm halfway through it, like I mentioned at the beginning. And also Inside the Black Box, the documentary by VPro, is also a really good one to check out. That was a really well put together documentary. So I'll link to both of those in the show notes at chatwithtraders.com. And, if listeners want to find out more, all the links will be there all in one place. All right, Rishi, will you enjoy your evening, and let's speak again soon.
Thanks, Aaron. Hope so.
You've come to the end of this episode of Chat with Traders, but don't worry, more great episodes are on the way. To stay updated with each great new episode, be sure to subscribe to the podcast in iTunes, and we'd love it if you leave us a rating and review. We'll see you next time on Chat with Traders.
What would your trading look like if capital wasn't the constraint? That's the reality for most traders. It's not skill holding them back, it's size. Trade the Pool changes that. Step into the U.S. equity markets with up to $200,000 in buying power without committing your own capital. Full access to stocks and ETFs, long or short, executed with the precision and freedom serious traders expect. Your performance is measured by one standard: disciplined risk management and consistent execution. Meet that standard and you operate at scale. No subscriptions, no ongoing obligations, just a clear path forward. For those ready to trade beyond limitations, this is the next level.
The biggest secret of the best traders in the world is that they're just like everyone else. However, they've worked hard to learn the markets and discover what works and what doesn't. But how can you hear about these journeys and get in on the strategies and tactics they use? You can do it by listening to Chat with Traders. Here's your host, Aaron Fifield.
What's up, guys? Welcome to episode 55, and thank you very much for tuning in. I'm your host, Aaron Fifield, and this week on the podcast, I interview Nathan Michaud of Investors Underground. Nate has been a day trader since 2003, and the stories from his first few years in the game are enough to make your head spin. After experiencing major highs and lows, both financially and psychologically, which is all covered during the interview, he's gone from strength to strength playing small cap momentum stocks. Over the next 60 minutes, you'll learn about Nate's approach to fast-moving stocks, the additional risks linked with short selling, a smart way to scale up, the power of compounding, and heaps more. Full show notes can be found at chatwithtraders.com/55, and for educational material and ongoing support from the Investors Underground community, go to chatwithtraders.com/IU for a discounted rate. All right, team, enjoy the interview. You're listening to the Chat with Traders podcast, and here is my guest, Nathan Michaud. All right, Nate, so great to be speaking with you. Thanks a lot for coming on the podcast. How's it going?
Great. How are you doing?
I'm doing really well. And Nate, we've had so many requests from traders listening who wanted to hear an interview with you. So I'm glad we could make this happen. And from what I hear, the last few weeks have been pretty chaotic for you. What's been going on?
They have. I mean, we've been, ever since we did the Vegas event for Traders for a Cause, we came right back and then we get right into the swing of things. And we just did the first annual gala at Tuscan Kitchen in my hometown area. And we did that with about 200 guests. We raised about $20,000. We presented a check to Honor Flight of New England for $45,000. And it turned out to be a really great success. But now can finally relax a little bit, and that's kind of why we're doing an interview right now.
Awesome. That's great, man. And Michelle Koenig, who I know is a good friend of yours, had plenty of great things to say about Traders for a Cause. She was on the podcast a few weeks back for episode 44, so that was a lot of fun. I'm sure we'll speak more about this later in the interview anyway, but let's get started. So Nathan, how did you get started trading? Tell us, where did everything kick off for you, and what year was this?
This was back my freshman year of college, and it was really about, at first I wanted to be potentially a broker. I had seen my uncle, who was very successful, lived a pretty good life, and I was very interested in that, and everything that I knew came from him. It's, okay, stocks is where you need to be, so that must mean I need to be a broker. So I started to focus towards the broker side of things. Is that something I want to do? And I started to get this interest for stocks, and it was really just trial and error my freshman year back in 2003. And I went out one night, came back, woke up late. A stock had earnings that I had bought, had no idea. I was up a couple $100 and literally been addicted since that day.
Sure. Okay. So you mentioned right there that your uncle had kind of inspired you in the early days. Because he was also a stock trader. Did he help you out in any way?
He was more of an investor. So, I knew that he had done well in the stock market in general and not necessarily as a day trader. He actually now is more active than he ever was, trying to just make a couple bucks each day, just having fun in his sort of semi-retirement. But it was more of here's what's possible, and there is something more than just that 9 to 5 or working for somebody or doing something else for somebody else's dream, and with more of that entrepreneurial type spirit.
Right. Okay. And when you first got started, what was it that would give you reason to buy or sell any particular stock? Like, what sort of things were you looking for in the early stages?
If you go way back to 2003, 2004, I mean, it was so much different than it is now. I mean, it was all about the story, and stocks would literally run. And keep in mind, I was trading OTCs back then. So you're talking about stocks that were 001, 005, and they would literally run to 20 cents, 50 cents. And they would just keep on going and going and going. But the only problem is sure, I had a couple grand, I put it in, I'd be up 10 grand. But I'd also keep on adding all the way down and down and down. I'd ride it all the way up, ride it all the way down, and I would not stop adding. So it was a lot easier back then to make, but unless you knew how to actually sell, then you weren't making any money. And that was sort of my case at first.
Okay, yeah, and I'm actually really keen to ask you more about that too. But just before we do, were you juggling a full-time job as well as trading intraday at the same time? And the reason I ask is because I know this is a difficulty for many people. I'm interested to hear how you were able to pull it off.
I would say the hardest part about what I did was kind of maintaining grades, I guess. I didn't have a job at the time. It was freshman year, sophomore year, and throughout college, but it was more of a in-between classes type of gig for me. And the only job that I did maintain through college is I was working for a friend's software company, just answering support. So it wasn't something that I needed to report to. It wasn't something that I need to leave to go to. It was something that I was on my computer anyway, so I could keep an eye on stocks at the same time.
Right. Okay. Yeah, I guess that makes sense. And Your situation in some ways is kind of unique because you were still in college and you had a job which you could do at the computer. Do you have any pointers for how others can better position themselves to juggle day trading while holding down a full-time job, say a typical 9 to 5?
It's really, you have to not put yourself into volatile positions that you're going to need to monitor every single second. I see so many people that come in and they're like, yes, I nailed this, I nailed this, I nailed that. And then they get involved in some type of big momentum stock that's running 100%. They either decide to long it and it drops 50%, or they short it and it keeps on going. But it all happens when they're not watching it, because they go back to work, they shut off their phone, they don't have internet. And that's where I see the people's biggest flaws are, because they always want to be in the market and you just can't. So if you're a part-time trader, that's what you need to be. You need to have stops in place, you need to have a plan in place, and you can't try to merge the two.
Okay. And while we're still focusing on the early stages of your journey, I have to ask you about your infamous motorcycle story. I know anyone who has watched your DVDs or read your chapter in Momo Traders is probably well familiar with this, but I think it's a great example of the roller coaster ride you experienced in the beginning.
Yeah, well, it was very easy back then, as far as all you had to really do is, in order to find big gains and whatnot, is we used to search filings just like people do nowadays, where you see people alert to a 13th D filing or some type of raise or whatever. They're very, very quick on Twitter. We used to do the same thing and just scanning, just like they do today, only for certain words, certain LLC names, certain things that appeared in every single promotion. And so what we would do is just search for those. As soon as you see that, all you need to do is watch for volume. When you start to see volume, you just jump in, you get long, and things would just go straight up. So you get used to this, just buy and hold, and when things start to speed up and break out, that's when you sell. So there was no real reason to watch every single tick. Now, if you take a step back and you realize I'm here buying 25,000 shares, 50,000 shares of a $1 or $2 type stock, and then scaling up along the way, well, the whole motorcycle story, I had 100,000 shares of a stock that was around $3. And here I'm at 19 or 20 at the time. And the fact that stocks are going up 10, 20, 30 cents on a day, pull back, and I didn't have to worry about anything because it wasn't speeding up yet. It was just going to keep on going, and now, look, I'll sell at 5 or 6 wherever it starts to really break out. Well, I got a call. It was May 5th, Cinco de Mayo, and they said, listen, we're having an event today, and if you don't move your motorcycle, we're going to tow it. So here I am. I'm looking at my monitor, and it's actually down 10 cents on the day, this RRPH, and no big deal because I hadn't sped up yet. I know what to do. Just hold it. There's no reason to sell. So I go out, move the motorcycle, coming back. I'm checking. This is back Palm Pilot days. I'm checking level 2 from Alpha Trade, and I'm looking at it. I'm like, no way. No, this is wrong. No, hold on. And I keep going back, and it's down 50%. It's down to $1.50. I'm like, you got to be kidding me. So the whole moral of the motorcycle story is just let them tow it. And that's pretty much what I learned that day. Is anytime it just shows you how far disconnected I got from reality, where I'm in this stock that's going up each and every single day, and I don't even care that it's down a couple 10, 20 cents. I don't even care to watch it. I don't have any real plan in place. And then when shit hits the fan, look what happens.
Right. So I'm not sure if you mentioned it there, but I believe you lost about $90,000 that day. And being only 19 or 20 years old, how did you deal with this loss? And I know now you've had losses far greater, but at the time, was it almost like hard to accept? Like it almost wasn't real?
Yeah, it was pretty much not real. To be completely honest, so I was down 150. And then it rebounded, and I actually top-ticked the exit. I sold everything at the very top, so I was able to minimize to 90,000. Otherwise, it would have been about $1.50. but probably about 10 minutes after I sold, my girlfriend at the time, which is now my wife, Laura, came to the to my dorm room, and she's like, "Hey, how's it going? You ready to go to go to lunch?" I'm like, "Yep, let's go. Yeah, I'm ready." She's like, "How's your day?" I'm like, "Yep, it's good." And it just did not hit me, and I just played it off as like, "Yep, no, I didn't just lose 90,000, the biggest loss ever." And so that was really my day, and it really didn't hit until after, like, at night, and you're looking at your account, and you're just like, "Oh, this sucks."
Yeah, I can imagine. And how did she react once she found out?
Oh, she found out about 9 years later. So, I said this in the Momo Traders, the book that we just put out. But the thing about my trading and I guess my life and stuff is I don't really talk about it with anybody except my trading buddies. And the same thing is, with Laura and whatnot. So really, until we were ready to build our house, and she started to kind of panic, like, "Listen, I can't do this," did really the stories come out, and she understand that actually I did make a decent amount of money in the market.
Right, okay. I imagine that would have been quite a shock. So you talked about how you were writing like these OTC promotions. Do you believe the same opportunities still exist in OTC markets today?
Absolutely not. The problem is now you have to. There's that fear that it could halt. There was a period of time where they would just halt everything. Every other week there was another halt of a certain promotion, and it's not necessarily a bad thing because look. There's other people on the other sides of the transactions, which you have to understand. For us as traders, we're like, this is awesome. It's going higher, it's going higher, it's going higher, and then it's going to be a great shorting opportunity. But yeah, you do have to understand that great shorting opportunity is at the expense of all these other people that were duped into buying. So overall, it's a good thing, and I think it's really heated up the small caps and the NASDAQs, which we've been able to take advantage of. But it is so different now than it was back then, where you just have stocks that were going straight up to now we're lucky to have I could probably name 2 stocks in the last 2 or 3 weeks that have actually been noteworthy on the OTC exchange.
Okay, and I've got to ask you, just on a bit of a side note, at some point you used your background in web design. I believe that you were doing websites before you even got into trading. You used that knowledge to start a site which was actually promoting some of these penny stocks, and I know that didn't end so well. Can you tell us a little bit about how you got into this and what happened?
Sure. So, just like you said, I had websites and I was very keen on making websites, and I also had a very big following. I was on Investors Hub, I was on Yahoo, I was on a bunch of other online mediums, and I had a following of some sort. And just like RRPH, where I was talking about, where I had lost a ton of money. Well, that started to have like a little ripple effect. And, I tried to make that RRPH money, that $90,000 that I had lost. And then that turns into another 50 and then another 100 and so on and so forth. So long story short, I depleted probably about half of what I had made, which is damn near a $500,000. And I was in a position where I was like, how am I going to make this back? And so I was approached by somebody on iHub who knew that I had a following. And you don't really realize at the time, at 21 years old, whatever it was, the responsibility that comes with a following. So I was like, you know what? Why not? I know how to make a website. I have a following. I can promote stocks. There's nothing wrong with that. But the problem that I ran into is that I started to trade the stocks that I was actually promoting. And you can't do that. And so anyway, long story short, severed ties with this particular kid. And, I knew that I was going down the wrong path. Severed ties. 2 years later, I get a knock on the door, and it's the SEC. So wasn't a good time, probably my lowest. And I literally went to zero. I had a complete restart and bounced off those lows. But I ended up having to pay a fine because, just like I said, you can't trade the names that you promote. And there's a fine line between that. You can promote, but you can't trade them. And that was that. Moved on, never looked back.
Right, yeah. I mean, that must have taken like quite a blow, both financially and psychologically.
I mean, I was literally looking to have maybe a party like, hey, I just hit $1 million. And then the next week I'm like, whoa. And, I actually borrowed $500 from a friend of mine in Boston the last month that I was there when everything went down. And that was rock bottom. And it wasn't until about a year and a half later that I was, actually about a year later, that I was doing taxes at the end of the year. And I looked and I had this tax form and this interest that was adding up. And I'm like, what the heck is this? And this is back when it was like 5% interest. And so I'm looking, and I forgot about one of my accounts because I had about 10 accounts at the time. And so that was the rebound. I found about $25,000 in an account, and that was sort of where I rebuilt off of zero.
Okay. And you said right there that you borrowed $500 from a friend. What did you borrow that money for?
Rent. My last month's rent.
Okay. And did you ever consider that maybe trading wasn't what you wanted to continue doing at that point?
Oh, absolutely. That there was about that maybe 2 or 3 month span where I was looking up different job opportunities, internships, things like that to kind of get involved in the financial realm. But it's just once you've seen the other side, it's very hard to go back. And so many people are fine with the cubicle life. So many people are fine with the 9 to 5s, and they just go, they're happy, they get a paycheck, they're good to go. But once you've seen the other side, you're not going to settle for that. And that's really the problem that I had is nothing was ever going to be good enough. So you needed to go and figure it out, hustle, find out a way to make it work, and I did.
Right, yeah. I really like how you explained that as in the other side. I think that's a really good way to describe it. Just before we move into more about how you trade these days, to summarize for us, what were the major difficulties you experienced with your own trading over those first, let's say 5 years?
So the biggest difficulty that you're going to face is just trying to find that consistency, but also not being influenced by other people and not being... it's good to be inspired and seeing other people's gains and things like that, but the key is really just focusing on yourself, and then slowly but surely you're going to mold into the trader that you need to be. And the problem is, especially in my first few years, is you want to be that guy that you just saw make $100,000. You want to be the guy that makes $1 million a year, but you don't really understand what comes along with that. So really the first couple of years is about identifying what works for you. Are you better at just going long? Are you better shorter? Or are you not a good day trader, but you're actually a good swing trader? Are you better at options? And what is it that you're good at? My strategy is not going to be good for everybody. Swing trading is not going to be good for everybody. But there is a way that you can mold all these different strategies together to develop who you are as a trader in general. And I think the key, and I'm still learning today, I'm still changing today, but the key is really to never stop learning and to always learn from others. And every single day I look to see what I could have done better. And it's not necessarily the losses that really upset me. It's really I should have stopped out at this price. I knew it, I thought about it, but I still didn't do it for whatever reason. So any stubbornness and things like that really sticks with me. But first 5 years, really the first year, do you get it? Do you understand it? And if you do, you're going to still be around in the second year. And then the second year, okay, do you make money at it? Okay, well, where do you make money at it? Third year, take those things where you make money at it and focus on just that. Be the best person you can at those areas, and then start to focus on other areas. But the key is really giving yourself the best chance, which a lot of people don't understand. And that best chance means putting away enough cash so that you don't need to make on a daily basis, so that you can just trade what you see, and if there's nothing there, there's nothing there. Wait for the next day.
For sure. That's a really great answer. Now, I'd like to speak more about or hear more about how you trade today. So imagine myself and everyone listening has no idea how you trade. We don't know what markets you trade and what time frames you're working with. How would you describe your trading approach?
My trading approach is pretty much focused on momentum. All I care about is stocks that have range, meaning something that might be $2 or $3, but it's trading up 20 or 30% today. It's up 30, there's 50 to $1 on the day. Something that has an abnormal range and an abnormal volume. And so that's the first thing that I look for. Each night we scan for stocks that are overextended, meaning stocks that have ran continuously for multiple days but have yet to have a real pullback. So dealing with that, you're dealing with momentum stocks that are breaking out, and I'm primarily a short seller. So I'm looking for those stocks that have really overextended, really broken out, but have yet to pull back. I'm looking to take advantage and join the downside when people first think about taking profits. So something that's going up, 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 there's no reason for people to sell. But that first point where it starts to crack, that's when everybody starts to take their profits. And if you think about it, it's usually a very, very quick snap. And it goes all the way back to college when I used to trade in between classes. And that's all I'm looking for. I'm looking for that 5 to 20 minute type of trade that you can anticipate, capture it, the next trade.
Okay, so on a typical day, how many trades are you managing, just to give us a bit more of an idea about your style?
For me, less is really more, is what I've found out. But given how the market has been in the last 6 to really the past year, it's very hard to minimize the opportunities. There's just so many. So for me, my ideal day is only about 3 to 5 names, but there are days that I'll be up there with 10 to 12 different names that I've traded, even more sometimes. But really the focus is taking everything that you've prepared for the night before, stocks that are on scan. Okay, what's working? What in the morning you wake up, you see it, okay, it's doing exactly what you thought. Minimize that list of 12 stocks down to 3. Add a couple from the morning moves, like news that has come out or whatever, but focus on those 5, 6 names, and then it's all about minimizing what you're watching, minimizing the opportunities, and then maximizing out of those opportunities. So really, a typical day for me is probably 6 to 8 names overall on average, I would say.
Okay, and then generally speaking, do those opportunities come for you mostly within the first couple of hours of the day, or are you watching pretty intensively throughout like the entire day?
So I recently downloaded a trading journal program, and it actually told me that I make all of my money between 8 a.m. and 11 a.m. I lose money between 11 a.m. and noon. I make a little bit between 3 and 4 p.m. So to answer you, most of my money is made from a little bit pre-market right up until 11 a.m.
Right, okay, that's really interesting. And I'd just like to pick up on something you said a couple answers ago about how you naturally gravitate to the short side. What is it that attracts you to having a preference of shorting stocks rather than going long? And has this ever caused you any grief by like kind of enforcing like a bias onto the market?
I just feel more comfortable on the short side. I find that I can find tops better. I find that I'm more comfortable on the short side. And trading is all about being confident and comfortable. And if you're not confident and comfortable in the trade, then you're going to be clicking all kinds of buttons. You're going to be out before the trade even happens. So I do actually, I've longed more this year than I probably ever have in the past. But I always tend to gravitate towards that short side. And it's just because that's where I feel confident with it. And it's not necessarily a bias, because one thing I try never to do is get too biased. And in fact, when people are short in the room or Twitter or wherever I'm looking, and people are, very, very biased, a lot of times I'll end up closing my position just because I get, it kind of drives me away from the trade. I always try to just trade what I see without any major bias. I have a plan, I have a stop in mind, and that's that. Never, it's short, it has to go down. It doesn't make sense to be up here, because I find that most of the people that lose a lot of money form such strong biases. This company's a piece of junk, they just raised, they have to raise more money in order for this whatever pharmaceutical drug to go through, and all this kind of stuff that reaffirms that short is the right trade, but yet it continues to go up, and then they end up getting smoked. So I always try to have a very small bias and just really stick to a general plan.
Right, okay. Yeah, no, that's well said.
Ever watch a stock rip and think, I could have nailed that if I had real capital? The truth is, many capable traders never reach their potential, not due to lack of skill, but lack of scale. Trade the Pool was built to solve exactly that. A firm designed for serious individuals who want access to the U.S. equity markets with meaningful buying power, up to $200,000 without committing their own capital. Get access to virtually every stock and ETF. Go long or short freely with the flexibility professional traders expect. You're evaluated on one thing: your ability to manage risk and execute with consistency. Meet the standard, and you trade at scale. No subscriptions, no ongoing commitments. Whether you're still refining your strategy, a trader with experience who hasn't yet broken through, or a seasoned professional simply looking for more capital, Trade the Pool is built to meet you where you are and take you that next step further. The markets have evolved, access has evolved, now so has the way traders operate within them. Trade the Pool.
You also mentioned there Twitter. How do you use Twitter? Do you find that this gives you any small advantage in your trading?
Twitter's the best. It's an instant Google. Google does, obviously you can't type in Google and see what you can see on Twitter. So, there's no better place than to type in a ticker. Why did it just move? Boom, type it in. Okay. There was an upgrade, and there's a lot of great people that have great alerts, and you really need to set up your Twitter to work for you. So, all right, does this person typically move the market on stocks? Take, for example, hit piece writers. Well, you might as well be watching those, because as soon as they alert something, you're going to have a trade. Same thing with other people that might follow bio stocks, pharmaceuticals, decisions, things like that. You want to be watching those because they're going to have it instantly. There's no better place on the internet to get instant information. And the only other thing that I like to use Twitter for is, what is the general sense on the name? Is everybody short and it keeps on going up? And if that's the case, then you know that it's likely a crowded short. And the only thing that's going to happen on a crowded short is when it starts to go, it starts to squeeze, it's going to break out hard. And the same thing with a long. If everybody's trying to defend a stock, hey, this shouldn't be going down. The news was actually good. It keeps on going down, down, down. Well, to me, that means I need to wait for a big washout. I need to wait for all these people that are perma bulls to go ahead and just bail, and then there's going to be an opportunity.
Okay, so this is probably a good point for me to ask you about the type of markets that you trade. Correct me if I'm wrong, but I understand that you like to trade a lot of thinly traded, low float or low cap stocks. What is it that really attracts you to these over your higher priced blue chips?
Small cap stocks, not thinly traded stocks. You won't see me trade very many thinly traded stocks unless it's something that has ran up like $2 to $15 or something like that. But for me, it's all about volume. I hate thinly traded names. I hate seeing people trade stuff with 50,000 to 100,000 volume, and you buy it, you sit there and watch the volume. It's not real trading. What I like to do is trade stuff that's got a couple million, 10 million, 20 million, 50 million shares traded, and even stuff like SUNE today that had 100 million shares. Things that are trading volume that is abnormal to what it typically does. And then with that, with the range comes an edge.
Okay, and are there any precautions that you might have for less experienced traders when interacting with these low cap stocks, that do put in these big ranges?
Absolutely. I mean, the biggest thing is recently, in the past maybe year, the ease of borrows has become a lot better for people. People have the ability to borrow names that they typically wouldn't, and they don't really understand what shorting a stock it really is and how much you can actually lose. They look at a stock and they have this like preconceived notion that, hey, a stock is up 30%, it has to go down. But most of the time, especially in this market, these 30, 40% runners end up running 100 or 120%. And the biggest thing is with a long, the most you can lose is 100%. And then with a short, the amount that you can lose is unlimited. So they don't really understand what they're about to get into. And just because a stock is easy to borrow does not mean that it's a good short. So that's really the biggest thing for new traders to understand is, one, short selling is not that easy. And number two, when you're dealing with a stock with huge range, you need to really be careful about the position size that you're trading, because it's not like a typical Microsoft type stock where you go long, it moves 7 cents, and if you're wrong, you get out for 7 cents loss. These things move 70 cents or $7. Just for example, go back a week and a half, ATV ran from $2 to $4 to $6, all the way up to almost $22 a share, all in one afternoon. Think about being on the opposite side of that. It's not a good deal.
No, definitely isn't. So Nate, can you share with us one of your favorite setups that you like to trade, or a particular event that you like to trade around?
Absolutely. So there's, I guess, a long side and a short side is probably the best. So for the long side, I call it ABCD. And basically, I'm looking for a pullback. Basically, a stock that's ran up, it's pulled back, it's put in a higher base. And once it starts to grind up off that base, I'm going to start to buy the dips with a risk based off the prior lows. And that way, it gives me an opportunity to have a set risk versus a potential reward of going back up towards the highs and potentially breaking out. Because what I look for typically is something risking 1 and make 3 to 1 type of reward to risk ratio. And on the short side, besides like parabolics, which I really haven't traded too much of recently, it's more of the failed follow through momentum. And so you come to the market, there's a stock that's moved quite a bit, and it had pulled back the day prior. That next morning, I wanted to retest whatever resistance it had the prior day. And if it starts to fail, I'm going to go ahead and short based off that resistance, and then look for that failed follow through momentum, and it ends up fading off and washing out.
Okay, awesome. Thanks a lot for sharing that with us. Before the market opens, how are you preparing for the day, either pre-market or the night before? You've kind of touched on this, but I'd really like to dig into this a little bit deeper. So yeah, share with us how you're preparing for each trading session.
So each night I do a scan. So I'm looking for stocks that are actively breaking out, but not just one day. I'm looking for stocks that are up each day for 3, 4, 5, even 10 consecutive days, but have yet to pull back. And the reason for that is because, like I said earlier, that first moment that people see a reason to take profits, that's when things are going to start to pull back. And that's exactly where I look to take advantage of that move. So I'm looking for stocks like that. I'm also looking for stocks that have been extremely beat, things that have been pulling down. For example, this week, a stock that was 24 went down to 22, 18, 17, 16. It hit 14 this morning, and it rebounded all the way up to 17. I'm looking for a reactive trade out of the open, buy the washout for the reversal. all based off emotion. Everything that I do is essentially based off of emotions. Reacting to where people might be panicking on the short side and they start to cover, I want to be shorting. Reacting to people where they're on the long side and they're bailing, I want to be buying in that act of panic. So that's really what I'm preparing for at night. And then in the morning, really the key is to just come to your computer kind of early, 7 a.m., 7:30 a.m., get a feel for, okay, what else is moving? So you've got your scan of 10 to 12 stocks, all right? 3 of them are doing exactly what you thought. Those are your main watches. They've got some volume. Good. What else is moving? Okay, 3, 4 other good ones. Minimize it to 2. Now you have your main watch list of 5 or 6 names out of the gate. Usually I try to get my first 2. I have 4 different screens, but I put on my center screen the 2 that I'm most likely to trade that are the reactive style setup, something that is going to cause me to have to react. So if it spikes out of the gate, I know that that's something that I wanted to short. If it washes out of the gate, I know that that's something that I wanted to long. So those are those center watches for me. Everything else is a secondary watch. And after that, I sort of focus, I wait for trades to set up, I settle down, I'm patient for entries.
Okay, so you said there that you're looking for stocks, usually the evening beforehand. How are you looking for those stocks? Are you running scans or are you visually sort of flicking through charts?
I run scans every single night, and for both the breakouts and things that are pretty much breaking down. And then I go back through my scans from prior nights. Okay, so I was looking at this on Tuesday and it didn't break out yet, so I might put it back on scan. Then go back another week. All right, well, this one didn't break out this day, so it's still kind of consolidating. It looks like it actually might break out again. And then I pull it off that scan and put it on the new one. So it's an act of continually looking through, just like you said, flicking through charts. And there is no bad thing about flicking through too many charts, because whether you realize it or not, you're putting that visual idea in your head. So even if it's not a plan for the day at all, and then all of a sudden you see it on Twitter, you see it in the chat room, you see it, reacting, you already have a picture of that chart in your mind from the night before. So it's always good to stay familiar with as many charts as you can.
Okay, excellent. That's a great answer. And you also touched on the fact that you're trading emotion a lot of the time, and that's sort of what you're looking for. Do you factor in, or does the fundamentals and news/PR have any impact on your trading also?
It does to an extent, but not as you would think. I mean, one thing I always say is surround yourself with successful people, and it's bound to, rub off on you. And I surround myself with some great guys that are great fundamental traders, are great bio traders, pharmaceutical type traders. And so I can get the answers that I need. For example, a pharmaceutical had good news, but it's pulling back, or pharmaceutical had good news, but it's down 50% because one of their trials failed. But if you know through these different resources that, hey, they still have 3 other things in the pipeline, well, then it's a potential bounce play. But if it has nothing else in the pipeline, then I'm not going to trade it. So it's really about surrounding yourself with the resources that are going to be able to help you answer those questions. But for me, it's mostly being aware of fundamental events, what I need to be aware of. But it really comes down to just trading, just technical breakouts, breakdowns, and trading what I see.
Got it. Okay, cool. So I'd like to ask you about scaling up. This is a topic that you'd mentioned to me prior to the call that had presented a number of challenges for you this year. So share with us, what have you learned from scaling up? And in hindsight, what's the best way you could have approached this?
Scaling up this year was definitely something that I wanted to do. Many of you guys know Greg, LX21, on Twitter, but he had done an interview with Cam at one point, and he had mentioned that he didn't understand why I always wired out. And I thought about it for quite some time, and there was a reason why I always wired out, because I got sloppy. Every single time that I got into a couple $100,000 in my account, I'd start doing stupid things. I'd start to get lazy. I'd start to let losers run just because, you know what? Hey, it's not that much. It's compared to the entire account. And it just wasn't good. So I'd always wire out to re-ground myself and kind of get back into the swing of things and do it again, wire out, do it again, wire out. And it did strike a chord with me, not in a bad way, in a good way, kind of like a kick in the ass. Like, hey, why am I wiring out? Why don't I focus on scaling up, focus on actually having more money in the account, but doing the right thing? Because at some point you need to get past that. You know, if you're only going to keep a little bit of money in the account just because you don't have the ability to control yourself with more money, well, that's a problem. So I was doing really, really well January, February, March, April, and then mid-May, June, July, I absolutely got destroyed. And, you know, it was really, I was starting to scale up. I was trying to figure out how to make this work. And a lot of times when you start to scale up, you think, well, hey, you know what? Instead of 5K, I'm just going to buy 10K. Instead of 10K, I'm just going to buy 20K. But it's not like that. And the problem is, and a lot of people will find this out, I've had this conversation with a lot of people, hey, I'm going to scale up. Yeah, I'm just going to double everything I do. That's not the way to go about it. And I learned that the hard way because I hit a wall a couple times. Genie, G-E-N-E, was one of the first ones that I scaled up on. And I said, you know what? It's fine. I got 25,000 shares short overnight. I'll go ahead and hold it. Woke up to a $50,000 loss. And, you know, it was a battle of going back and forth with myself. Like, hey, is this $50,000 loss something that I need to freak out about and take? Or is it just part of me scaling up? And it was just continually going back and forth, back and forth. So what I've learned is it's not about just doubling your size. It's about scaling in. And you start in, and you'd be surprised about how small I actually start in on my first entries. It's no different than I normally ever would. But the secret is really just scaling in and adding to that winner, pretending that you're not in the stock yet. And I've done this a million times on webinars and explaining it. And the more you think about it, the more it makes sense. So rather than adding to that winner just to add it. So you got short, you got a good position, and so you're just going to start adding because you're up. Well, pretend that you're not up yet. Where would you pretend that you're not in the position yet? Where would you short? Would you short here? No. Okay, so wait for it to be at a position where you would actually short and then add, because that's going to take the emotions out of it and it's going to allow you to let that trade work. And I think that's been the biggest thing that has helped me. Because even on the long side, you get long on a particular name and okay, boom, you nail it. It goes up 20 cents, 30 cents. You're like, sweet, I'm up $2,000. Normally I would take it here, but hey, I'm scaling up. So instead of just drilling the offer and continuing to add, because you don't realize how fast being up $2,000, then you add, and all of a sudden it pulls back, you're back to flat. You don't realize how fast that can happen. So the key is, would you have chased that 30-cent move? Probably not. So pretend that you're not in yet, wait for the pullback, starts to consolidate, it looks like a long entry, then add. And that's been really the key to my success since July, August, September, October, November, like the last 6 months, I would say. And I've been fine-tuning that and realizing that it's not just doubling the size.
Okay, so two things. When you say wire out, like you did at the beginning of your response there, you're referring to taking profits out of your trading account?
Correct. I used to always just keep it under 100,000. Every time I rip through it, I take out 20, 30, 40, whatever it ended up being, and then wire back down just to keep myself from doing anything stupid.
Okay. And the other thing I'd like to ask in regards to your response there is, when would be a good time for other traders to consider scaling up? Like at what point should they be in their sort of trading career, so to say, would be a good point for them to consider scaling up?
I think it's most important to do it after you find some sort of consistency. The real reason why I scaled up is because I realized that I wasn't making the most out of my talent. I don't want to have regrets that I could have done something that somebody else did. I could have done that. I should have done that, and been upset that, hey, I just took the easy way out every single time and the safe way out. So the problem is, like you just said, new traders, I mean, everybody wants to turn $2,000 into $1 million tomorrow. And that's a real problem because that's not the way that it works. So the key is really about focusing, finding consistency, and then slowly scale up from there. If you try to scale up on day one, you're going to implode, you're going to blow up, and your trading career is going to be over.
Yeah, okay. Now that's great advice. And I'd like to dive into a little bit more advice for other traders now. So you have a very active community. While there's a number of outstanding traders in there, there is also many less experienced and newer traders. From what you've observed, what are common issues they run into?
I think that a lot of people they look at what people make, they look at what people do, and they're influenced rather than inspired. So I think the real key is to be inspired by what you see, but if you find it influencing what you do, if you find it influencing your trades, then you're going to run into issues. You need to remember where you came from. You need to remember where you're at. And one example that I always use is, people fixate on, I'll go back to Greg, for example, one time where he made $450,000 on a trade. And they look at that and they say, you know what, I want to be like him. But they skipped over the fact that the prior trade he lost $180,000 to get there. And so I always ask people, especially when they're trying to start out, scale up, or just kind of think in general, well, what's your goal? Well, I just want to make $1,000 a day. Okay, are you okay with losing $300 a day? Because I always look for that 3-to-1 sort of reward to risk ratio. So if people aren't okay with the downside, then their goals are misaligned. And I think it's most important for people to find out what they're good at and focus there. Don't try to do everything. One big problem that new traders have is they feel like they have to be in a trade at every single minute. And you just get out of stock and then somebody mentions something, they tweet something, whatever, some news comes out, all of a sudden they're back in a stock, they don't even have a plan on it. So the real key is just to be patient, let trades come to you, and doing less is more.
And that interview Cam did with Greg, LX21, is an awesome interview. I'll actually link to that in the show notes. So I definitely encourage anyone listening to this interview to also check that out. What do you think is one of the greatest misconceptions about traders? Maybe not even misconceptions amongst complete beginners, but misconceptions from those who have been in the game for a couple years who still lack consistency and are not yet profitable traders?
I think that just a general conversation for these people sometimes is the answer. I've talked to people that have been in the game, a year, 2 years, 3 years, and just having a conversation with the person. Listen, I do this, but I'm trading so well for a month, and then I just gave all my gains back on one day. And just having that one conversation, well, what can you get from that? You just gave your gains back from all in one day. Well, how much did you lose? Oh, I lost $10,000. I made $700 on average every single day for the month, and then I just lost $10,000. Okay, well, what would happen if you had a max loss set at $500 or $1,000? Would you have $9,000 more dollars today? Yes. Okay, well, that's one place to start. And a lot of times it's just really about having not necessarily a full community, but just having a trading buddy to bounce ideas off. And a lot of times you'll find that the answers are right there in a simple conversation.
Mm-hmm. So you find that a lot of people perhaps overcomplicate things?
Pretty much. I mean, it's people underestimate the power of taking losses. I mean, it's so easy to get stubborn. You don't want to be wrong. But if you actually have ever been on a hot streak, and even if it's a couple $100 a day, if you refresh that account, it's amazing how fast that adds up. And people underestimate the power of compounding, the power of just having, a couple $100 a day, a couple $1,000 a day, whatever it may be, whatever level that you're at, people underestimate just how fast gains add up because they always let a loser or two kind of bring them back to the medium. I've had many of those problems, and throughout the past, I still deal with it today. It's always that you don't want to take it off, but you know you should. And I can tell you that more often than not, when I take it off and I do the right thing, even if I'm upset because I missed out, for example, today on Lulu, I was short, I was up enough, really nice, I missed the cover, I went down again on it, and then it came back to about even. I was excited about it. I went ahead and sized right down, and then it did exactly what I was expecting, but I wasn't upset because I did the right thing. I missed out on a huge gain, but what if I didn't cover? What if it kept on going? And that's kind of the way that you need to look at things, and it's all about minimizing those what if type days, because those what if days are what sets apart great traders from good or losing traders.
Yeah, absolutely. And I think this is probably going to tie neatly into my next question, which is in regards to one of your, I guess, mottos, if you will, that you trade by, which I'd love for you to expand on. And that is nail and bail, don't stay and pray. How does this tie in with your trading?
Well, I mean, this is really the kind of the momentum type of trading. And a lot of people will take shorts on these big names, or they will get long on these stocks that are tanking. And the idea is going to be to get in and get out, but then they try to make something more of it. And that's just not the way to do it. And especially when you're trading stocks that have crazy range, that, like I said earlier, the 30% gainers that turn into 100 or 120% type gainers. And, you know, it's a situation where you need to really focus on just nailing that trade, moving on. Focus on the next one. Nail it, move on. And not necessarily nail it and make money every single time, but nail it. If it doesn't work, bail, get out. And the problem is sometimes when it doesn't work, people stick around because they just want to, quote unquote, see what it'll do. And that see what it'll do turns into many times account breakers.
Yeah, 100%. All right, Nate, well, let me ask you one last question, and then we'll speak a little bit about Traders for a Cause. I'm keen to hear a little bit more about that, and also Investors Underground. So before we do that, what's one area of your trading you'd like to work on or improve moving forward in 2016?
The biggest thing is probably that balance of getting away from the screens. And I mean, I've been working on it for years, but I've actually been doing pretty good about it the last couple months. But it's a totally different story when you're at highs, and it's so much easier to trade when you're near your account highs because you're not chasing anything, you're not trying to get back, and you're actually just able to wait for the trades and let things happen. And with that comes a lot less, not necessarily stress, but a lot less the feel that you need to be there, that if you're not there, you're potentially missing something that could bring you back up to your highs and whatever. So the key is really just trading well, never try to minimize the drawdowns that you have so that you are able to actually enjoy life at the same time. Because if you ever notice, when we have those days off, the days are so long and you don't realize how long you're actually in front of the computers. And it's nice to be able to break up that day and have that work-life balance, especially if you have a wife, a girlfriend, or whatever. You need to have that type of balance, otherwise, you could lose it.
Yeah, that's a really solid point. And I mean, getting that balance right is always a constant struggle, but I mean, it's something that I think pretty much we all need to continually strive for. So yeah, great points. Now, Nate, I'm keen to hear a little bit more about Traders for a Cause. So tell us how it came about and what motivated you to start.
It was an idea one year that I had come up with, just sort of sitting behind my monitors, and I'm like, hey, it's just being my monitors. Wouldn't it be nice to, have some type of other impact in the world? And I had approached my friend Scott Herman, who runs Centerpoint, and I just threw out the idea to him, and I said, imagine if 1 week or 1 month we just switched our logos to pink, and we raised money for breast cancer 1 year, something like that. Just throwing it out there, and he just kind of stops and he's like, Nate, are you serious? Do you know anything about me, my past, or anything? And long story short is his wife had breast cancer, and I had no idea. And so it really struck a chord with him. He was like, listen, Nate, I'm in, and I'll double whatever we raise. And that was kind of like how it was first born. And so we came up with that idea. We did one little small fundraiser the first year as we were becoming a 501c charity. And the next year we ended up doing a Vegas conference. We had about 135 or so attendees there. And we raised about $100,000 our first year. And then last year we had 177 attendees, and we raised about $175,000. So it's really about, the way that I explain it to people is we're in a business where people like to brag about how much they make. Why not brag about how much you donate? And it's really a great excuse for people to get together that you have these online relationships with, meet them, and shake a hand, and people that you work with literally every single day, but it's just a digital relationship. But when you meet them, you're actually doing something good for other people. So that's kind of how it was created, and it's worked out great so far. And it's been a really a great year, especially for us. We've raised over $200,000 just this year alone.
Yeah, that's really awesome. And what big plans have you got for 2016? Is there anything in the pipeline?
It looks like October of 2016, yet again, we'll probably do the golf tournament and the Vegas get-together once again. And hopefully we push over 200 attendees.
Yeah, that'd be really cool. Can you let us in on any of the speakers you've got lined up for the event, or is it still early stages?
We have talked about, I told Greg that he needs to speak again, and I think he's gonna. I talked to D4 Trade Online, and I think he's committed, and I'm working on Craig Trader, who's an exceptional fundamental trader. Once again, like I said earlier, surround yourself with people that have greater strengths than you, and he's definitely a much better fundamental trader than I am. So he brings in an interesting approach there. I'll probably speak next year, and I don't know who else yet.
Awesome. I'm sure it'll be a great event regardless. Now, tell us a little bit about Investors Underground. How are you helping traders to improve, and what products and services have you got readily available?
Well, what our site is really about is understanding sort of the why. It's not about joining and being told, hey, buy now, sell now, or getting an alert in your email box or a text message or anything like that, where it's really a rush to the entry in order to get a good entry and a rush to the exit when somebody exits. It's really about, okay, here's this setup, here's what I would look for, here's what I would risk on, and understanding what makes it a good trade. And that's sort of the way that we built the community, and we all sort of trade the same way, and it's really focused on just having good information, good alerts, good traders, and just really comes back to that timely information. So that's the chat portion. And then as far as the products and services, the products, it's all educational based. So we have 2 different DVDs. They're streaming educational courses. And one is just your basic entry level, goes through all the terminology, all the setups, long, shorts, sort of pitfalls, things that you're going to run into, and every mistake that I made. And if you can prevent them, I'm not saying you're not going to lose at all, but what I'm saying is if you can prevent those roadblocks that you're about to hit by learning about them ahead of time at least you're going to give yourself that much better of a chance. And then we had Tandem Trader, which is the second one, which is literally a recording of my screen as I'm making trades and dissecting what, who, when, where, why of each and every single one of those trades, drawing on it, showing why, what I saw, and really understanding, not necessarily, hey, this is what the trade did after the fact, but actually seeing it in real time. So that was really the biggest part about Tandem Trader, which was our best DVD to date. And then you take it a step further with having the service with the webinars and just ability to interact with all these great traders. And it's not just one person. That's not what it's about. It's about a community of people that are there every single day that are looking towards that one goal of finding profit.
Yeah, that's really great. And I mean, you guys have definitely had a really good response to the material you've put out, and you've got a very active community. So it's cool to see you've been able to put that together in a really impressive way. And guys listening, if you want to find out more about Nate and Investors Underground and their products and services they have available, go to chatwithtraders.com/IU. That's the letter I and letter U, obviously abbreviation for Investors Underground. So chatwithtraders.com/IU. And for full transparency, that is an affiliate link. So if you do decide to sign up or subscribe to any of their services, I will receive a small kickback, but the price will not be inflated in order for me to be compensated. In fact, I believe the prices on that page are actually quite discounted and heavily reduced from what you'd normally find online. So definitely check that out. And Nate, you're going to have to introduce me to some of the other great traders you've got in your community, because it would be really awesome to set up an interview with some of these guys.
Absolutely. I mean, we've got so many different guys in the room that I know that you can get a ton of different, different ways of trading in life. And I mean, that's really the first thing. If you look at Momo Traders, the book that we just came out with, you've got Phil. Phil is one of the guys that just comes in the morning, makes his trades, he leaves, he goes to the lake for the day. I'm jealous of his lifestyle. But then you got Eric, who has molded into this great swing trader. You've got Greg, who is just an amazing trader. You've got Michelle, who's a swing trader, which you interviewed last time. So, I mean, there's just so many great traders, great things that you can learn. Like I've said all along, you should never stop learning, because you're always going to continually mold into a new trader. The second that you stop, that's when you lose your edge.
Absolutely. You got to continue evolving. All right. So to wrap this up, chatwithtraders.com/IU. You can find out more about Investors Underground and learn more about Nate there. What's the website for Traders for a Cause?
Traders for, which is the number 4, acause.org.
Okay. And your Twitter handle is?
Investors Live.
Awesome. All right. Well, all those links and a full recap on this episode can be found at chatwithtraders.com. So everything will be there all in one place. Nate, thank you so much for doing this. I'm really glad we got the opportunity to set this up. Take care and enjoy your evening.
Thank you so much. Have a good one.
You've come to the end of this episode of Chat with Traders, but don't worry, more great episodes are on the way. To stay updated with each great new episode, be sure to subscribe to the podcast in iTunes, and we'd love it if you leave us a rating and review. We'll see you next time on Chat with Traders.
What would your trading look like if capital wasn't the constraint? That's the reality for most traders. It's not skill holding them back, it's size. Trade the Pool changes that. Step into the U.S. equity markets with up to $200,000 in buying power without committing your own capital. Full access to stocks and ETFs, long or short, executed with the precision and freedom serious traders expect. Your performance is measured by one standard: disciplined risk management and consistent execution. Meet that standard and you operate at scale. No subscriptions, no ongoing obligations, just a clear path forward. For those ready to trade beyond limitations, this is the next level.
Markets, speculation, and risk. This is the Chat with Traders podcast, hosted by Aaron Fifield.
What's up, traders? How you doing? Hope you're off to a really great start for the year. Welcome to episode 56. All right, so this week's guest is Matt Zimberg. He's the founder of Optimus Futures, a boutique brokerage firm that, of course, caters specifically to futures traders. Matt has been deeply involved in the business of trading since his early 20s, and while he's no longer an active trader, he is extremely insightful on the subject. Keeping in mind, he has extensive conversations with many traders every day, from absolute beginners to those trading seven-figure accounts and upwards. In particular, some of the topics we covered during this interview include the makeup of a successful trader, why professional trading should be boring. I know you hear it all the time, but Matt does a really great job of explaining why. You'll also hear some tips and pointers for selecting the right broker and much more. Now, because Matt is a registered broker, I have to read out this disclaimer, so please bear with me. Trading futures and options involves substantial risk of loss and is not suitable for all investors. Past performance is not necessarily indicative of future results. You should therefore carefully consider whether such trading is suitable for you in light of your financial condition. The placement of order such stop loss or stop limit order will not necessarily limit your losses to the intended amounts, since market conditions may make it impossible to execute such orders. The use of leverage can lead to large losses as well as gains. All right, now that that's out of the way, let's get to the interview. Here's my guest, Matt Zimberg. What's up, Matt? How's things, buddy?
Things are really good, and I'm excited to be here with you.
Good to hear, good to hear. Welcome to the podcast, man. It's really good to be speaking with you, of course. Now, for this episode, I feel like you're going to provide us with somewhat of an interesting perspective as someone who runs a brokerage and has done for many years. Whereas most people I speak to have broking experience, have come from broking and transitioned into trading, but you're much the opposite. So let's wind back time to your early 20s when you did first get started in trading. What was your introduction to trading and where did it all begin for you?
I would say that probably the first time I had real curiosity in the markets was during my time in college. There were a lot of students that I was surrounded with that studied with me finance and MBA. And at the time, I was exposed to some academics that started learning about derivatives, swaps, and things of that nature. And that really got my curiosity in the practical field of trading and the whole intermarket banking and so forth. Also, during college, I studied finance and economics, and naturally, you get exposed to those sort of things, like trading and, in all instruments and Forex and stocks, futures, options, and also over the counter. So that would probably been my first exposure to the markets. Later on, I started out as a broker. I had a number of jobs after college. I've been exposed to a number of things, but I would say I started off as a broker on the retail side, and I really, really liked it. And from there, I continued to where I am today.
Okay, sure. So tell us about your first trade, because you were quite involved with trading before you sort of moved deeper into the brokering side of things. What was your experience like as a trader for those, in those earlier years?
I would say that I was very, very naive about the markets. I truly did not understand the complexities of the market. In the first years, I didn't understand how the market works, how the mechanism works, the effect of individual psychology on trading and so forth. And I would say that took many, many years to learn and to see how it how it's all incorporated. So I would say that the first trades that I've done as an individual were very, very long-term, based on trends and things of that nature. But at the same time, I can say that when I started, I had a defined methodology. I understood all the complexities and so forth. Part of it, when you come from college and you have an academic background, you learn a lot of theoretical stuff. And then you start learning the real stuff that happens in real life. And anybody who went from college to work in any area, that he sees that the practical area is very, very different from the academic area or the theoretical one. So I kind of, in the first years as a broker, I had to learn how to look at the markets the right way, how to analyze it the right way, and how to think about it the right way.
Okay, so from there, tell us a little bit about your first years as a broker. Like, how'd you get involved with that side of things?
The first years were very, very interesting. Basically, I applied for a job. I said I want to be a broker, I had an interview and so forth. And typically in the first years, it's very, very hard because I would say that you don't have the understanding of the market, so it's really hard to acquire customers. As I've became more proficient in the market, I got better at it, and I have to admit that in the early years, I also had a lot of customers who have traded for many years. So they were just looking for somebody reliable to place an order with, and have shared a lot of information with me. So some of them have traded in the, even in the 70s. So even though I started my career in the 90s, they were already trading in the 70s. They told me about their experiences, about their ups, their downs, and so forth. And I kind of build upon that experience. I'm very grateful that I had people like that in my life in my early years that have actually sat down and spoke to me. And at the time, unlike today, the internet was not as evolved. So I've met a lot of people in person. So in person, so they shared with me the information. We spoke about it, and from there, it kind of started. How should I say that? It gave me the opportunity to explore the topics they were talking about more and more, like fundamental analysis, technical analysis, the psychology of the markets, surprises that can happen in the markets, and things of that nature. So those were the first years. As a broker, I evolved from being a broker to being a branch manager. Later on, I moved to New York. I worked, prior to building my own firm, I worked in a very large FCM. I've learned a lot from that. I've learned from people in different departments. There were self-directed, managed futures. There was the risk department. So I've learned really how the big operation functions before I built my own.
All right, excellent. So let's get into some of the things that you've learned and observed, from many years as a broker. So when we spoke, prior to this call, you had mentioned to me that there were two things you really wanted to get across during this interview. Now, the first point you made was people who are good in trading are not just good in trading. So if you could, Matt, walk us through this and share what makes a good trader.
Okay. So typically, in my experience, the good traders that I have met have done something very successful in their life before. Maybe I shouldn't exaggerate and say very successful, but I could say that they were successful. Maybe it was in the area of business, or it could have been in a successful career. But what they're used to is some sort of I would say, a cold discipline and approach to things. And they have been through ups and downs in their life and in their career. So when they came to the markets and they start trading the markets, the ups and the downs do not affect them the same way as if they would affect somebody who I would say, in the beginning of his career, or has not achieved as much. So those people have a little bit more of I would say, of sophistication and approach when they come to the markets. I would say, if this could lead me a little bit to the idea of what makes a good trader, in my personal opinion, is really the idea that they've done something successful before, they've built a method around it to that success, and at the same time, I would say that being successful in the market, one trait that people do not talk about is really finding order in chaos. I find that people that are successful traders know how to do that. They don't necessarily look at the entire picture, but what they do, they isolate certain variables within trading, and they basically find the order in it. If I can use an example, and I hope it's an appropriate example, but if you look, for example, at a hurricane, okay? When you look at a hurricane, or a tornado, I would say, you basically see a mass wind that blows everything around, and it looks very chaotic. But in reality, there's order to it, meaning that it moves in a certain velocity, it has a certain radius, and good traders find those variables within a very chaotic environment. And I think that helps them a lot. This is one thing I think that people do not talk about when it comes to successful trading. And this is just purely, again, my observation. So to those who are starting out, I would say that you have to develop a discipline in something way before it got involved in trading. And if you're not the type of person that can operate in a chaotic environment with very unknown variables, it would be very, very hard to be successful in the trading arena of any instrument.
Okay, that's a really great answer there, Matt. And that was you actually hit on the second point I was going to bring up, which you'd mentioned to me, and that is successful traders typically thrive in chaotic environments. So I think you covered that pretty well in there. So what are some of the greatest misconceptions that you often see or hear about good traders?
There is a concept of what traders think of good traders, right? So what the retail thinks of what good traders are and what they aren't. But the one thing that I noticed is that successful traders have at times the same psychological issues as beginner traders. But the difference is that they stick with their method. So I think that at some point people think that successful trader has completely overcome the psychology part. And I would say that they simply learned to live with the idea that they have to listen to their method more than their own gut feelings tells them. And I'll give you a very simple example. Not long ago, I spoke to a really good friend of mine, and he's been trading for many, many years. And he told me that when he listens to his method, and what I mean by listening, when his method tells him, for example, that he has to add positions to a falling market, or he has to short, a market that is going up, many times it gives him very strong uncomfort level. But he still learned over time, because of his success, to learn to his method more than his gut feeling. So to all the people out there that are beginners, they think that, successful traders have it all in control. Many times they don't. Psychologically, they just act on it differently. The second thing about misconception is the methods that they use. I often find that beginner traders think of traders out there as people who have a very sophisticated method and many, many variables to it. But I find that successful traders have narrowed it down to a very small number of variables. And this is basically what they go with. I think that beginner traders, as opposed to very experienced and successful traders, they try to have many charts, many screens, many platforms, and they think that that will all lead to success. But the reality is the successful traders that I saw and have met over my life, they use very simple methods, and they actually very proud of it. They don't say that they use sophisticated methods. They say we use simple things. It works for us. But I would say that they also have a very strong sense of risk management, meaning that regardless of the methods that they use, they know that many times they're wrong, and they have the ability to absorb losses and move on. And that's a very important trait in a successful trader, meaning that he has the ability to be hurt many, many times and not stop and continue doing it, and day in and day out. I would say that most people, unfortunately, cannot do that, and when they experience a sequence of losses, they freeze, which is really understandable. After all, money doesn't grow on trees, and everybody has only a certain level of risk capital that they can apply to in their lifetime or during that year and so forth. So I would say risk management, the ability to, again, absorb losses in a sequence of months, and still continue with the method that has been successful to them.
Okay, so a couple things just off what you've said there. The traders you're referring to who kind of have the approach that less is more, do you find that these are a certain type of traders, as in the, short-term discretionary traders, or the, maybe trend followers, or are you talking about traders just in general?
I would say that it's in general, whether they use a long-term approach or a short-term approach, it still has to be simple. Now, I want to emphasize one thing as well. When I say simple, sometimes it took them years to get to that simple, meaning that, maybe they started off with a lot of variables and a lot of indicators and a lot of other things that basically thought would help them. But at the same time, over time, they kind of, saw that certain things really just mislead them or they don't help them. So they simply narrowed it down. But one thing I wanted to say is that every single trader that I've met, every single one uses a different thing. I've never met one trader that has been doing this for a very, very long time successfully, and he's using something very similar to someone else. And that, again, leads me to believe that there is something in their nature that allows them to operate in this environment using the tools that they feel comfortable. So I don't necessarily know if it's always the tools that make them successful, but I think it's more than anything the risk management that they apply to it in terms of trading. I would actually, the people that are beginners always ask me, what do those successful traders do? And I tell them every single one of them is different. And this is what I really wanted to convey to a lot of people who are listening out there. You shouldn't really try and imitate anybody else's style and ask them what they do. But instead, build your own and something that you feel comfortable with. You feel comfortable with the entries, the exits, and the risk management.
Right. So the second part I wanted to pick up from, and that is you spoke, quite a bit about actually methodologies and, a good sound approach. So how should traders go about developing their own methodologies? What's your opinion of a good approach?
Well, first they have to understand how the mechanism of the marketplace works. I find that a lot of people would jump to technical analysis or price action or quantitative analysis, all those things, but they really first have to understand how the market mechanism works, meaning how buyers and sellers interact in the marketplace. And so, for example, how limit orders are being absorbed, how market orders are getting executed, and so forth. So this whole interaction of buyers and sellers, and it's really easy to learn because there's a lot of stuff on it on the net today. The second thing I would say is really look at their set of their skill set. What are they good at? Are they good in visuals? For example, I find that I spoke to a few traders over the years that are very good in recognizing patterns on the charts. Some people are extremely good in terms of knowing how to read indicators right. Some people like to apply things that are in math, mathematical analysis or statistical analysis. I would say for majority of people, first observe the markets, observe the patterns that the markets are operate within. Narrow it down to a small number of markets. If you're a futures trader, you can focus on something, for example, a very liquid market like the E-mini S&P. Although it's a very difficult market to trade, it has a lot of liquidity, it moves in certain patterns and so forth. If you want something a little bit different with, let's say, different type of leverage and movement, you can look at the 10-year notes and so forth. And once you learn the leverage that each product has, you can choose the one that is appropriate for you. So let's say maybe you're not comfortable with the movement of the E-mini S&P and the range throughout the day. Maybe it's just too much for your nature and your risk capital. But you may find that the 10-year notes, the movement is a little bit narrow. It's something that you can live with. So that's the first thing. The first thing is really to choose the markets. Once you choose the markets, then, like I said before, choose the methodology you want to apply. Look at the visual displays. Play around on every platform. You have so many indicators and technical analysis that you can apply and learn each one of them and what they do. You might not use those indicators, but by learning them, you will see what they're actually what traders are actually looking for. And that could evolve to other things and so forth. The third thing that I would do is really learn about cash management. It is, we can talk 2 hours about that topic in itself, but recognizing, I should say, when you're wrong is the key. So before you start trading, and if you've traded for a number of years, you have to develop a method that tells you when you are wrong. That the reason you get out of the market is because the set of conditions that have made you get into the market is no longer there. So a lot of people can use risk management that is financial, but it's better, in my personal opinion, to have a risk management which is based on price rather than just money. But essentially, the risk management, regardless of the methodology that you use, would be a key component of your trading, recognizing when you're wrong. Because I've seen situations, and it's kind of unfortunate, that people have eliminated an entire account because they were hoping that the price would come back. So we both know that psychology is a big component of the market, but the last thing you want to resort to in trading is hope. Everything has to be based on something. So it has to be based on the methodology. So again, the last part that I emphasize is the risk management, knowing when you're wrong and getting out of it.
Excellent. Okay, Matt. So bringing it back now, I asked you about what is the makeup of a good trader. On the other hand, what makes a quote-unquote bad trader?
Well, I wouldn't call anybody a bad trader, but I would tell you that there's different traders in different stage of trading. I mean, they're at a different stage. So when they start, I would say that even the best traders out there have lost money in trading in the early years. I think it's just you pay tuition to the marketplace. But I would say this, you can define a bad trader if you have the wrong motivation. If you're in the marketplace, to pay your mortgage and to create additional income when you shouldn't trade, it's really going to be reflected in your trading. I would tell people this, that any type of instrument that uses leverage, whether it's futures or Forex, or if you trade stocks on leverage, on margin, or option trading, they basically, your psychology will be affected by your motivation. So I would say to those traders who have really strong curiosity of the markets to learn in the first years and not trade. And basically, as they say, scared money never wins. So going back to the traders that are trying to be successful, and they're at a different stage, and the things that they don't apply out there are risk management. The second thing that they do is that they think that there's a method out there, some mystical method that they can just copy and be very successful with it. So they can look at a successful trader, take out what he does and simply imitate it, when in reality it's not true. Because the risk management component, that's what makes them successful, I believe, not necessarily the method. The third thing that I think they do is that they change methods all the time. So they move from one method to another method to another method. And another thing, a misconception among traders that are not successful, is that they think that there is some sort of a consistency in the marketplace as far as returns. So they think that a trader, for example, can open an account with $10,000 or $20,000 or $100,000 and generate, for example, 5% consistently every month. If you look at the returns of successful traders, you can always make an average after many years of trading, but I would say that the average is very misleading. I would say that they go through a sequence of very good months and very bad months, in the hopes that in the end they have a positive year. But they don't operate on short-term basis, and they don't expect cash flows to be generated on a monthly basis. And a lot of beginner traders, for some reason, have this belief. I would say that even when I try and convey this message to many traders, a lot of them don't believe me. They think that there is some sort of a magical method out there that makes the same return every single month. If you look at successful traders or anybody with a long-term track record, and I mean 15 years, 20 years, and so forth, it's quite interesting to see their returns and their drawdowns. And I think that traders, beginner traders, should start looking at those returns to see what they should expect. I truly believe that part of my job as a broker is really to inform people of all the knowledge that I have, in the hopes that if they see it, they will also approach the markets the right way. I think that if they look at those kind of stats, it would kind of change their approach, and hopefully for the better.
Yeah, so that's an interesting topic that you bring up there. And I mean, we could probably spend quite a lot of time on this. And that's, what's a decent return that you could expect? Like, when could you, how do I say this? Like, if you look at the big guys on Wall Street, right, they might return, 20% a year, and that's considered as like exceptional, okay? If a smaller retail trader, maybe trading a $10,000 account, returns 20% in a year, chances are they're not going to be satisfied. What's the difference there? Like, talk to us a little bit about how traders should think about that.
I think, if somebody has the ability to return 20%, I think it's a great return. This is just in my personal opinion, considering that the interest rate environment today, although we had a hike in the rates, by just 1/4 of a point, I think 20% is great. I wish I could answer that question and say what traders should expect. I think they should expect returns that are based on their skills. Some people will have more and some people will have less. But I have encountered people, for example, that would throw $5,000 or $10,000 into an account, and their question to me is, can I make $200 a day? And usually that's followed by, I'm not a greedy guy. I just want $200 a day. And my answer to that is greed. The minute you come to the marketplace and you say, this is what I want, whether it's 200 or 500 or 1,000, is definitely the wrong approach. Now, if you consider annually, $200 a day and something like 5,000 or 10,000, that's an abnormal return. I don't think people should expect it, especially when they're beginners. What they look at is the volatility of the market. And so they would look at something like the E-mini S&P, right? And they would see a range of 40, 50 points a day, or sometimes 20 points a day. And they would say, this is very achievable to extract only 4 points out of the market. But I think it's very deceiving to look at the markets this way. I think that what they don't have in terms of calculation, or one of the variables they don't take into consideration, is really the psychology that it takes to be successful in the marketplace, how you monitor and how you control the emotional volatility that comes with the markets. So honestly, I cannot, in good faith, say what traders should expect. I would say that it's based on their skills, the risk that they take with each trade, the risk capital that they have, and so forth. So different traders will experience different things. But I am very comfortable saying that if traders in the first year just survive, meaning that if they do things right and they don't lose their capital in the first year, I would say that, in my personal opinion, they may, and again, I emphasize, they may have a chance, in the years to come. This is only an opinion. This is my opinion, but I think this is what they should strive for. I think that most of beginner traders should expect, some sort of losses in the first years or months. And the reason is because that's just the marketplace. They have to learn how to control their emotions, develop a methodology, and so forth in the marketplace. A lot of people try for many years to paper trade before they come into the market, and they develop certain expectations from their paper trading to be applied in the marketplace. But a lot of people think I would say that because I'm a broker and I have a motivation of getting them started in trading. But nevertheless, I'm going to say that whatever you perform in your demo account, when you don't have skin in the game, it's a completely different thing. You will behave completely differently when you're in the marketplace. Also, and I know it's a little bit of a different topic, but nevertheless, people develop expectations of return based on their demo trading. And I would say that whatever happens in your demo, as far as your orders getting filled and the number of contracts that you trade and so forth, are very different than what you'll experience in real life.
Yeah, and just, further thought on that is like, the big hedge fund managers who are managing, billions of dollars, like literally billions of dollars, if they make a return of 20%, is that fair to compare someone who's trading maybe, a $10,000, $20,000 account? Is it fair to sort of compare their returns side by side? Like someone who's trading, $10,000, $20,000 account might make a 20% return in just a couple good trades. So can you really sort of compare your returns amongst the big boys?
Not really. In my personal opinion, hedge funds, for example, they trade a lot of money. And it's much harder to trade larger sums of money as opposed to small sums of money. And I think there's also a different set of politics with hedge funds. They have big customers, and I don't think they have certain rules and regulations as far as the risks that they can take with their customers' capital. Now, a small trader, on the other hand, might take, let's say that he'll take 3-4 gold positions, and, gold will jump up, let's say, $20 in a day, and he potentially could double his account, right? So on that trade, he achieved a lot more than what a hedge fund achieved in a year, and he might feel very good about it. But here's the most important thing. The most important thing is consistency. It's what you can do consistently, and not necessarily look at a retail trader that just does a small number of trades and becomes very euphoric about it. This is just my opinion. So I don't think you can compare between the two. And I think people who invest in hedge funds, they have totally different expectations that somebody who's a trader. We're talking here, in my personal opinion, of an investor that is used to certain market returns versus a trader that might expect a lot more because he's taking a lot more risk with his capital.
Right. So I guess the point I'm sort of trying to get to is that for an independent trader, it's not necessarily greedy or unreasonable to expect, returns of much greater than 20% per year?
I would say it depends on their skill. I'm not really comfortable telling anybody, a certain return. I would say everything is based on your skill, how many years you've done that, the risk that you take with every trade, and so forth. There are individual traders who make more than that. There'll be a lot more individual traders that make less than that. But again, it boils down to their skill. The question that you asked me is a very reasonable question. I really am asked a lot by people, what should I expect? What kind of returns should I expect? And it's very hard for me to tell anybody what they should expect because it really depends on their skill. I think that nobody should come to the market with any expectations of return. I would say, I feel very comfortable saying that. I think that as you should just focus on your method. The minute you start focusing on returns, it's a totally different thing. And I think it's in a leverage environment like futures, I don't think you should apply it. Maybe in other asset classes, you can build strategies, that would give you that. Like in bonds, there's fixed returns, dividends from stocks, and so forth. When you trade in a very leveraged environment like futures that entails a very high risk of trading, I think your most important focus should be your method. And what it brings you, it brings you. That's really what it is. I think that's what successful traders also do. They could also think about this. Let's say that you got to the point that you're a successful trader. So a lot of beginner traders think, well, why don't successful traders just trade triple or quadruple or at least double the positions that they have if they're so successful, and then they'll make more. But the answer to that, the reason they don't do that is because they're used to a certain level of risk that they're comfortable with. The second thing is, the more risk you take in a trade, in any given trade, it will affect you psychologically different. So maybe some traders can, for example, be successful with one lot, which is absolutely fine. But the minute they go to 5, they just kind of, they're in a different state of mind. Or somebody got to the point where they trade 10 contracts, but if they want to trade 20 contracts, might be too much for them. The fluctuations and the leverage and the effect on the balance could be a little bit different. So again, the focus should really be on the method itself and the application of the method to the best of a trader's ability without thinking about returns. And hopefully good things will come out of it.
Sure. Okay. That's a valid point. So let's keep this moving. Next question here I've got, I think you're going to give an interesting answer to. In your opinion, how does trading differ from gambling, if at all?
They're very similar in many ways. Both involve psychology. Those who are poker players, they have a bankroll, and any gambler would tell you that bankroll is extremely important, just like cash management. So in many ways, there are a lot of similarities, and you can actually learn from them. So one of the things anything that involves psychology and odds has, those are things that have things in common. So when you place a trade, you have certain odds, you have a certain psychology. When you gamble, you have a certain psychology and certain odds. So I would say there are similar things between gambling and trading in terms of psychology and cash management. I would say that the difference is that, and again, this is just my opinion, I think the major difference is really the trends of the markets. Meaning that every single time you gamble, you start over with the same odds. But I think in the marketplace, you have trends. You have trends of markets going up and markets are going down, and you have those trends and you can basically build on that. But I would tell you this, a lot of people say, I'm not a gambler, I'm a trader, right? because they don't want to be associated with the word gambler. But the issue is, if you're trading, for example, based on gut feeling, and you don't have any method, and you double down, or you get into, when you lose, or you get into revenge trading, this is also a form of gambling. So I would say that, when you think about those two things, I don't think you should right away dismiss that trading doesn't have any gambling components in it. I think it's important to realize that both involve very strong psychology, cash management, and so forth. But of course, I think that trading is done in a better environment, in a regulated environment. Casinos are private, and they're interested for their customers, to lose. That's how they make their money. I think the exchanges, on the other hand, the regulation in our industry provide more of an objective environment for the trader. And in a place like an exchange, you just exchange opinions, right? So somebody's long, somebody's short, and so forth. And somebody will be right at the end of the day. But the exchange doesn't have a vested interest in somebody, losing their money. So I would say that trading provides a better and a more objective environment, than a gambling environment.
Yeah, I really like that answer, Matt. And the reason I asked that is because there's a really great article you have on the Optimus Futures blog. So I'll link to that if anyone wants to, read more on that subject. That'll be at chatwithtraders.com/56. So one other thing I wanted to ask about, obviously amongst many, you often hear established traders and the guys who have been around the block saying professional trading should be boring. Are you able to elaborate on why this should be the case?
Yes, it's actually a very good question. Trading at the end of the day is successful trading, I should say, is boring. And I'll tell you exactly why. Once you build a method and the method is successful, you really have to wait for the times to apply it. And the market may take some time until it provides you with this opportunity. So even if you're a day trader, it doesn't mean that you have to trade every single day. Maybe the method that you build is a day trading method, but it only applies once a week. Maybe there was 1 week that every day provided that opportunity. But at the same time, you have to wait until the market forms to give you this opportunity and apply your method. It has to be done under certain market conditions. And this is why I say trading is boring, or successful trading is boring, because most of the time it requires traders to sit and wait until the market presents them with this opportunity. Unfortunately, it's human nature. People get bored, so they don't want to miss on an opportunity. So again, they use a lot of hunches and gut feels and, newsletters and forums and other forms of communication that encourage them to be in the marketplace. But I find that those people that are patient, they wait for the right opportunity, and then they apply it, I think they have better odds than somebody that looks for excitement in the marketplace. And that's, again, why it's boring, because you have to wait for that opportunity to come. And those people, they just learned, that this is what it is. They just sit, they wait, the opportunity presents itself, and then they apply it. And even then, they know that they still have to control their risk management, and they have to, apply regardless if it was, let's say, somebody trades price action, and that certain formation was formed, and they apply. They still have to apply the risk management to it, in order to be successful in the long run. And the one thing that I would like to add, this is really important to understand. We were talking before about successful traders and everything else, and you asked me about gambling as well. And there's one thing that is still could be very, very common. You could do all the right things. You can do every day the right things according to your plan, and the market just doesn't return anything. or actually doesn't play along with you, or where you lose money. So you do everything right. And this is also what traders have to understand. There could be days that they do everything right. They were disciplined, they waited for the right opportunity, they applied the risk management, and still they were not successful in the trade. And this is what successful traders have learned also to live with time, is that the fact that they can do everything right and still be wrong. And this is something that majority of the people will not want to do or admit to, that they actually could do everything right and still have a unsuccessful day. So that's important, to understand. And the reason that I'm sharing it with everybody is, God forbid, not to discourage anybody from trading, but rather I think that, if you prepare right, if you know all the facts, one thing that I try to do with my customers is really give them all the facts up front, and be honest with them about it. And I think if you provide them with the right facts, I think that a lot of people will make the right decisions along with it.
Yeah, that's a brilliant answer. And I like the part where you mentioned that even if you're a day trader, that you don't have to trade every day. And it kind of reminds me of a point that Cam Data, who I know you're very familiar with, mentioned on a previous podcast. And he spoke about how, there's some days where he might sit in front of his screens for, 5 hours and not even place a trade, just because he has a very specific framework for how he trades. And if, the market doesn't align with that, then, it's a no-go. So,
right.
It's a solid point. Now, another question I'd like to, put to you is, why do traders many times find themselves repeating bad habits and lacking discipline?
Well, let's go back and talk about what we spoke about earlier about, people who approach this game who were successful before. They're used to discipline. Most people are not used to discipline in their day-to-day life. But I would say that there's this concept of hope. And I think that people have to separate between hope and habits. And I'll be very specific, and I'll answer your question. So a lot of people say, just this time. The reason that they repeat the same mistakes over and over again, they say, just this time. I'll give you an example. Let's say somebody gets into a bad trade and it goes against them, and then they add money and they add money and they add money and they blow their account, right? And so that experience is done. And then let's say they refund their account. So now the same situation, and what they say to themselves, just this time, and if I recover, I won't do it again. So they're always in the business of convincing themselves that they will not do it again. The reason that they lack discipline is because they're hopeful. When there's a certain level in the marketplace that even if you're very, very disciplined, and it happens to a lot of beginner traders, they throw everything out the window. Everything that they've learned, everything that they've applied, they just kind of throw it out the window in the hopes of recovering big losses that have occurred. So I would say that many traders are not disciplined. I would say because they're not used to applying a method consistently every day, they're not used to the fact that you have to wait for the market, for the opportunity. They always think they're going to miss out on things. And at the same time, they're in the psychology is in such a way that they hope to recover from losses, and they keep on repeating the same mistake over and over again. Over the years, I've read a lot of articles about psychology and trading or just human psychology in general, and motivations of people can vary from one person to, everybody. I can't say that I have expertise in behavioral finance, which a lot of those people, their psychology falls under. But I would say that hope to recover from losses is probably the number one thing where this is the area where they stay undisciplined. They hope to recover losses that have occurred in the market. And when they try to do that, even worse thing happened. The one advice I would tell people is basically, again, risk management. stay focused on that. That is your number one priority. And I'm not saying that you should be proud every time you take a loss, but at the same time, you can say to yourself, you know what, at least I applied it and I applied the risk management. And you just keep on doing it in that pattern. And hopefully that would lead you to better and positive results.
Absolutely. Yeah, well said, Matt. I think that was probably a little bit of a tricky question, but I think you nailed it. So now it makes sense that I ask you a few things around brokerage while we have you here. So this may be almost like a two-pronged question, but answer it however you see best fit. So what are some tips and pointers traders should consider when deciding on a broker and a platform?
I would say when you choose a broker, you choose somebody you get along with, you choose somebody who's competent, and somebody who can give you very objective answers that are based on your situations. Now, at times I am faced with situations with, for example, potential customers that come to us and they request certain things and so forth. And what I try and do is not necessarily discourage them from what they do, but rather show them a different thing that they can utilize in their trading, whether a different technology or they've read something online which I don't think is right and so forth. So to answer your question, a broker that is objective, a broker that understands what you're trying to do and apply and offer you the right technology with it. Now, as far as the choice of platforms, how do they go about choosing the technology and so forth? I would tell you this is probably the most overwhelming area for traders. I would say that some are stuck for months, if not years, trying to choose the right platform for them. And I would say that, just choose one and just start. Honestly, might not be what you're looking for, and you'll have to switch later on. But at least by working with a platform, at least you'll see what you get out of it, and it might fill all your needs. So I would say it requires a little bit of research as far as your method. But I find that most of the platforms today that are provided by the big companies that we represent would cover probably, I would say, 80 to 90% of customer needs.
Okay, and you might have to correct me on my terminology here, but what are some of the big differences between your typical retail, your online brokers versus your more professional brokers, like yourself?
I'm not sure that there is a big difference because, what we do, if you're talking about the big wirehouses out there, then they also, we're in the same marketplace. So they have a platform and they kind of, I would say, have, their technology and they represent it. And then there's brokers like us, and we represent our technology. In terms of operation, I think we're more of a boutique. So they're very big. When you call in, not everybody might know your name or what you want to do, or there might be a lot of departments. We have more of a personal relationships with our customers. And, sometimes we provide, the same type of technology, if not better. The big houses out there, they usually have one platform and they push everybody onto their platform. Because we are an independent introducing broker, we have the ability to offer different people, to offer different traders, different technologies. Some people might come in and say, look, I need something very good for option analysis. I'm a writer of options. Or somebody might say, look, I'm using market profile. What do you think is better for that? And also, one thing that it's important to remember, and this is something that you only learn over time. When you shop around, you really have to understand the technology that is provided to you. It's not all the same. Many years ago, when we started implementing more and more and more online trading, I found that there could be really big differences in terms of technology and execution. So what you should strive to have is some sort of a data feed that works with your platform, which is low latency. So that's basically, the thing you should strive for, something that, delivers your orders really fast. So I would say that boutiques, in my personal opinion, boutique firms like us may give a bigger option to a trader as opposed to just pushing one platform. We have over 40. So I think this is where we have the advantage. Now, where they have the advantage at times is basically in areas where we're not licensed, for example. So you might find that they have one platform for stocks, options, futures, all intermingled into one. And this is and for some traders that's important. For those who are focused on futures specifically, I think this is where we have the advantage.
Okay. So just to summarize, it would be essentially, I guess, the technology aspect is much more flexible in which platform you prefer to work with, as well as more personable on the support side of things.
Correct.
Okay. So following on from this, again, a very open-ended question, but what should an active trader consider or think about when it comes to commissions?
Well, commissions are really important because they're basically a cost for every single transaction that you do. And essentially, what you should look at from a cost perspective is a number of things. One, it's to see what kind of impact it has on your trading overall. So, for example, if somebody's very, very active, it would be really foolish, to pay, let's say, above average commission or above average what the standard industry offers. So you have to see what impact it has on your trading. If somebody, on the other hand, trades once a day or once a week and it doesn't matter, and then that's where it's not important. But there's always a price war between brokers. You really have to decide who provides you with the best service at a given price. We try to be very, very flexible because clearly if somebody's a very active trader, I don't want the commissions to eat, if he's a successful trader, the majority of his equity. So it's important to be very, very flexible in that area in order to retain long-term customers. But if I was a customer, I would see, number one, the competence level when, for support, technology, making sure that it's always working and so forth. And also, it's important to talk about the one-off things, right? So, for example, what would happen if your internet fell? That's not a commission factor necessarily when you trade, but that one-off thing, you have to be sure that your trading broker is available there, or the FCM that you work with is there to help you offset the risk when you're in that position. So those are the things that you should cover. So again, it's technology, price, support, and so forth. And again, that all stems from your level of trading. You have to look at the volumes that you have and to see what kind of impact it has overall on your account. You may find that you might be with a broker that you pay him just a little bit more, but at the same time, it doesn't have any serious impact on your trading, and you have a good relationship and you have a technology that works. Now, you may find that sometimes, the impact of the commissions due to your frequency of trading, and I have to admit that some day traders, they generate a lot of trades. Some of them are scalpers, or they go for a small number of points, and they might do it with a large number of contracts. So that has an impact. So it's important to negotiate those things with the broker. And I think an experienced broker who doesn't think short term should be very accommodating.
Ever watch a stock rip and think, I could have nailed that if I had real capital? The truth is, many capable traders never reach their potential, not due to lack of skill, but lack of scale. Trade the Pool was built to solve exactly that. A firm designed for serious individuals who want access to the U.S. equity markets with meaningful buying power, up to $200,000 without committing their own capital. Get access to virtually every stock and ETF. Go long or short freely with the flexibility professional traders expect. You're evaluated on one thing: your ability to manage risk and execute with consistency. Meet the standard, and you trade at scale. No subscriptions, no ongoing commitments. Whether you're still refining your strategy, a trader with experience who hasn't yet broken through, or a seasoned professional simply looking for more capital, Trade the Pool is built to meet you where you are and take you that next step further. The markets have evolved, access has evolved. Now, so has the way traders operate within them. Trade the Pool.
So I guess that's something I'd like to ask you about is, typically speaking, how negotiable is the amount of commission a trader pays to their broker? Like, especially if they notice that their commissions do have quite a big impact on their trading performance. Like, how do they go about that? Is it an option to negotiate with every broker, or are there certain brokers where you can and can't do it?
I can't speak for other brokers, but I would say, for example, in our brokerage, and I believe it's the same case with other brokers as well, although I don't know for sure for every broker, but I find that most people are negotiable. If the trader is able to demonstrate that it's really having a serious impact on his trading, then basically, everybody should be negotiable. However, sometimes there's only so much a broker can do in terms of commissions, because a lot of the commissions are built of other factors. They're built of for example, what the exchange charges. So they have a fixed cost, they never change it. Then you have the routing fees. So depending on the technology that you use and the platform might have a routing fee, which they incorporate into every single transaction. That's what they do. And sometimes the cost from them could be much higher than the cost of the broker. So sometimes it's the negotiation part is not only done with the broker, but the broker has to negotiate with, the technology and say, look, I have a customer, he really trades a lot. It would be in our best interest, to lower those costs in order to help the customer. And, I know there's a certain kind of misconception about brokers that we really want to squeeze the most out of people, but I find that professional brokers, even other friends of mine who are my competitors, but nevertheless colleagues, that's not the way that we think in the industry. We really try to, and I'm not the only one. So I don't want to say that I'm the only righteous brokers. There's a lot of good brokers out there who really understand the needs of the customers, and we try our best to help the customers and still at the same time have some sort of an integrity behind pricing.
Sure. No, that's really good to hear. So, Matt, still on the topic of brokerage, I think it's still relevant and ties in, but slightly different. So you've been in the business a long time, right? What are some of the great differences you've seen when comparing, the younger generation of traders to the older generations of traders, especially with the introduction of online trading, paper trading, and the different sort of tools and platforms that are now available? Like, what are the great differences or challenges between, today's generation and, the generations who have been trading for many, many years?
That's a really good question. There's a lot of things that I can tell you about both the brokers in the industry that have changed and the customers that have changed. When I started in the industry, majority of my time was actually spent on analyzing the markets. So I would say that once a week I would sit and look at the markets and what happened. And since most of the business was done over the phone, I would discuss that with the customer. Those things rarely happen today. I mean, here and there you might talk to a customer in general about trading and about the markets, but it was not as specific as it was before. I would say that before also people have not traded as frequently as they trade today. I think today, because they sit in front of the screen and they see the movements of the charts and the prices, I think it also affects their behavior. So before, the old generation, in order to get quotes, you really had to pay a lot of money. And it basically economically was not worth it. Today, it's practically, free, with the exception of a few, fees you have to pay to the CME or other exchanges. For the most part, it's really nothing, in my personal opinion. So people trade a lot more frequently today. Today, us as brokers, we're really turned more into consultants of software, not markets. People don't discuss with us markets anymore. And I'm not saying it's good or bad. I'm just saying that's just the way it is. There's so much information out there today that is free, from personal blogs to forums to big news outlets that write articles by the minute. The amount of information is out there is incredible. So the old traders were more focused on, I would say, back in the day, on longer term trends. They would take one trade, here and there, focused on longer term. Today, because of the commission cost that has been reduced substantially down, and because of the access to the markets, the ability to deliver orders so fast, the amount of trading is increased from the younger generations. I think they're more focused on shorter term trading, from scalping to day trading. And I find that people that are focused on long-term trading are just less and less and less. Also today, people trade a larger variety of markets. Back in the day, people would need to follow a certain sector, like they would follow the grains or the metals. Today, people trade everywhere. Anything that moves, and in different exchanges. They can trade the E-mini S&P during the day, and at nighttime, they might turn onto the Eurex and trade the DAX market. So the reality of it all is that the trader has changed substantially, his nature, what he's looking for in a trader, and the traders have become, and the brokers have become more of technology providers. And that's what we do. We're just in the business of kind of technology and commissions.
Okay. And just while we're on this subject, what tips do you have for traders going from a demo account to live trading? You touched on this a little bit earlier, but just, what tips and pointers could you give to someone who might be making the jump?
Okay, well, before they even make the jump, I would say that during their demo, they really have to behave as if it's real money. And a lot of people say they do that, but they really, really don't. For example, somebody might trade X amount of contracts on any given future contract, but in real life, they would trade a lot less, right? Or they might use time frames that are reasonable, in a demo, but they're not reasonable in real life. Let me use a very specific example. A lot of people say, I just want to trade one tick on the E-mini S&P. They just want to trade a lot of times the one tick minimum, which is $12.50. And I would say for a retail trader, it's impossible. It's impossible because you can't sit at home, and with the latency that you have, to go to the marketplace and do those kind of things. It's just, in real life, it's not practical. What you need is to have some sort of an automated program or some sort of an algo that sits on the server of the exchange, and you have to have exchange memberships that would lower your commission substantially and so forth. But this is just one example. So it's important that when you trade demo, not to treat it as only a tool of demo, an imaginary thing, because the transition to real trading would have a real important impact on your results. So you might see that the results in real life are not the same, and if you didn't apply it right on the demo, they will never be the same. So I would say that's important to do. Now, some traders just don't know those things. Unfortunately, it's lack of knowledge that makes them behave one way in a demo, and then in real life they expect to have the same, and it's just not the same. But I would say that that the difference when they transition, from demo to live, to a live environment, is to realize that when you have skin in the game, you have a completely different behavior when it comes to your money. Completely different. They can't expect the same results I don't think you can learn how to trade through a demo. I believe that you can only learn how to trade with real live capital, because the emotional reactions in both situations is completely different. And because I believe in discipline and the psychological composition of a trader, I think that this is where you would basically see the difference in the two. So I think traders really have to realize that once they transition to a real live environment, it would not be the same. I think demos, for the most part, are there, in my opinion, just to learn the trading platform. It really is. It's where you learn the functionalities of the platform. So when you trade live, you don't want to use a manual or call your broker and say, where do I press this or where do I press that? You just learn over time, how to do things. Now, I'm going to say also another thing, which is another aspect, that periodically you have people who trade live, but they might test a method on a demo environment. Now, those who have traded live for many, many years or for many months, when they go back to demo, they, I would say, are more realistic about the limitations of demos. They already understand that if it works in demo, it doesn't mean that it works in real life. But they test it in a fashion that works many times with the limitations of a demo. So when they move to real life, they don't have the same expectations. They might test certain things in terms of data. They might see if it's economically viable for them to do that. But again, their expectations and the way they approach demos are very different than those who never traded before.
Absolutely. I think that's a really valid point, and I can kind of relate to that on some level. Like, I remember when I very first got into trading, I was on a demo account, obviously, but it just didn't really feel right. I just knew that I wasn't treating it like I would if it was real money on the line. So yeah, after live trading for some time, and then I went back onto demo later on to try a different sort of methodology. And it was much more helpful after I'd kind of had a little bit of experience actually live trading. So yeah, it totally makes sense what you're saying there. Now, Matt, where do you see the future of trading headed? Like, where is our industry going? And maybe if you could aim this answer more towards independent traders.
I think the focus from retail customers and self-directed customers, I think the direction is going towards faster and faster connectivity to the exchange, low latency execution, and emphasis on the data. Today, retail customers, and I have to admit that some retail customers are very sophisticated. I have come across retail customers that I've actually learned a lot from. They have been, for example, in areas of software and programming, and I'm not a programmer per se, and so I have some basic knowledge of some certain programming languages, but I've learned a lot from them how they look at the market. So I think the direction that we're going to where it's faster execution, low latency, and also the ability to transmit unfiltered data. I think this will be a very important focus for a lot of technology companies out there. And I think this is what traders would demand from the marketplace.
Sure. Okay. Exciting times ahead. So,
Definitely.
Matt, are there any final words you'd like to add? I think we've covered a lot of ground on this episode. It's been really, really great. But are there any final words you'd like to add before we start to wind things down?
I would just say that, it takes a long time to be a trader. You shouldn't be in a rush. You really should filter the information out there. The more you talk to people who actually trade, and it's hard to find traders. For the most part, I find that people who trade, they don't advertise that they trade. You would never know. They always say that they do other things. But if you have a chance to talk to people who actually trade real live, and they apply it year after year, I think you can learn a lot from them. And I think at the same time, you have to filter also what you read on the internet. I've read or I heard that in the next 4 years, the amount of information that will be on the internet will be 100,000 times more than the amount of information since the creation of Earth. I mean, can you imagine how much information there will be there about trading in every asset class? And you will go to the internet and you'll punch something on Google and you'll have articles and articles and articles. And you really have to, the difficult part will be to filter out what information will be there. Not only for myself, but, for any, if you have an industry friend, try to talk to brokers like us who have been in the industry for a long time. We will give you practical solutions and we'll be able to answer many of the questions that you have. And if you have a good relationship with your broker or somebody you can communicate with, this is a lot of the stuff that could cover. And so basically, I would say as a final word is really, more than anything, is to take it easy. The one very important thing that I would say in the end, that futures trading is a very risky business. You really have to trade it only with risk capital. I would really suggest to people that are very excited about the markets and want to participate and so forth, and I encounter those situations every day when people tell me, look, I have X amount of dollars, I want to put this much in futures. And many times I tell them, look, you can't. You really have to look at your overall financial situation and see if trading in leveraged product is your best bet to start with. There might be better asset classes that are better for you. But if you decide to if you decided that futures trading is the area for you, take it easy. Filter out the information, learn the platform, and I would say also make a journal. When you trade in a real live environment, make a journal of what you trade and decisions that you have made right. Write them down. I would say the quantity that you write about your good trading should double the quantity of the writing that you do about your bad trading. Because what you want to do is get used to writing your good habits, and you reinforce your habits by writing more and more about them. It is important to make decisions when you make mistakes, and everybody will make mistakes. But at the same time, you keep track of everything that you do. You approach it in a very, very cold way. If there are times that you have periods that you did, that as I emphasized before, that you did everything right, but the market didn't deal you a good card, it's fine. It's something that happens to a lot of traders out there. That's basically it,
Awesome. Well, plenty of solid advice right there, Matt. Thank you very much for doing this. Before you go, can you tell us a little bit about Optimus Futures, like who you cater to, and just a little bit more about your company?
Thank you. I appreciate it. So Optimus Futures is an independent introducing broker. We trade through a number of clearing firms because we want to give our customers the variety to choose which clearing firm they want to go with. Along with every single clearing firm, there's also a lot of technology that they offer. So if people look on optimusfutures.com, they would see the number of platforms that we offer, and we help them choose which one is right for them. Along with that, we support them. We try to send them videos about every single platform. We're in communication with them in the early days to make sure that they get the username, the password, answer all their technical questions that they might have, and so forth. And above all, I would say my company is very, very patient. We're really like people. I personally, this is just my personal philosophy. I know that I make my living, it's a very conscious thought that I have, that I know that I make my living from other people taking risks with their capital. I don't think it's something that every single broker thinks about every day, and it's just kind of part of a job. Look, customers call in, you help them, and they trade. But I think about it every day, how difficult it is to be a trader in this environment. in markets that are becoming more and more volatile. They're affected by algos, high frequency trading that has completely changed the landscape of trading. So trading as we go forward will be harder and harder. I don't think it will be an easy landscape to operate in for many people. We've especially seen that, just a small point, in the transition of where people had to move from pit trading, people who operated in the pits, to screen trading. And many of them were not successful in doing that. So I don't know if you've ever seen the movie Floored, but that movie emphasizes that. So I always keep at the back of my mind how difficult the environment is for traders. And so I try to help them as much as I can, provide them with all the tools. And the same goes for my staff. They're really nice people. They really operate also from that philosophy because I enforce it every day. And again, you can find the rest on optimusfutures.com.
Excellent. So optimusfutures.com. How else can people get in touch with you? Are you on active on Twitter?
We have a Twitter account. It's Optimus. I think it's up at Optimus Futures. People can always email me. I always get my emails on my phone and on my laptop when I'm not at work. I answer emails at night. It's matt@optimusfutures.com. And they can call us toll free. It's 1-800-771-6748. Our local number is 561-367-8686. And they can also, through Skype, Optimus Trading Support. If you're an international customer and you're interested in getting in touch, we'll help you out.
Excellent. Okay. Well, I'll make sure to include links to all the details you just shared there in the show notes. So those show notes can be found at chatwithtraders.com/56. Everything will all be there in one place. Now, Matt, I should have asked you this before we even jumped on the call. I know you're a busy man, but are you open to answering more maybe general questions that any of the listeners may have in the comments? It may be something around brokerage questions or questions, even about trading.
Absolutely. I always enjoy talking to people. I find that, I never lack the enthusiasm to explain the same thing, even if I have to do it 10 times a day, if I have 10 beginners that day, or if I have 10 advanced traders who are looking for better technology. Even if the answers that I provide are repetitive, I always do it. And I wanted to tell, specifically, Aaron, that I really, really like what you do for traders. When I started out, when I was probably in my 20s, I don't think that people around our age group at the time took the same initiative that you take today to help people. And I think what you do for the community out there, bringing industry people and giving them a realistic perspective about trading, I think it is so educating. And I think a lot of people, maybe that's one of the good things about the internet. There's so much information out there, but periodically there's a person out there like you who has really good intentions, who is very organized, puts things in an organized manner where people can actually listen to all those interviews, take notes, and come with realistic expectations to the marketplace. So that's one good thing that happened with time. That, I find that young people like yourself have a lot more skills than what we had back in the day, when we started in the business.
Well, thank you very much, Matt. That means a lot. I really do appreciate that. So thank you. So guys, if you do have questions for Matt about anything at all trading related, go to chatwithtraders.com/56, scroll to the bottom of the page and leave your question in the comments area. And Matt will be obviously keeping a close eye on that, as will I. So, all right, Matt, absolutely awesome to have you on the podcast. Thank you so much for doing this. I know we'll be staying in touch, and we'll talk soon.
Absolutely. Thank you for the opportunity, Aaron. Much appreciated.
You've reached the end of this episode of Chat with Traders, but rest assured there are more episodes loaded with real market insight and zero hype on the way soon. So to stay updated with each great new release, subscribe to the podcast in iTunes, and we'd love it if you'd leave a rating and review. We'll catch you next time on Chat with Traders.
What would your trading look like if capital wasn't the constraint? That's the reality for most traders. It's not skill holding them back, it's size. Trade the Pool changes that. Step into the U.S. equity markets with up to 200. Meet
guest on the podcast this week. His name is Jesse, but in the Twitter
cast hosted by Aaron Fifield.
For those ready to trade beyond limitations, this is the next level.
Markets, speculation, and risk. This is the Chat with Traders podcast, hosted by Aaron Fifield.
What's happening, guys? You're listening to episode 57, and thanks so much for joining me. I have a really cool guest on the podcast this week. His name is Jesse, but in the Twitter sphere, he goes by Psycho on Wall Street. Chances are you've probably seen him around. A couple things you should know about Jesse. He made $500,000 in 90 days trading marijuana penny stocks and then lost it all just as quickly. He went from part-time to full-time trading and for now has returned to part-time trading. He describes his approach as a hybrid between a day trader and a swing trader. His motive for trading is to one day open a fully functional, no-kill animal shelter, which I think is incredible, and props to him. We discuss all of this and much, much more during the interview, including a deep dive into Jesse's trading approach. Now, if you have any questions whatsoever for Jesse, go to chatwithtraders.com/57, scroll to the bottom of the page, and leave a question in the comments area. Jesse will be watching closely and answering any questions that come through, so go ahead and take advantage of this. All right, let's cut to the interview. Here's my guest, Jesse, or like I mentioned, you may know him better as Psycho on Wall Street. Hey, Jesse, how's it going, man?
It's going good, man. Thanks for asking. How are you?
I'm doing great and good to hear. So let me say thanks so much for coming on the podcast. I have a great feeling this interview will resonate with many traders listening, especially due to the fact you've only been trading a few years now. So you're still very in touch with the challenges that newer traders experience, which I really like. So this is probably a good point to start. Let's talk how you very first got started trading. So what was your introduction to financial markets? And also give us some context about your background prior to this.
Okay, yeah, sure. So my background prior to this, I've kind of a checkered career path. I was a janitor at a Winco in Moscow, Idaho for a couple of years when I got out of college. And then I was a haybuck for a couple of years and drove a truck and just, did heavy equipment. And then eventually, I have no idea how it happened, but about 7 or 8 years ago, I found myself in the software industry and just really got into it and started teaching myself some things. And that's what I do today. I'm still in software, mainly in disaster recovery, replication, things like that. And so I still have a full-time job as I trade. And as far as how I got into trading, my first exposure to the financial markets was from my parents, actually, and it was a big red flag telling me no. Don't do it. It's too much risk. Just put your money in savings. And so for a long time, I never had any desire to learn about it. But as it happens, I had an intern, and he had just mentioned to me one day about some stock called Tesla. And this was back in the summer of 2013, and said that his dad bought a bunch of Tesla and it was going well for him. So I pulled up Yahoo quotes on Tesla and saw I think it was like 100 and some a share at that time, maybe a little bit more. And then I just forgot about it. And a couple of months later, my neighbor, who was a good buddy of mine, we were having a chat one day, and he told me that he opened up an E-Trade account. And that was kind of the first, eye to eye, someone like me who I knew was, starting out and was getting into trading. So that piqued my interest a little bit. So for the next couple of weeks, just asked him what he was doing. He said he opened up an account with like $5,000 or something like that, and was just trying out some things. And so I remember I went on the computer and I looked at that Tesla stock again, and I think it was up like $30 or something like that. And so it finally kind of clicked for me how everything, or at least how you could profit from, being in financial instruments. And so I opened up my own E-Trade account with $5,000, and very first day I opened it, I bought some Tesla stock, and that was my foray into getting into trading.
Sure, okay. And just out of curiosity, do you still keep in touch with your neighbor who opened the E-Trade account, and do you know how he's going to this day?
Oh yeah, well, he's one of my best friends now. He's going to be my wedding actually, and so he still is in the markets. He not so much anymore. He got into the OTC boom when it was hot, and like many others, it didn't end up so well. And I think he kind of lost the zest for it. And he's vice president at his company, and I think his work demands a little bit more time than he has to give to the markets. But he still does things every now and then and gives me updates like, "Hey, I made a couple $100 a day." So.
Right. Okay. Cool. So at the time you were really new to this, what was your first move beside buying Tesla stock, and where did you begin learning from?
So, I mean, I bought Tesla honestly just because it was going up. When you're new, you don't know anything, so you only know every little piece as you go. And so it was going up. So I was like, okay, I'll buy some. It's probably going to go up some more. And so I bought some Tesla, and as far as what I was using, I didn't have I didn't have any charts. I didn't have a desktop platform. I used the web-based trading platform that E-Trade offers. So I didn't even have L2. I just had level 1 quotes, the bid and the ask, and didn't track news or anything. I think the first research I ever did was on the Yahoo message boards, and I think that's what I used as my research tool for like 6 months before I even figured out that there were other ways to learn about stocks. And so I found out that Elon Musk was the CEO of Tesla, and he had another company called Solar City. So that was the second stock I bought. And I think I bought that at $28. And, at this point, I only had, a couple $1,000s I was working with, so I wasn't buying much, but things were going up at that time. So I just bought things that were going up, and it seemed to work at the beginning.
Okay, so would you say you had some sort of beginner's luck for that first maybe 6 months to a year that you were trading?
100%. It's funny because I think one of the challenges today, after you trade, it's kind of like that fork in the road where when you don't know anything, there's no noise to prohibit you from making decisions, if that makes sense. Like, you don't know what to look at or what things could be red flags, fundamentals, trading volume, etc. Everything is very, very simple. But as you learn more, especially as a new trader, you tend to want to use everything to make decisions, and it ends up actually hampering your decision-making skills. So at the beginning, I think that's why a lot of people have beginner's luck, is because they just don't know any better.
Yeah, I think that's really well said, and I can totally relate, because it kind of feels like the more you learn, sometimes it feels like the less you know.
Right.
I know there's a quote that goes something along those lines. I probably just butchered it, but you get the point. So Jesse, you have to share with us your story about trading the marijuana boom. I think that was maybe around end of 2014. It's a hell of a story. If you could start from the start and walk us through it.
Yeah, sure, 100%. It's not a very cheery story I like to tell, but it was a great learning experience, and it was fun, and there were some cool things that happened during it. But I think I had traded biotech and things of that nature along with Tesla because that was hot, in fall of 2013, and I had just gotten on Twitter, and I had found a group of people that were exclusively trading these marijuana stocks, and here's how it happened. So I had some success trading those early stocks with Tesla and Solar City, and so I ended up just wiring more money into my account because I figured the more money I had, the more I could do with it. And so I think at at the beginning, I had wired $30,000 in, which was my complete life savings at that point. Outside of your rainy day funds and et cetera. That was just my savings account. I said, screw it, I'm throwing it all in. And I had gone in big on Omer at the time because it was having a run, and it absolutely tanked on me. I think I probably bought that absolute complete top, and lost like $10,000, and I really didn't know what to do. And so, and it again, beginner's luck. I saw stock OXBT, which was like Oxygen Biotherapeutics, and it had a couple of good days in a row. And so I literally threw my entire account into that. And I think it was like $4 at the time. And I bought, 8,000 shares or something like that. And it ended up going up to like 11 or $12 in the next 48 hours. And to me, it was a huge win, and at that time I was under the PDT rule. And so I bought it and I couldn't sell it for 3 days. I didn't end up selling it till 3 days later, and it was like $7 or $8. But so what I did is after that trade, I quit my job and said, you know what, I'm going to trade full time. And I'm sure a lot of people can relate to that. So at that point, I made a couple of bad trades, and I had cut my account in half, and I was back down to 30 grand again. And that's when I ran into the marijuana stocks, and I ended up, doing the same thing. Screw it, I'm just going to go all in on marijuana stocks. And I kid you not, the next day after I put my account in there, they all got cut in half by 50%. And I didn't know it at the time, but it was just right when marijuana stocks were catching on in OTC. And so they had that first initial bubble. And then the months after is when, everybody was buying weed stocks in the OTC. And so I took that 50% haircut, didn't sleep for a couple of days. And all of a sudden things just exploded. And, I did a couple of, I held some long-term, things that were sub penny that ended up going up to like 30 cents a share. And I ended up, at the peak, my account was just under $500,000 at the end of March, beginning of April of 2014. And that was where I thought that I literally knew everything about trading. I figured that I had it made. I was going to turn that $500,000 into a couple million, that couple million into 10 million, all in the OTC. Little did I know, that there's certain things that you can't do in the OTC, like liquidity problems. A tenth of a penny is quite a bit of a haircut when you have $100,000 in a penny stock. So what ended up happening is I held those stocks because I thought they were going to bounce back up all the way down till my account was at like 100,000. And I, said, no big deal. I can turn this back into it. And this was right at the peak of the OTC going into the summer, and when things absolutely just completely died off. And I was throwing 10, 20 grand at certain stocks and taking $5,000, $10,000 haircuts on them as they dropped off. And I mean, I think I got my account down to like $5,000 before I got it back up to my original 30. And that's when I reached out to Nathan and Michelle at the Investors Live crew and got my head squared on straight.
Wow. Okay. That is quite the story. So let's just break that down a little bit. How long did it take for you to go from, you said your account got cut in half, so I'm presuming it was probably down around the 20 grand mark. How long did it take you to go from that point to actually accumulating $500,000?
It was under 90 days. I mean, I made 100 grand one month and I made 200 grand the next month. And then going into April, it was, right at the peak, just under that $500,000. And then right there, that's when things started to tank. And I, like I said, I thought I had it all figured out, but little did I know, like you have to take some profits. You can't hold on to things. Things don't always go up, they can only go up for so long. And I learned that the hard way.
Absolutely. So then on the other side, how long did it take for you to actually lose that money until you were back down to just $5,000?
Less than 90 days.
Less than 90 days. So how did you handle this? Like, were you in shock at all? Because I can tell you, if I made $500,000 in the next couple months and then lost it just as quickly, I'd be devastated.
Yeah, no, and it's funny too, because I had an old college coach that I'm still friends with, and we were having, he drinks coffee, I drink energy drinks, but we just met for coffee, and we were talking, and he asked me what I was up to, and I said, I'm in the stock market, even though I was, buying weed stocks. He's like, oh, I had a friend who did that once, and he made $500,000 and lost it just as fast. And I kid you not, I was like, oh, that's not going to happen to me. I'm smart, quote unquote. I know what I'm doing. And so when it happened, I was like, I can't friggin' believe this. I let it happen. And I was pretty stressed out. I mean, I think I lost probably about 15, 20 pounds. I was going through like a can of chew, probably 2 cans of chew a day. I don't know. I lived off of chew and energy drinks. I couldn't sleep. And, it was kind of at that point where I was continually whittling away at my count where, I just said, hey, I gotta do something different. I gotta completely change the way I think, because this obviously is not working. And so the first thing I did was I reached out to the person who in the background was telling me and the other people I was trading with that this is not sustainable. And that was Nathan, Xauusd at Investors Live. And we had some heated exchanges too on Twitter a couple of times. I was cussing him out because he was saying, hey man, you better take some profits. This thing isn't going to go anywhere. The top is coming. And I kept on telling me to know what he was talking about. And I didn't know his history. I didn't know he'd been where I had been. So he'd learned the hard way as well. And so as soon as I decided to make a decision, I sent him an email and said, hey man, I just want to know, despite our past, if you'd help me out. I hit a brick wall, dude. I need to learn. And he open arms said, yeah, man, we'd love to have you, love to help you out. Just let me know what I can do. So I joined, and through Nate, I met Michelle, and that's really where I found my home, was in the swing room at Trade on the Fly.
Okay, yeah. And in previous conversations, you have mentioned to me that Michelle Koenig, who was also on the podcast on episode 44, so if anyone listening wants to check that out, really good interview. You mentioned to me in the past that she's probably been the most influential in your development as a trader. If you had to narrow it down to just a few things, what are some of the key lessons you picked up from Michelle, and maybe even some of the lessons that actually helped you get back on track?
Yeah, sure. I think the first thing is that she promoted a very encouraging learning environment for me. So I mean, we all know that, traders have some of the most sensitive egos, when it comes to trading and ideas and whether they're right or wrong. And Michelle really encouraged me, because when I got into her room, I just sat and watched for a couple of weeks, and she sent me a DM that said, hey, what's going on? How you doing? I haven't seen you post anything. Do you have any ideas you'd like to share? And so she kept pushing me to post ideas. And through that, I developed a confidence in trying to develop and find ideas on my own. And, once I got into finding out what chart patterns and setups and things worked for me, she helped kind of put in that foundation. And I think the biggest thing on top of that is that, and you've talked to Michelle too, she's the sweetest person on the planet, but that lady trades with zero emotion whatsoever. She's a robot. And not a lot of people that I know in the trading community are like that. And so that's one of the things that she consistently helps me out with, is that, you're either right or you're right out. The idea is going to work or it's not. Don't try to be right, try to make money. And she's helped me get my emotions in check. And the other person that's helped me do that is Tom Canfield, who's another mod in the room. And those two have probably made the most impact on my trading career.
Oh, that's really good to hear. So just before we move into more about how you trade these days, I think it'd be valuable for listeners if we highlight this, and you kind of touched on it right at the beginning, that you currently do have a full-time job. So I'd like to ask you, how do you juggle trading and a full-time job? Is there any challenges that come with that?
Yeah, I mean, yeah, there are, because when the job calls, you have to put trading on hold. And that's, I think that's one of the biggest things that a lot of new people struggle with. They want to go trade full time. And that's the biggest thing I learned about myself when I did quit my job, was that I wasn't mentally or emotionally ready to have the pressure of trading be my only source of income. And I think that's why I was making emotional trading decisions the way I was. And that's, one of the things that a lot of guys like Modern Rock and Nate, and some of the others preach is that, when you're starting out, you want to have a job to build your bank account and pay your bills so you can trade. And, they have some certain guidelines that they have in their website about what you should probably do before you go full time. And I agree with 100%. And that's one of the things that I've been able to do as I've had a job, is that I've been able to learn how to actually trade and trade properly and not trade all with emotions, because, my source of income is my job and not my trading. And I think that's one of the number one reasons people blow up, is because they try to do this full time too early, and they're just not mentally, or they haven't mastered their emotions enough yet to be able to handle that. And so trading with a job, it actually, for me, is a little bit easier, because I don't have that stress of where my money's coming from. I know where it's at, and I'm able to build my bank account and build my stake while I'm trading. And so the challenges are, unless you have access to a mobile app or you're in front of a computer all day, and whether it's work equipment or your own personal equipment, that dictates, how much time you get in front of the screen. But for a while there, I only had a morning or an hour in the morning in pre-market and an hour in the afternoon at close. And so I would look for setups the night before, and I'd trade them if they were set up properly in pre-market and maybe a couple minutes into the open. And then I'd shut down for the day, and I'd work. And then on my lunch in the afternoon, I'd fire up my laptop, and I'd open it up and see if there were any afternoon setups, and that would be my trades. And so for a while, I was only doing 1 or 2 trades a day. And now, I work from home. My schedule's calmed down a little bit, so I'm able to spend quite a bit more time in front of the computer. And so there's a better balance. Okay.
And is it still a goal of yours to go full-time trading again sometime soon, or are you not as concerned about that anymore?
No, it is. It's a goal, and soon is a relative word. And I think everybody's going to be different. I have a couple buddies who are in their early 20s that are trading full time and absolutely killing it, and I just wasn't ready for that. So for me, it's just going to be to a point where financially I feel 100% comfortable doing it. And for everybody, that's different. A lot of people recommend having 2 years' salary plus a rainy day fund, and at least $20,000 to $30,000 in your trading account before you start. For me, it's just going to be a point where I have some certain numbers in mind financially where I want to be, where I would feel comfortable trading full time. And quite frankly, I like my balance right now. I have a really good split between work, life, and trading, to where I'm comfortable where it's at right now. But if I'm not trading full time in the next, I would say probably 3 or 4 years, then something's wrong.
Okay, sure. No, that's really interesting to get your take on that. I really appreciate you sharing that with us. So let's shift this conversation to how you're trading these days and how you're navigating your way through the market. So Jesse, how would you describe or summarize your trading approach?
It's a good question. I think we talked about it, in another conversation, but there's not really, I'm not a day trader and I'm not a swing trader. I do kind of a mix of both. And I think that's one of the things that again, a lot of new traders try to do is they try to compartmentalize their trading into one style because they see, all these people that you emulate, which is very easy to do when you are getting into financial Twitter. That's where a lot of people start and learn about things, and that's one of the things that I wanted to make clear is that I don't trade a huge account. I'm not a guy that makes $20,000-$30,000 in a day. I have days where I make a couple grand, and that's an awesome day for me, and I have days where I make a couple $100, and I just want to be consistent for a long period of time, because I tried doing the swing for the fences, everything. And sometimes it works, but when it doesn't, it doesn't. And emotionally, it'll blow you out real quick. So as far as my trading goes right now, I tend to prefer to swing trade. And I like short-term swings a little bit better. And when I say that, anywhere from 3 days to a week, obviously in this market, the time frame can be a lot shorter than that. And then I also do some day trading as well. And what I do is a lot of people do scans every night. And I used to do that, but it was a little bit too much noise for me. So now I just do scans on the weekend, and I look for the best setups on a larger time frame. So I'm not focused on the minutia that's going on, on a 5 or a 15-minute candle. Granted, there's some great opportunities within those ranges, but on the weekend, I can find 20 ideas and pick out the 10 best setups. And out of that, I can pick 4 long setups and 4 short setups that I like for the week. And I plug my alerts into my system, get my charts up and my watch list. And so I've got, the idea set on the screen plus the sub ideas and the alerts. And really after that, it's just about, when the alert goes off, then I'm watching a little bit closer. So for me, it's a little bit more automated, and I like it that way because with work, I can't be watching every tick. And so if an idea is working, literally one of the hardest things I'm having a challenge doing is letting it work. I like to take profits quick, especially in this market. And so that's one of the things I'm working on is holding things longer. Yeah, so I would just say it's a pretty good mix of holding things anywhere from 3 to 5 days to, sometimes, an hour or two, depending on the setup.
Okay, cool. So if I understood that correctly, you might only be tracking about 8 stocks each week. Is that right?
Yeah, that's right.
Okay, all right, cool. So when you're reading charts, what time frames are you analyzing? Like, have you found a sweet spot? You mentioned that you don't watch, minute intraday charts like, minutely charts and 15-minute charts. What time frames are you analyzing?
Yeah, so I start out looking at the daily, and one of the things that I've learned from a couple different traders is, so like Michelle, she's a breakout trader. She likes stocks that are breaking out, and that's when she likes to buy them on the long side. And on the short side, she likes to buy them when they break down through the support levels. And Tom Canfield, one of the other guys that I speak with a lot, he also he won't touch anything unless it's based above its 50 and 200 day moving average. And for me, I'm a little bit different. On the long side, I like to buy things as close to near to midterm support as I can. That way I have a clear stop if the trade goes against me. And on the short side, I personally, I like to buy things as close to the top end resistance as I can. So again, I've got a clear line. So what I do is I look at the daily, and then for the 4 that I pick out on the long and the short side that I want to focus on, I zoom the chart out and I look at the weekly and monthly so I can see the bigger picture. And then depending on what the market's doing, I just kind of stock my entry. And typically when I do an entry, for most people, it's extremely small size. Like I might pick up a couple 100 to 500 shares to start. And I do that because if a trade goes against me, I can mitigate my risk with minimal damage whatsoever. And if the trade starts to work out, then I've got a good start and I can start scaling in. And that's one of the things that I do now that I didn't used to do is I scale in. Before I would just, essentially throw everything I could right at the beginning, and it either worked or it didn't. Now I scale in typically in 4 or 5 scales before I have a full position, and that's really helped out my trade management quite a bit, and Nate helped me out with that too.
So let's talk about that a little more, about how you do manage trades, because I know something many newer traders struggle with is knowing when to get out.
Right.
So what's your thought process for actually managing trades and adding to positions and then taking a profit or a loss at the end? Like, how do you decide when to scale into a position?
It's a good question. So if the trade's going for me, let's say, I have a good entry, it's near support, and some of the other indicators I use I use slow stocks quite a bit. And I typically like to buy when slow stocks are as close to being on the long side, as close to being oversold as I can. And that's typically when it's near support and it's oversold. That's typically where I like to do my entry. And so I'll start there. And if it starts working out, I'll add right away. And what I like to do is if I like to wait for a retest. If it retests and holds, then I'll scale in again. If it doesn't retest and it just keeps working, then I'll just keep adding until it doesn't. And typically that's when I start to zoom in a little bit on the trade, just to manage it a little bit better. So instead of looking at the daily or the weekly, I'll zoom in a little bit and look at the hourly and the 15-minute chart to see if I see anything that would cause me alarm, etc. And when I first started out, I was trying to look at 1 minute and 2 minute charts, and it was way too much noise for me, and I would spook myself out. And so now I zoom out and look at the bigger picture. And when I scale in, and I've got full position, and the trade's working, then typically right at 3%, I'll take one of my scales off, and that's what I do to pay for the trade and get a little bit of house's money in the pot. And then the next points are typically 5%, and 5% is really the sweet spot because you can grow a small account really fast with 5% trades consistently. And then and if it holds 5%, then I'll leave it on as long as it works. And if it dips below or looks like it's going to dip below 5%, then I'll take some off and leave just either a quarter or a fifth of the position on, depending on what the size in was.
Okay, and when you say you'll hold on to it for as long as it works, how long might you be holding that for? Like, could it go on for like maybe a couple weeks? And would you just trail a stop behind your, the price by however much, or how are you managing that part of it?
Well, and that's one of the things that I'm trying to learn to add into, how I manage trades. Is it's not how they open, it's how they close. So if a stock closes strong, and when I say strong, that it doesn't have to close at high days, but it has to close, within 5 to 10% of the high day. And when I say that, and I'm talking about the whole move. So if it moved 50 cents, it's got to close within 5 to 10 cents of the high a day. Then I'll keep it on. And if it has a weak close, then I won't hold it overnight, especially in this tape, because you never know what's going to happen overnight. And the gaps up and down have been enough to drive a person crazy. So lately they've just been day and a couple of overnight trades.
Sure. Okay. Yeah, that makes sense. So. All right, so where were we? From my understanding, there are 2 types of setups that you trade or really like to focus on in particular. Could you share some insight on these 2 setups?
Yeah, sure. So typically on the long side, I'm having good success, I would say. I've been focusing on biotech kind of just like everybody else. And really what I've been doing is, I guess you call it range trading. I don't think it's a new term. That's just what I call it. And so I find stocks that are trading within a range, and Modern Rock talks about this a lot. something that's been bouncing between, let's say, $9 and $10 for hours or days, et cetera. And these biotechs have been finding a nice range after this dip when when IBB's been going from 300 to 320 or 340. There's been really good range in there. So essentially, I just focused on a couple of biotechs that have pretty consistent range, and I'll short them at the top of the range and cover at the bottom, and I'll long at the bottom and sell at the top. And I've done that on a couple where it's worked, and I just keep doing it until it doesn't work anymore. The challenge is when it doesn't work, I guess my ego, my stubbornness gets in the way, and that's we were talking earlier about how I've been pretty consistent about having 4 or 5 green days in a row, and then I have one stubborn day where I get spanked, and so that's one of the things I'm trying to avoid. But those range trades, I've been having pretty consistent success with. And then the other one is shorting these the sector rotation. So right now it's the solars. There's a lot of money going into solars, and they got really hot really quick. And so I try not to short the crowded trades. And so a lot of people are focused on Soon and or Sun Edison and Solar City. And I've been trying to focus on the outliers that are less crowded trades, because then the moves are a little bit more natural, whereas the ebbs and flows in these crowded trades are a little bit more forced, and I don't have a very good handle on them. So on these outliers, they get hot and they peak out, and I'm just looking at the chart and finding out where they should have quite a bit of resistance at, and I'll short them and they fade off. And again, that's another thing I've been finding some consistent success with. And prior to that, it was semiconductors, and prior to that, it was China names, and prior to that, it was biotech.
Okay, but you're trading the same type of setup regardless of the sector, right?
100%.
Okay, so I'd like to ask you then, you can now say that these are my 2 high probability setups, and you can say that with confidence. What motions did you go through to identifying these as good quality setups? Like, how did you arrive at this point?
The only logical answer that makes sense is that you make a lot of mistakes. You try out a lot of setups until you find ones that work consistently for you. And for me, it was quite a natural come to Jesus moment, I guess. Is when I got into charting, I scanned everything. I mean, when I did scans, I would scan every night, and I'd look at 500 to 1,000 charts a night every night, because I just figured the more you did, the more you learned. And through that process, my stock watch list went from having 50 to 60 stocks I was trying to watch to where it's at now, where I've got a 20 subset and 8 real ideas. And it came from seeing the same patterns over and over again, and then looking back at my trade log and seeing which ones I was the most successful at. And it's kind of just putting 2 and 2 together. These are the ones that have worked the most for me, and they're also the ones that I identify on my scans the most. So for right now, my goal is just to get really consistent at one thing, and that's my high probability setups. And then, once that becomes a little bit more robotic and automated, I can, try to learn some other tricks.
Okay. I know that you have trading rules in place to keep you on track with your trading. How systematic and strict are these rules, and what do they focus on? Are these rules mainly for sort of position sizing and risk management, or are these rules that actually help you identify the setups and state, these are the setups I trade? And I guess the second part to the question is, what sort of variance do these rules allow for in your trading decisions?
That's a great question. And 100% the rules are in place to protect me from myself. And that's really how I came up with the rules. And when I did my trade review for the year, the number one losing trade and my biggest losses came from when I had it all came on the short side. I never did it on the long side, and I don't know why, but always on the short side. I would fight a trend. I would go in with a plan. I'd have a stop set with a max loss risk, and it would it would go through my stop, and I'd bump my stop up another couple cents, and I'd add a little bit, and I'd do the same thing over and over again until it got to the point where I don't even know how I got there, and I just closed the trade out. So the rules are to protect me from myself. And so when I go into a trade, I have my soft stop and my hard stop. And typically they're not very far from each other. And that's because of what I just said. I tend to be a little bit stubborn because I want to be right. And that's obviously not how you want to trade. You want to make money. So my max loss is 1% of the trade. And a lot of people will say that's stupid or you're not giving it enough room, but I don't care because that works for me. So, if I've got a $500 trade on, my max loss is $5. And if I've got a 5,000 trade on, it's $50. And that, again, that's because I know myself and I'm protecting me from getting myself into a position that I can't work out of. And that's really the rule, is that I have a 1% max loss and I have a soft stop and the hard stop. And before I get into the trade, immediately after I enter my order, I already enter the hard stop in, so I don't leave myself, the freedom to change that. It's set in stone. And what that's allowed me to do is remove a little bit more emotion from my trade, because now it's automated and I have no control over it.
Ever watch a stock rip and think, I could have nailed that if I had real capital? The truth is, many capable traders never reach their potential, not due to lack of skill, but lack of scale. Trade the Pool was built to solve exactly that. A firm designed for serious individuals on one thing: your ability to simply looking for more capital.
Up a little bit and speak about some more kind of general advice for others. So, Jesse, you're very active on Twitter and you communicate with many other traders. Plus, you're also a moderator in Michelle's group for Trade on the Fly. What sort of questions do you often get asked most frequently?
It's a great question. And obviously, because I'm new, I have a lot of new people that are asking me questions, and I think it's because, like we talked about earlier, I don't throw around huge trades. I don't have a $100,000 account. I'm not making $30,000 a day. And I think that they can relate a little bit more to how I trade and asking me questions, and because I'm so new. And I think the thing is, like, the number one question is, how about all these setups? What should I read? What YouTube channels? Who should I watch? Or what room should I join? Or what do you think about this setup? And really what I would say to all the new traders is try to pare away as much of that minutia as you can. Like we talked about, keeping it simple. Like, try not to try and absorb everything at once, because there is a vast amount of trading information and resources out there. And as a new trader, you want to go out and gobble it all up. But like you mentioned before, kind of the more you try to know, the more it can hurt you. So what I would say is, for new traders, they're always asking about, what should I do next? Well, you got to come up with a plan. And so many people come into this thing just like I did. We're like, okay, I've got cash. I opened up an account. Let me start trading. And there's so much that needs to happen between I want to be a trader, to, okay, I'm going to make my first trade. And I think no one focuses on that gap in their path. They all focus on, okay, I've got money. I want to make a trade. What should I trade? And it's just too fast. There's so much that they can do. And, finding somebody that they can work with, that they can ask questions to. And that's not easy, because there's not a lot of people out there that want to do that for free, So trying to find someone, and not just anyone, but the right person for you, is that's half the battle when you're getting started, because trading is pretty much a solo game unless you get on with a prop firm and you're trading in an office with somebody. You're doing it by yourself. There's no class or anything. So finding someone that'll help you, and, joining a chat room, starting one of the services. A lot of people talk trash about it. There's a lot of guff about it online. Even I talk trash about it because there are some ridiculous, paid chat rooms out there that are just extremely detrimental to the financial, the FinTwit, financial Twitter in general. But there's ones out there that, of course, I would recommend paying $1,000 for a year of having access to people who have been doing this for 10 to 20 years. That was the best thing I ever did. If I didn't do that, I would probably still be burning money in the OTCs. So I 100% promote people joining. Now, here's the key: the right chat room, because not all of them are going to be the right one. So invest in that education. Once you've gotten from A to B and you're ready to make a trade, get in a chat room and get in there and just watch for 2-3 weeks. Study the materials that are available to you. Don't just go out there, blazing guns, because you get smacked real hard. Eventually, you could have beginner's luck right away, but there's two types of traders: those who have experienced a life-changing loss, and those who will, and that's it. Those are the only two. If you haven't experienced a big loss yet, you will, and that's the wake-up call. So the number one question I get is, what do I do to get started? And those are the things that I typically end up telling people is, invest in yourself.
Yeah, I think you brought up a lot of really great points there. So yeah, thank you very much. That was a brilliant answer. Now, stepping away from the markets, there's something else in your life which I know you're extremely passionate about, and that's the well-being of animals. So what are some of the issues you feel most strongly about, and what would you like to bring greater awareness to?
Oh yeah, man, I appreciate you asking that. And that's it's funny you say that, because half the emails I get are about, animal awareness, animal cruelty. I get emails. I got an awesome email from a guy that was getting ready. Him and his girlfriend were getting ready to adopt their first dog, and they wanted to, get a puppy. And I told them, puppies are typically adopted out first. They have no problem getting adopted, and the ones that have the hardest time getting adopted are dark colored senior dogs. And they ended up getting, an older dog, which was absolutely awesome. That was, great for me to read, and they absolutely adore their new pup. So, I just have always had an extremely huge soft spot for animals. And, the biggest reason is because, they're oftentimes, they don't have a choice in their surroundings. See, human beings, they have a choice. They always have a choice, no matter what. I honestly don't care what anybody says. Well, they were forced into this. They're a product of their surroundings. I firmly believe that a person is a product of themselves. And no matter what, at the end of the day, the thing that separates us from everything else on this planet is that we always have a cognitive choice about what we do. Whereas animals don't. They don't choose who they go home with. They don't choose who they get sold to on Craigslist. They don't choose what they're bred for. And I think that things are extremely imbalanced right now in the way that we view an animal's life. And currently, it's very easy for people to, just be out of sight, out of mind. You go to the store and you buy some Tyson chicken breasts or whatever, and, you don't know where it came from, but little do you know that, baby chicks are thrown into crushers if they're males because they can't use them to lay eggs, or they've got machines that rip the beaks off the chickens so they don't, because they're kept in such close proximity of each other in those factory farms, they peck each other. And so they rip the beaks off them so they don't peck each other. And, those are just things you don't think about. And so I just felt that if I had an opportunity to reach a broad audience with just kind of, hey, this is happening, whether you want to see it or not, I'm going to throw it out there. I hope you look at it and, maybe think about some of the decisions, or even better, if you see something happening, have action, do something about it. And that's one of the things a lot of people don't know what animal abuse is or how to recognize it, or even how to rescue a dog or a cat properly. So I just, I couldn't go a day without bringing it up just because it really means a lot to me. And quite frankly, that's why one of the driving factors of me getting into trading was because I wanted to open up, a fully functional no-kill animal shelter where dogs could come and they could just live out the rest of their days there if they had to. And I couldn't do that, with a job. So I had to figure out another way to make money, and, just happened to be trading stocks.
Sure. Yeah, no, I think that's a really great cause and motive for getting into trading. I think that's awesome. So what's your involvement? Like, what sort of actions are you taking, like, on sort of an ongoing basis? Are you involved with any causes or anything like that?
Yeah, so when I was in Seattle, I used to volunteer at the animal shelter. I donate to the animal shelter. I donate to the ASPCA. Obviously, I sign every petition that I can get my hands on. And then really, I'm kind of reaching max bandwidth just with that. Once I get some more time, there's some other projects I'd like to get involved in. I'm getting ready to do on Twitter. Actually, I'm putting together not a fundraiser, but a drive to where people can donate to a general fund, whether it be money or dog food, cat food, guinea pig food, blankets, towels, whatever. And we'll try and get it sourced out to the local shelters that need assistance the most. And then other than that, me and the future Mrs. Psycho, we've made some dietary changes over the last year or two to be more conscious of what we're putting in our bodies. We're not 100% meat free yet. And you and I have talked about that. It's something that, we'd like to try 100%, but we get, I would say 99% of what we eat that comes from animals comes from local farming. And is sourced, from an organic location where they've, free range, non-GMO, humane slaughter. That's what you want to call it. They're put down humanely. They live a great life. And, we're working on being completely dairy free. We're getting ready to go. What is it? I can't remember what it's called. I always want to say Episcopalian, but that's a religion. Where it's just, we're just doing seafood, so like fish and clams, crab, etc. And then I think later this year is where we're going to try the completely vegetarian route, and then next year we actually have it on the calendar to try to go vegan for a little bit and see if we can handle it.
Okay, sure. Yeah, you'll have to keep us posted on how you go with that.
Yeah.
It's also something I've been giving a bit of thought to as well in recent times, is actually just sort of reducing the amount of meat that we do consume, because we do eat an unnecessary amount of meat.
Right.
I'm obviously generalizing here, but for the most of us, I actually watched a documentary a few weeks ago called Cowspiracy.
Yeah.
Actually a really solid documentary. Doesn't even focus so much on the cruelty of animals, but just about the impact of sort of farming on the environment. It was really interesting. Not something I'd normally watch, but I'm glad I did. It was a real eye-opener. So, yeah. So, you've outlined a few issues here. I don't know what the proper term is, but actually having animals as pets where they're not treated right, as well as the actual farming of animals. So what needs to be put in place for some of these issues to be either fixed or reduced or resolved in some way?
That's a great question. And I personally, I think that the number one thing that can be changed is, having harsher punishment for animal cruelty, because, all over the country, and you can look up in each jurisdiction of each state and each district, they all have different animal cruelty laws. And in some states, like, it's a $50 fine and, that's it. And in some states, like Washington is getting really good. Oregon's getting better. They have some of the stiffest animal cruelty fines. And, that's one of the things that I like to tweet out is when people get busted. And I hate to say it, but like places like the UK have some of the worst punishment for animal cruelty. But, different cultures that, you can only do so much, but, making a thing on PETA or ASPCA or, any kind of animal cruelty or supporting the ethical treatment of animals where it sends an automated letter to your congressman, that actually makes a difference. A lot of people don't think it does, but they hit a certain amount of signatures and they have to do something in response. And even if it's just, hey, we're writing a bill, it's a step in the right direction. So I think that, they need to step up their game when it comes to punishing people who get their kicks, treating animals like crap.
Okay, so if someone listening right now wants to do something to help, you mentioned there, signing petitions and that sort of thing online. But is there anything else that would help? Like, what's the best way that they could do this?
Oh yeah, no, the easiest and simplest way for people to actually help make a difference is to donate, whether it be money or goods, to their local animal shelter, because in the United States, animal shelters are extremely and severely underfunded. And so $5 like literally helps. Even $1. If you just walk there, once a month and handed them $1, that helps. Because they have, the thing about it is, puppy mills are an epidemic in the United States. Well, I mean, just breeding mills in general. And so pets are overbred to the point where, if they're not sold, they're given away or just let go, and so many strays come in, and they just don't have the capacity. And that's why, the unfortunate ending for a lot of them is being euthanized at a shelter because they don't have the resources to keep them alive. And so if people could donate, just a little bit, yeah, I think the ASPCA is like $18 a month. That's like one of the donorship programs, and a little bit goes a long way, especially if it's done on a mass scale.
No doubt, no doubt. Well, I mean, I think it's an awesome cause you're getting behind here, and I hope a lot of others join you. And I'm glad we could bring some awareness to this. Is there anything you'd like to add before we close this out, or do you think we've covered pretty much everything? For now.
Yeah, for now. Yeah, I think we've covered it. Unless, you had anything else you wanted to ask me, I feel good about this.
Okay, excellent. Yeah, well, I mean, I think that'll do us for now. So do you want to share with listeners where they can go to find out more about you, maybe your Twitter handle? And I know you had a blog at one point. Are you still keeping this up to date?
Yeah, so, the Twitter handle is at Psycho on Wall Street, and the street is with an ST. You can go to tradeonthefly.com, send Michelle an email, or you can send me an email at psychoonwallstreet, all spelled out, at gmail.com. And, I never turned away a question. I typically answer emails on the weekend. So if you shoot me an email, be more than happy to reply the best that I can. And, the blog is active. When my bandwidth got maxed, I wasn't able to post on it as much, but I got a pretty cool email from a buddy of mine that he's holding me accountable, and so I think at the towards the end of this month, I'm going to start doing a weekly recap on the blog. Nothing major, just thoughts and reflection about how the week went, and go from there.
Okay. And what's the link to that one?
It's psychoonwallstreet.wordpress.com.
Okay. And street ST or the full word?
I believe it's the full word. It's been so long that I forgot about it.
Easy done.
Yeah, it's psychoonwallstreet.wordpress.com.
Okay. Well, I'll put a link to it in the show notes anyway. And I'm also going to add... actually, two things I'm going to add. First one is, if you do want to find out more about Michelle's Trade on the Fly, you can just go to chatwithtraders.com/offshore. And for full disclosure, that is an affiliate link. So if you do decide to sign up, I think there may even be a free trial on the site. But if you do sign up and pay for any of the services or products, I will receive a small kickback, but the price is not inflated for me to be compensated. So, if you use an affiliate link, it's a really good way to support the podcast. That's just chatwithtraders.com/offshore to find out more about Trade on the Fly, where Jesse is a moderator there also. And the second thing I was going to add, if you have any questions for Jesse, obviously you can email him and contact him on Twitter, but you can also leave a comment on the website. So at chatwithtraders.com/57, just scroll to the bottom of the page and leave a question in the, learning more about you.
There are more episodes loaded with real market insight and zero hype on the way soon. So to stay updated with each great new release, subscribe to the podcast in iTunes. And we'd love it if you'd leave a rating and review. We'll catch you next time on Chat with Traders.
What would your trading access to ongoing
Podcast hosted by Aaron Fifield.
Okay, what's up, team? Thanks so much for joining me on episode 58. I'm your host, Aaron Fifield, and this week I spoke with Paul Singh. Paul is a long-time trader who has been doing this since his college days. Over the years, he's traded stocks, options, and futures, but now tends to focus purely on stocks. In fact, Paul actually began trading during the dot-com boom and quickly racked up huge profits. He was living large in a penthouse. His neighbors were professional athletes and all was good until the bubble burst, and that's when he shortly after returned to square one. So during this interview, we discussed the light bulb moments and changes Paul made to his trading, which helped him to achieve sustainability and consistency. We talk about how he transitioned into full-time trading, why you should be cautious of micromanaging positions, and overall, how to be a better swing trader. It's worth mentioning there's also something within this interview for day traders because Paul is very active on an intraday time frame too. Now, Paul is also offered to answer any questions you may have. So while you're listening, if there's something you'd like more info on, or perhaps something doesn't quite make sense, go to chatwithtraders.com/58 and leave a question you want answered at the bottom of the page. All right, guys, you're listening to the Chat with Traders podcast. Please welcome my guest, Paul Singh. Paul, how you doing, man?
I'm doing great. How are you, Aaron?
I am doing awesome. And you know why? Because I finally have you on the podcast. I was looking through.
I know. I think you contacted me about 2 or 3 podcasts in when you were doing this. And I had no idea what it was. And, with me, I don't do a lot of this kind of stuff. So, I had it in mind this whole time, but seeing what you've done, man, it's amazing. All these great traders that you've had, some of them are actually my personal kind of idols. So to be even included in this is just awesome.
Oh, thank you very much, man. It means a lot. And I think I was actually looking through my emails earlier today, as some of the emails we've had back and forth, and I originally contacted you. It was over 12 months ago, so I'm glad we could tee this up. It's finally happening.
I'm excited about this.
So I've been hassling you a lot since then. But anyway, Paul, thank you very much for making the time to speak with me today. Now, we always kick this off by starting from when you first got into trading. I'm going to take a bit of a guess here, but I think you were a law student prior to being a trader. You can correct me if I'm wrong, but regardless, share with us how you first got started in trading and what sparked your interest.
Yeah, law school is when I really got into it. I would say college is when I really started trading. I did basically what just about everybody does, where you get into, especially back then. There's more information now, but back then it was all about long-term holds. I started to do that, and I realized, I'm not making money. I don't want to look, 30 years down the road. So that kind of led me to trading, and I noticed a few things. Back then, everyone was getting into Microsoft, and I think it was Oracle, and this was the 90s. I'm 40 years old now, so this is back when I was in college, and I noticed there was a stock called Xauusd, which was a local clothing company, and I got that just because it was a local company, and that thing ramped up. and these companies that everybody knows about didn't. And that kind of sparked my interest that, hey, maybe there's another way to play this. So I always had that in mind. And then, yeah, when I got into law school, there was that internet boom. And, it was awesome while I was in it, but it was probably the worst time to learn about trading. Because basically you didn't need to know anything to make money. And the problem is that was awesome while you're through it, but it wasn't going to last. So I actually started, my first year of law school, I started with $5,000, and that thing ran up to almost $200,000 in a matter of months. It was about 2 or 3 months. And I'm thinking, hey, who needs law school? I'm going to be a millionaire here. I've already made 200,000. I got an expensive apartment. It was a penthouse I had professional athletes were my neighbors and living large. And then reality hit when that boom went bust. And basically that 200,000 went, slowly to 100,000 to 50,000 back to nothing. So I like to look at it to make me feel happy that I only lost $5,000, which is actually what I lost. But it was up around 200,000, about 185. So that was a wake-up call. And then I kind of went back and forth. I was busy, with law school and, starting a career. But I always came back to trading. And the second time, now this is my second time blowing up an account. So that was my first time. Now I came back again. And this time I'd done a little research. I read some books, and books aren't going to tell you a whole lot. They can give you a basic foundation. And it wasn't like today where you have access to everything, all these great traders and mentors. Back then it was really difficult in the 90s. But I started trading. I started to put some of this stuff in practice. I didn't still have a fully kind of functioning trading process, but I did trade it much better. I ended up blowing an account again. So any of you guys who are having problems, it's really all about perseverance. You're going to go through these periods where you blow up an account or two, and it's really kind of your learning process. So I blew up 2 accounts, and went back and forth with trading, and then it was that third real attempt. This was probably now 2004, 2005, somewhere in there, where everything really started to click for me, and everything I was learning kind of came together. And again, I started with, it was always $5,000. I started with $5,000, and it was I was an attorney at this time, so it was a 5 or 6 year process of this part-time trading, swing trading around my job. And it took about 5 or 6 years, slowly grinding it out. I had a different mentality about trading. It was no longer hitting that lottery. I still kind of had that in my mind from that first time when I was in the middle of that internet boom. And this time when I traded, there was another boom. There was a commodities boom. And there's always something around the corner. And this time it was a commodities boom. And this time, because of my experience with the internet boom, I knew how to handle it. And I actually kept my profits. So it was really just grinding it. It took me about 5 or 6 years then. At about 2011, I broke and went full time.
Okay, so 2011, what year did you get started? Like how long in before you actually did make that jump to go full time?
So I would say, I was trading from the late 90s. I would say I got really serious. And when I talk about that light bulb moment, that's when I really got serious and about trading. That was around 2005, 2006. So it was about 6 years.
Okay. So in the space of about 4 years, you'd mentioned that you'd blown up about 3 accounts.
Yeah.
Why do you think it was that you kept pushing on and kept trying to make something of this whole trading thing?
I think it was a challenge for me. It was something, once I get into something, I just go full into it. And that's just been my mentality with everything, where I just don't give up. Sometimes that can be good. Sometimes it can be bad. And with trading, and you have to love it too. And I love trading. So, it was interesting to me, and I wasn't going to give up. I probably came close a few times. But always, just kind of push through. And I think part of it too is I was seeing progress. So, the first time, that was just dumb luck, and I knew I wasn't trading well. The second time, I actually saw that I was improving as a trader. And when I blew up that account, I could identify exactly, what I was doing wrong. And then I said, okay, you know what? I don't need to give up here, because I know if I correct these mistakes, I can be a successful trader.
Okay. So tell us about the point when you actually felt confident to go full time. Like, what was it that made you feel comfortable that you could now rely on trading for a full-time income? Was there anything that convinced you that you're like, okay, I'm safe now to take the leap?
A couple. One, I'd been profitable every year since then, so that was comforting. Two was I really waited until I had enough money where I didn't have to worry about, you don't want to be trading to pay the rent. And I was really patient. When I turned 5,000 to 100,000, that was the first time I actually seriously thought about going full time. I looked at the finances. I just thought to myself, you know what? I know if I break off here, I'm not going to be trading properly. I'm going to be thinking about how much money I need to be pulling out. So I made the decision when I go full time. I don't want to have to take money out, or if I do have to take it out, it won't really affect me. So I basically just kept trading until I knew I'd be comfortable with the amount I could trade.
Okay, so you said at the start of your answer there that you had enough money. How much was enough money? You don't have to give us a dollar value, but like in terms of covering your living expenses, how long did you allow? Like, did you have enough money sitting in a separate account from your trading account that would support you for 2 years if you didn't make any money over that time or something like that?
Yeah, so, I think it's a little easier for me because, my wife works, she has a good job. We have quite a bit saved up. So in that regard, I didn't have to worry about it too much. But the entire time I was thinking, if something did happen and I needed to take money out and rely on my trading, I would need at least mid six figures. And that would hold me over for 2 or 3 years. And I think anybody going full time, I think that's the biggest mistake people make, is not having a big enough account. And you realize, you think about it while you're working. Yeah, I can break off here. But you don't realize until, and even with me, where I knew I had that safety net of a savings, I had a savings, then my trading accounts, and then, my wife works. So that's all good. But even still, with all that and realizing that if I traded badly, I wouldn't be on the street. Still, when I gave up that paycheck, it was very difficult. Knowing that my only source of income for me personally is my trading, it was difficult. So for anyone listening who's thinking about this, and you're thinking about that dollar amount, it has to be, you have to think about where will you be. And it's not always just covering your expenses. It's more of a mental thing. Sure, okay, I have enough to cover my expenses, but where will you really feel comfortable mentally, where you're not even thinking about, your expenses while you're going to be trading? Because once you do that, it's going to be you're going to start making poor decisions. And as traders, it's all about decision making. It's not like sometimes I look back at when I was working full time. And I had that paycheck, even though you are making decisions, you're still going to get your paycheck. But with trading, every single decision you make affects the outcome. So it's a decision-making game. So you want to do everything you can to make sure you're making good decisions. So, I would say whatever you're thinking about in terms of how much to use, maybe even double that amount so you'll feel comfortable.
Right. I think that's some really great advice there, Paul. And you said that when you did go full time, you experienced it was very difficult. What were some of those difficulties there? Obviously, you outlined that the decision making, impacts whether you make money today or not. But were there any difficulties that you weren't expecting? Maybe things that other people who may be thinking of going full time should expect?
You know what got me, and I never expected this, is just the boredom. I wouldn't say the boredom for swing trading, if you're swing trading full time, because what I was used to is having so much to do in the day and then fitting in my trading through that. So I was always doing something. And now, I'm sitting in my office and, with swing trading, I'm holding positions anywhere from 2 days to 3 months. And once I've put in my trades during the trading day, there really wasn't a whole lot to do. and you almost feel like it's really all mental. You know logically that you're doing the right thing. These trades work out. You're going to make money, but you're sitting there and doing nothing, and you just feel like, what am I doing now? How do I fill my day? And that's not something I ever expected. So I got into day trading at that point. So now I swing and day trade. I'd never day traded before, but that was kind of the impetus for me to start day trading. And coincidentally at that time, Kunal, who I'd mentored in the mid 2000s, I didn't even know this, but he had his own big website he's created, and you've interviewed him in the past. He a really good trader, and he contacted me out of the blue, and it just happened to be perfect timing for me, just helping me fill out the day. So that's something I would recommend to anybody who's going to go full time, is really think about other things you can be doing, because what you don't want is, one, that mental idea that you're just sitting there doing nothing, and two, for a swing trader. And this is why part-time trading is great for a swing trader, because you're not sitting there watching every tick. And when you're swing trading, there's a lot of back and forth, and some of the pullbacks are, on the way to your target. You can start, it can start playing with your mind. You pull out a good position just because you're sitting there watching everything, maybe on different time frames. So if you have something else to do, that really helps in terms of allowing you to play out these swings the way you'd want to.
Okay, yeah, that's a really great point that you bring up, and I can see how a lot of people actually wouldn't expect that, like you mentioned there, especially as a swing trader, because really most of your work is done before or after the market closes.
Exactly. I always thought when I talk about swing, the perspiration, the hard work is done post-market, in the evenings, pre-market. That's where the hard work is done. I would say that the easiest part, if you're doing it correctly, the easiest part of the whole trading process is actually putting on the trade as a swing trader, because you've already you know exactly what you're looking for. You're basically just waiting for the setups to emerge, and when the stock hits that price, you're going to get in at that point. So the intraday stuff you're doing is actually, as a swing trader, the easiest part of trading. The hard part is later in the day, when you're figuring out the market, sector analysis, the setups you're going to trade. That's the difficult part. So yeah, those market hours are actually the easiest part of trading, and the part you kind of need to fill up with other things.
For sure. So Paul, before we get into more about how you're trading today, I really want to ask you, maybe if you can summarize for us, what changes in your earlier years did you make to your trading which led to the greatest improvements? Like any aha moments that really changed the game for you?
I realized that trading is more than stock picking. That was the light bulb moment for me. And you see this all the time, whether it's day trading, swing trading. You can have a bunch of people trading the same stocks, but some people are profitable and some people aren't. And why is that? And I've broke it down to 3 different areas. So basically you have the stock picking and the setups. And actually that is the least important part when it comes to trading. And then 2 is the risk management, and 3 is trade management. And the part that you can teach just about anybody, I would say even in a month or 2, if you've got average intelligence, most traders have studied other things, and, studying to be an engineer, a doctor, a lawyer, finance, whatever it is 10 times harder than learning the actual setups of trading. So you can learn that very quickly, and you've probably seen this all the time, where there's a bunch of trading trivia buffs or knowledge buffs that know everything about trading. I know guys who can name every single candle pattern out there. And I could, if I had to name them, I could probably name 5 or 10. But that's not what's important. It's knowing how to trade. So the setups, I would say, is 1/3 of it. Risk management is 1/3. That's another part that's easy to teach somebody. Just understanding probabilities, understanding risk reward. Not really difficult. Some people have trouble applying it, but in general, most people can get that down. So it's those 2 aspects. And then there's trade management. And trade management is what separates winning and losing traders, mostly because that's where the whole mental game, psychology, comes into play. So this is what we're talking about. Once you're in a trade, micromanaging your positions, where the fear and greed comes in, taking too small of a profit, allowing your stops to get too loose. All this kind of stuff is all based on fear, greed, and it's really related to how you manage the trade. So I think that's the area where most people have to work on. And that was it for me. When I realized that, and I realized that it's not all about stock picking. It doesn't even matter. You could give me a stock to trade. And if I know how to manage it, manage the risk, and then manage the trade, I can probably make money without even having a setup for that stock. So that was really my light bulb moment.
Okay, very well said. I like that answer. All right, Paul, well, let's talk about how you're trading now. So if you can, take a minute to explain your style/methodology of trading.
I've been through so many styles, and with swing, I would say the overall idea for me is taking like complex ideas and making it as simple as possible, because we've talked about decision making, and you see it all the time where people have all these different things they're looking for, and it becomes really hard to make decisions based on them. So overall, I try to make it as simple as possible, and then I've kind of laid it out for myself where I've got a basket of, say, 10 or 15 different setups that I trade regularly. And basically, the style then is adapting to what's going on in the market. So I'm very focused on what's going on in the market, what's going on with sectors, basically tracking money flow. So I want to see where the big boys are going, kind of tracking that, and then kind of jumping on their backs. So whatever setups are working for that is what I'm going to trade. And one common question I always get asked is, what is your favorite setup? And I usually don't give them the answer they want, because my answer is I don't have a favorite setup, or my setup is what's working today. And the setup that's working right now is not going to work 6 months from now, and might not have worked 6 months prior. But, the setups I was trading in 2008 don't work now. In the market we're in right now, if I say breakouts are my favorite setups, the market we're in now, breakups, almost every breakout is going to fail. So you need to be adaptable. And I would say that is kind of my overall strategy, where I'm really paying attention to the market, how they relate to stocks. I've got these setups, and basically, like someone with a tool belt, you've got all these tools, and knowing when to pull out that specific setup that will work in that market.
Okay, so 10 to 15 setups. Are those setups that you've kind of discovered over time, or have you always traded that amount, like 10 to 15 setups?
It's always developing, yeah. And to be a successful trader, you'll see traders who will do good for 1 or 2 years. They develop this awesome setup, and then inevitably, in a few years, it's going to stop working. Because of the market, maybe because people have figured out this setup, and then you have to develop more and more setups. So yeah, starting, way in the mid-2000s, I was almost exclusively trading breakouts. That's all I did, either breakouts or breakdowns. Then and that was mostly in commodities when they were all ramping up. And then after that, the breakouts weren't working as well, so it was breakout pullbacks. So I added that to the list of stocks I was trading. Then it was moving averages. Everything was based around moving averages. And if you're trading now, you're probably noticing that all this moving average stuff that used to work so great way back when is not working quite as well now, or there's different variations. So you always have to be studying and seeing what's working now. Now, whoever the market makers or the algos are, they know everyone's trading on these moving averages, and we'll just stop them out underneath. So you can game that and now kind of figure out how to play the moving averages differently. So yeah, it's kind of a process where you're constantly, adding new setups according to what's working in the market. So, 6 or 7 years ago, a setup that I use a lot now is remounts, especially in a market like this. So basically, a stock will go below a moving average, and a lot of times it's stop gunning, and then it'll remount that moving average once everyone's been stopped out. That's a trade 6 or 7 years ago, I would never have done, had no idea about it. But now that's what's working for me. So yeah, these setups are constantly developing.
Okay, so what markets are you most active in? Obviously, you trade a lot of equities. Are you also still active in futures or commodities?
Not anymore. I used to trade commodities and futures. Now it's exclusively stocks.
Okay, and is there a reason for that?
You know, I have a belief that you have to master what you're doing. So basically, if you have too many things you're trying to learn, it's just too difficult. You really want to master one area. So for me, you know, I used to do options and trade futures and this other stuff, but now I feel like I've mastered this area, so I'm just sticking to that.
Right, and was there any reason why you leant towards stocks and equities over going exclusively to futures?
You know, part of it I think is the fact that they're structured hours. I would find that, you know, with if something is trading around the clock, I feel like I always needed to be doing it. And I just didn't like that. So even, you know, I've dabbled in pre-market, and I'm actually every year I set a new thing to study. And this year it's pre-market trading. So, you know, I do branch out in different things, but maybe I think more than anything, it's the defined hours.
Okay. So what is it about the pre-market that's appealing to you right now?
Well, you know, I think part of it is I'm doing more day trading, and I trade a lot at the open, and I started to see that pre-market activity, when trading past the open, you see these areas pre-market that have an effect on the post-market trading. So I started watching it for that reason, and as I started watching it, I started to see these setups kind of emerging. And with me, usually I like to learn things on my own, so I'm sure there's some strategies out there. But with me, I start watching something, and then if something starts to come to me, I start to see these patterns, I'll start working at it. And that's kind of what I'm doing now with the pre-market trading.
Sure, okay. Yeah, that's really interesting. And I'd like to ask you, what role does technical analysis play in your trading? I see you overlay a few indicators on your charts just from skimming through your blog. How do these help you?
You know, I guess it depends on how you define technical analysis. If we're talking about indicators, I was very indicator based in the beginning, and I've moved. I think as you get more and more experienced, you realize you don't need them quite as much. So now I'm based mostly on price action and volume, and that's basically what indicators are measuring anyway. So I think I can see just by looking at the chart without the indicator, I can see that. So, you know, I get asked all the time, like, you know, what is your Bollinger Band strategy, or how are you using stochastics? And really, I used to use Bollinger Bands, and I've taken those completely off my charts now. I still keep stochastics on, just to kind of confirm what I'm seeing if I think something is oversold or overbought. But really, as I've progressed, I'm using less and less indicators, and I liken it to this is almost in every field, where when you're a beginner, and even when you're a successful beginner, you're looking at things in a more complex way. And as you progress and become an expert, you really learn to simplify and tune out the noise and what you don't need. You see this if you're into art, where you see a lot of painters, when they first started, a lot of lines, a lot of unnecessary stuff in a painting or a drawing. And as they progress, you see less and less lines, but the lines they use have much more of an impact. They know what is going to have an impact, what is useful and what is not. And it's the same thing with traders. You see this all the time with traders, and a lot of traders I've worked with, where in the beginning, you know, they've got layers and layers of indicators and moving averages. I've seen people using 10 different moving averages, and you can't even make sense of where you should go with this. And it's really been a process of taking things off rather than adding things.
Sure. Okay. Now, just when I mentioned your blog there, I also remembered that when I was on there, I saw a phrase that kept popping up over and over again, and that phrase was set it and forget it.
Yes.
Could you expand on why this is relevant for traders, and maybe talk about the subject, which I think it ties into very nicely, of micromanaging?
Exactly. It's all about micromanaging positions. So you can go in, and this happens a lot with losing traders. And again, we talked about the trade management aspect where you can have the perfect stock. You've managed your risk properly. You've got the perfect plan going in. Say stock X is at 100. I'm going to get out at 115. That's where resistance is. I'm going to get out at 95. So I've got 3-1 on my reward to risk. You go in with the perfect plan. And then what happens once the trade gets executed? You start watching every single tick. And maybe you start watching a different time frame. And on that faster time frame, something looks meaningful, but if you think about it on the time frame you were looking at, it really wouldn't have had an impact. And that's where the set it and forget it comes in. You basically have this plan. You've done the hard work already, and we were talking about this. The hard work is in the preparation. So you've done the hard work. You know what you should be doing here. So you set the trade. You have it laid out, and then really just forget about it. And that can be hard when you're a full-time trader and you're watching every tick. So it's good to have other outlets. And, for me, it was day trading. That gets my mind off the swing trading. But you need something else so you're not watching every tick. And that's why actually it can be easier to part-time swing trade than full-time swing trade because whatever you're doing outside of trading gets your mind off it. So set it and forget it. And that's, I think, the biggest trading leak for traders is micromanaging positions, where a number of ways you can do it. One is the stock moves against you, and we talked about fear, and fear is one of these biggest motivators for us here. And the stock moves. You had that stop at 95, but it gets down to 97, and you just pull out of what really was still a good position. That's just the natural volatility of the stock. Same thing with taking profits. Way back when, the way our minds are developed is to take a quick profit because, it's kind of the antithesis of what we should be doing as traders because the way we've been hardwired, going back millions of years. So, instead of waiting till 115, we get out at 105. And, with usually, if you're swing trading with a 1-to-1 reward to risk, you're not going to be a successful trader. So you really have to get that kind of set it and forget it mentality in mind. It really helps in your head. Try not to watch every little tick. And you can be great at picking these stocks, but if you can't trade them, if you can't get past this your own psychology, you're not going to be a successful trader.
Absolutely. So let's unpack this a little further. Could you share with us what is on your plan before going into any trade? So what are some of the things that you're setting before you even get into the trade?
Okay. Well, starting from the beginning, the first thing I do is do a market analysis. So, I'm seeing what the market's doing, and, the saying is what 70 or 80% of stocks move is the market. So I want to be in stocks that are generally, unless it's earnings based or something like that, I want to be in stocks that are in line and leading the market. So I'm looking for that. Every week I do a sector analysis to see where the money is flowing. We talked about money flow. I'm really focusing on that. And from there, I'm building an overall watch list. Again, this is for decision making, narrowing down those thousands of stocks that are out there into something manageable so you make better decisions. So I try to keep it anywhere from 50 to 150 stocks, depending on how the market is. So I've got that initial watch list that I'm looking at daily, and it's constantly changing, depending on what stocks are moving on a daily basis. So it's pretty organic, but I've got that overall watch list. And then going into that trading day, I'm taking that list, and that list is not full of stocks that are right at, the entry level that I want. They're setting up, and I'm kind of stocking them, a lion would stock a deer. It's kind of the same thing. You're watching these, waiting for them to set up. And then every evening or in the morning, I'm trying to narrow it down to 5 to 15 stocks, somewhere in there, that I'll be watching during the day to see if they set up. And with every one of these stocks, I have a plan written out where I have the entry range, I have the stop range, and I have my target range. And this really helps with the position sizing. And this is a really simple thing to do. And a lot of traders don't do this. So they get a stock they want to buy, and it hits the price they want. And, they kind of panic. They want to jump in. And they're having to think, okay, what is my position size? What do you know? And it leads to bad decisions. So I have that laid out beforehand. I know, okay, I only want to risk $1,000. So if I have a $10 stop, I can only take this many shares. So that's all laid out already for me. I know the position size I'm going to take. I know where the price needs to be. I know where I'm going to put my stop, where my target is. And it's all ready for me so that then when that happens during the day, now there's some things that could change what I'm looking at. So it's a guide. Maybe something happens where the market is not doing what I wanted to do, something in the sector, or whatever it is. So it can change, but at least I have that framework that allows me to make less decisions when it's time to trade. And then it actually becomes very easy to make the trade, and there's no anxiety. And that's part of the problem. I think a lot of traders, when comes time to make the trade, they have anxiety. Because they're having to process all this stuff. So I try to make it so I have to process as little as possible when I'm actually making the trade.
Okay, I think that's a really great answer. When you say you write it out, how are you doing that? Is it an Excel spreadsheet, or do you have some other software, or are you actually writing it pen and paper?
You be in a journal, and now it's an Evernote. So that's basically all. Yeah, it's nothing complicated where I'm creating spreadsheets or anything like that.
Okay, Evernote, very cool. All right, so I know an ongoing challenge for many traders is, where should I put my stop?
Yes.
Can you shine some light on this? Like, what's your rule of thumb or guide to placing stops?
Yeah, a common mistake that traders make is they're only thinking, if they're using risk analysis, they're only thinking about their risk. And, you have to take into account, one, the natural volatility of a stock. If a stock is not just going to move in the direction you want it to, or if it's going to get to a point, it usually doesn't get up there in a straight line. It's going back and forth. So I always take into account how volatile the stock is. I used to just look at, this is going back, to 2005, 2006, when you could do this. I would just look at where, say, a support level is, and I would place my stop right there. And the problem with that now is these methods have become so common that everybody is doing that. So what happens, you see this all the time, stops get taken out, and then the stock will move in the way you think it's going to move. So what's really, in the last few years, what's really become key to me is not only thinking about my own risk, thinking about where support levels are, but also thinking about where everybody else is placing their stops and making sure I'm not placing it right at that level. So I think right now that's I think the biggest flaw a lot of traders currently are making is they're thinking exactly like everybody else is, and they end up having the same issues that everyone else does. So I would say think about that when you're placing the stop. Where is everybody else placing it? And don't place it at that level. Another thing I'll do is, if I feel like there's going to be stop gunning, I'll wait for it to happen. I actually won't enter it where I was planning to enter. I'll wait for that stop gunning, and that's why I do a lot of this remount trading now. Is I'll wait for everyone to get stopped out. Then once it remounts that level, then I'll actually enter. So I don't have to worry about that so much in entering the stop.
Okay, so just two things off that. Taking an approach like that, which you kind of describe as the remount approach, is there some risk that you may actually miss the move?
Yes, and that's happened to me a few times. So yeah. So there's a couple of ways to play it. You can take sometimes I'll take a smaller position and allow myself to hold through the stop gunning, and then that way, if it does move without the stop gunning happening, at least I'm in it. And I can always add to it later if the trade is working for me. So I'll enter a half size position, let the stop gunning happen, and make it a full size position, or add to it later. But yeah, I have missed moves because of that. But I think overall, right now, it's a really good strategy to use, and I'm sure this is going to get figured out pretty soon, and then we'll I'll adjust and do something else.
Sure. Okay. And the other thing I wanted to ask about was, you said that you take volatility into consideration for where you place your stops. Do you have some sort of rule of thumb for that, or is it really vary for each different stock?
I used to be very objective about this, and I'd look at ATR and different volatility measures and then calculate that. And through experience now, it comes with experience where I just look at it and I can see the price action and have a good idea of where I need to place it. Basically, just looking at the price action now. Before I was using other measures like ATR and other volatility measures.
Okay, and is that something you might suggest for traders who are less experienced, who maybe don't have quite that level of feel for the market, for how they place their stops, like to actually calculate a formula?
I would say if you can start eyeballing it, I know most people like something objective, but even when you use these objective measures, they're not any. But for me, they weren't any better. I actually went back and analyzed it and saw, is this working for me? And I found it wasn't adding anything to what I was doing. Basically, it's very simple. If you're trading Netflix usually has a $4 to $5 range, intraday range. Which it doesn't right now, but let's say it has a $4 to $5 intraday range, and you've put your stop at 2 points away. Very simple. It's common sense. There's a good chance you're going to get stopped out. So I would say just it comes with experience. We always talk about pattern recognition. The stuff comes with time, just working at it every day, and you just start to see things.
Ever watch a stock rip and think, I could have nailed that if I had real capital? The truth is, many capable traders never reach their potential, not due to lack of skill, but lack of scale. Trade the Pool was built to solve exactly that. A firm designed for serious individuals who want access to the U.S. equity markets with meaningful buying power, up to $200,000 without committing their own capital. Get access to virtually every stock and ETF. Go long or short freely with the flexibility professional traders expect. You're evaluated on one thing: your ability to manage risk and execute with consistency. Meet the standard, and you trade at scale. No subscriptions, no ongoing commitments. Whether you're still refining your strategy, a trader with experience who hasn't yet broken through, or a seasoned professional simply looking for more capital, Trade the Pool is built to meet you where you
often ask, especially swing traders, how do you react when, let's say, okay, so just as an example, you're in a long position, you've been in it for a few days, then all of a sudden shit hits the fan in China. You know the US market is likely to have a sharp sell-off in the upcoming session. What do you do and how do you react to this?
Yeah, and I've been through that. And this last year, it happened with Google. And when I was holding through that, I got a ton of people telling me I was crazy to do that. But first of all, if you're trading part-time and you have a hard stop, there's nothing you can do. You're going to get stopped out, right, when it gaps down. But if you can be kind of watching it, if you've got your job, but you can kind of monitor, especially with cell phones and all that kind of stuff, you can monitor a little bit. Or if you're trading full-time, what I like to do is have a mental stop, and I call it basically, the gap down strategy, where you see a lot of times there's overreactions to this stuff, right? Something happens in China, and we were talking about fear before, and there's your personal understanding your own mental makeup and fear, but it's also very important to understand the fear of them in the market. And oftentimes with this stuff, there's going to be an overreaction. Something happens over there that has nothing to do with the stock you're trading, but there's going to be an overreaction. And a lot of times with these overreactions, pretty quickly after that initial overreaction, people come to their senses and say, wait a minute, this isn't affecting us here. Why was I so worried? And that's kind of happening right now. So when something like that happens, what I'll do is, even if it's obliterated my stop and now my risk reward is all screwed up and I would want to get out, usually that's the worst place to get out. And that's where all the call them weak hands, that's where they're getting out. And if you can sometimes stick through that, there comes a point where you have to get out. So what I'll do is I'll watch that gap down and then I'll give it a little room. And if it can hold that level and then bounce back, I'll stick with it. And maybe I get part of, the gap down back, or maybe it'll reverse completely. The August 24th sellout sell-off was the big one. So I was in Google and Amazon at that point, and they looked fantastic. Both of them had blowout earnings. They broke out at really nice levels. And in the Bulls on Wall Street trade report service, I give trade alerts to all the trades. And so I was in that, and a number of members were in that trade. And the market, gapped down, and it took these guys down with it. And that's the exact strategy I used with that, where it had obliterated my stops, where my stops would have been if I had a hard stop, but I did have a mental stop, and I just held through that level, and they bounced back and ended up being big winners. Where there was a lot of panic there, and a lot of people just jumped out right there without even thinking. And part of that is, one, people are thinking about the risk. But part of it is this kind of fear, and again, the mental makeup, where I don't know if you've ever experienced this, but sometimes on a losing trade, you have all this anxiety, and once you get out of that trade, there's a sense of relief. Even though you've had this big loss, just being out of it makes you feel good. John Tudor Jones, a great trader, talks about this all the time, that traders are always looking to increase their happiness. And sometimes doing something stupid and just getting out of it, while you should be pissed off about that, really you feel good. Somehow it makes you feel good. And that's what happened to a lot of people during that period. So I would say anytime something like that happens, stay calm, don't panic like everyone else is, and have this process in mind. So you should have this preparation kind of laid out. You should know. It's like, a lot of, sports athletes. They practice and practice for every situation that can happen. That's why the good teams are so good. You see their attention to detail. So you should have laid out, if I have a gap down here, how do I handle this? And you want to get to the point where when that happens, I talk about this with my wife, talks about this, where she says, I don't know if you've had a winning day or losing day. You sound the same all the time. And I record videos in the morning for all my members, and it's the same thing. They'll tell me, just recently when this big gap down happened, you don't sound panicked at all. And it's because of experience. I've been through this many times, but also I have this process laid out where I know exactly what I'm going to do. I'm not really thinking about it. I've simplified this whole thing, and I know exactly how to react to this.
Okay. Another really great answer there, Paul. Let's do one more question before we wind this down. I know you've got family visiting, so I don't want to take up too much of your time, but I think this question is going to tie in with that last one really well, and it is very important. How do you juggle positions between longs and shorts, being mindful not to have too many positions in one direction? Is this something you're mindful of, or really not bothered?
I don't worry about balancing it usually, unless I'm unsure of the market. But generally, I'm thinking about the market, and then I'll have a bias towards what I want to do. So right now, let's take right now as an example. We've had, because of China and oil, we've had this huge rundown, and the market is extremely oversold right now. So I'm thinking about longs because of that. It's a tough time here to get short. So I have a bias in terms of what I'm looking to do. And then if we get a little bounce, depending on how the bounce is acting, how stocks are reacting, maybe at that point I say, okay, we've had a little bounce here, and now I can initiate some shorts. So I'll be taking more shorts. But in terms of actually balancing the counts between long and shorts, I don't do that. A lot of times what happens is people have this idea that they should be balanced, and what happens, and you basically break even. So you have to understand the market and be able to analyze that and know kind of which direction you should be trading. Okay.
Very good. All right, Paul, well, seeing as we're right into 2016 now, I know your goal for the year is to get more involved in the pre-market action. Do you have any tips or pointers for others about how to set goals for the year ahead?
Yeah. A lot of times people have goals, but then they don't have a plan on what to do to get to that goal. So with everything I've done, going back to my part-time trading, I had a plan of what I was going to do. And just something simple like this, my goal for 2016, one, I keep it very simple. Every year it's one thing, and I want to master that thing. So when you're setting these goals, think about mastery, not learning, haphazardly 5 or 10 different things. Focus on 1 or 2 things and just master them. So with me, it's pre-market action. So I'm actually getting up a little earlier now where, the market here on the West Coast opens at 6:30. I used to get up at 5. Now I'm getting up at 4. And I'm spending that time every day just immersing myself into mastering pre-market trading. And I've laid out a plan of how I'm going to do it and the kind of the things I'm looking for. So keep it simple, have a plan laid out, make it actionable, and then look for results. So every month I'm reviewing how I'm doing. So right now, I'm not actually trading what I'm seeing, but I'm jotting things down. That's my first step. I'm kind of jotting down what I'm seeing and getting an idea. Then my next step will be paper trading. I know a lot of people kind of poo-poo paper trading, but I think paper trading is a really good learning tool. So my next step, incremental here, will be paper trading. And then once I'm good at that, then I will go to actually really trading it. And I've kind of got a 6-month plan of getting to that point.
Awesome. Love it. All right, Paul. Well, it's been really, really good to have you on the podcast. Thank you so much for doing this.
Oh, man. Thank you for having me.
No trouble whatsoever. I'm glad we could make this happen. Where can listeners go to find out more about you?
Okay, so bullsonwallstreet.com, it's Kunal's site. I run the swing trading portion of that. So you can just go to bullsonwallstreet.com. If you're interested in swing trading, part-time trading, just go in there. There's a free trial, and you can contact me. You can contact Kunal. We answer everything back. So you can see me there. And then I also have my old blog, which I keep updated, and that's themarketspeculator.blogspot.com. And you can contact me, through any of those means.
Okay, and you're also on Twitter as well. What's your handle?
What is my handle? Paul J. Singh. I'm pretty sure it's Paul J. I go on it every day, but I don't remember my handle. I think it's Paul J. Singh.
Okay, sure. Well, I'll make sure to include all those links in the show notes at chatwithtraders.com/58. And I'll just point out to do this at the very beginning. I've got to work on that. But are you open to answering any questions that listeners may have in the comments section of this interview?
Oh, definitely. Yeah. Throw anything you're thinking about, any questions you have. Yeah, I'll answer them right away. No problem.
Very cool. Okay, so guys, chatwithtraders.com/.
A long time coming. So yeah, great. Thanks a lot, Aaron.
You've reached the end of this episode of Chat with Traders, but rest assured there are more episodes loaded with real market insight and zero hype on the way soon. So to stay updated with each great new release, subscribe to the podcast in iTunes, and we'd love it if you'd leave a rating and review. We'll catch you next time on Chat with Traders.
What would your trading look like if capital wasn't the constraint? That's the reality for most traders. It's not skill holding them back, it's size. Trade the Pool changes that. Step into the U.S. equity markets with up to $200,000 in buying power without committing your own capital. Full access to stocks and ETFs, long or short, executed with the precision and freedom serious traders expect. Your performance is measured by one standard: disciplined risk management and consistent execution. Meet that standard?
And he's a partner at Futex. Futex is a proprietary trading firm located in the UK. Dan has been involved with financial markets since 1995, straight out of college, and got his start as a book runner on the exchange floor. He later became a pit trader and was also there for the transition to electronic markets. These days, Dan plays a major role in training new traders to the firm and continues to actively trade, predominantly focusing on two markets, bonds and Euro stocks. Some of the topics we hit on during our discussion were how Dan seeks out trading opportunities and uses tools such as the price ladder and market profile, and how macro events have a significant impact on his trade decisions. I also asked Dan a bunch of questions about prop trading, and he has some really interesting points to share on the topic of risk. So there's plenty to learn, plenty to take in. Let's get right to it. You're listening to the Chat with Traders podcast. Please welcome my guest from London, UK, Daniel Goldberg. Dan, welcome to the podcast, man. How are you?
Yeah, I'm good, thank you. Good. Pleased to do this.
All right. Well, thanks a million for coming on, Dan. I've really been looking forward to this, and you were, of course, highly recommended as a must interview by Tom Dante. Guys listening, he was on episode 39 and awesome interview. So make sure you check that out after this one, of course. So, Dan, the way I see this discussion headed, we'll talk about your earlier years because you've been doing this for just over 20 years now. We'll also talk about the opportunities you seek out in your trading these days. And I have a bunch of questions I want to ask you about prop trading. So how's that? Sound like a plan?
Sounds like a plan.
All right. So, Dan, take us back to 1995. What was your intro to trading, and what was it about financial markets that appealed to you?
I think the first thing to understand is I was pretty raw and pretty naive, sort of thinking back to, I guess most 18-year-olds are, but I didn't have the entry into the financial world that I guess a lot of people do now. I mean, when we interview people now, we expect them to know what a financial future is, and honest to God, I had no clue. I guess I fell victim to a couple of films that were out around that time. So, I mean, these are films that I ask people if they've watched nowadays and they've never heard of them. But you think back to like Trading Places or Wall Street. Although they're maybe slightly different to where I ended up, that was my early influence. The news media tended to still cover the trading floor and the pits and all the shouting and screaming, and that just got my early addiction going. I've got to be honest, I had absolutely no idea what I was heading into. I just remember thinking at the time that it was a pretty good idea to finish off my college, not worry too much about university, and head into the big wide world. And just literally I sent hundreds of CVs to any address I could find. We had to use post back then, and I just scoured the city with my CV and with letters trying to get in. And it took a while. I had a few interviews that didn't pan out, but the one interview that I did eventually end up getting, I had actually on the live floor. And I think the moment I stepped on the live floor, I just thought, yeah, this is for me. This is the place I want to be. So that's really how I sort of stumbled across it. I think really and truthfully, for the first 3 years of my running stroke trading career, I probably didn't still know what a Bund future was, but that's where I was.
Okay, sure. So while you were in college, while this fascination for markets started to grow, were you doing any trading just on your own at that stage?
No, it was so different back then. I mean, you got to remember, half of us. I know it makes me sound like such an old bastard, but I didn't even have the internet back then. I mean, we were 18, and I didn't even have a mobile phone. So the access to it was not the same as it is now. It seems like, you can sit on a train and whomever you're sat next to will have an IG account or some other such spread betting firm's account. And it wasn't like that back then. You couldn't access it in the same way, or at least I didn't know how to access it in the same way. And I had no, parental backing. I mean, I was living day to day. I had no financial support whatsoever, so I wouldn't have even had 50 or 100 quid to shove in a spread betting account.
Of course, yeah. No, that makes sense now that you actually mention it. I didn't even put two and two together.
Yeah, I know, showing my age early in the interview. Yeah.
No, it's good. It's good. So How did you first get your foot in the door? Like you said, you were putting CVs out to, hundreds of banks and, trying to get interviews here, there and everywhere. How did you first get your foot in the door?
Pure luck. I mean, it really was. Unfortunately, I think what a lot of people don't realise is the fine lines and the sort of the fortunate margins that life throws at you. And I know that to a certain degree you do make your own luck, and I was throwing myself out there and speaking to everyone, but eventually it came through a family member. It just so happened that some obscure relation, I think it was my grandma's sister's daughter, so I don't know what that makes her to me, happened to be a teacher, and she taught the two gentlemen that ended up being traders on the life floor. And I was making quite a lot of noise saying that I wanted to get into the industry, and it happened to just in conversation fall down through the ranks of the family, and it turned out that it ended up getting mentioned to them. So they said, come along and have a chat. I don't think they even saw a CV. I remember one of the brothers who I spoke to one of the brothers, but he was busy trading, and the other one I ended up playing crib with, and at the time I didn't know that really it was kind of a test of my my sort of mental speed that we were playing this card game. But I was fortunate enough to know the game and actually be reasonably good at it. So that genuinely, no word of a lie, is how I ended up getting my first job as a runner on the life floor.
Right. Okay. So, what is the actual role and position of a book runner? Like, what does that entail?
Well, when you think back now, you click a button and your order is in there, and then it drops into your fill window, and then magically it ends up on your statement the next day. But back when we first started, all of these exchanges were done by hand. So the trader in the pit would be shouting and trading and doing his trades with other counterparties, and he would be handwriting them. He would be putting them on a piece of card, and throughout the course of the day, he would be sort of totting up his position and most often his P&L as well. But it was my job to go and collect those cards off him. Depending on who the trader was and how often they traded, you had to kind of decide, and how busy the market was, you had to decide how often you wanted to jump in and get the cards. But then you had to go and write them in a book, make sure the trader was correct in his position and his P&L, and then you had to type them into an old, I think it was called a TRS system. And once you typed them into that system, that's when they went off to the back office and then got manually allocated to a trader's account, for the next day. So it was a fairly lengthy process, which is why it makes me laugh nowadays when traders, they bitch and moan and scream and cry if their system maybe freezes for a millisecond. Quite frankly, back in the proper trading days, a trader wouldn't know his P&L. He might not have time to work it out. And there were a lot of times when a trader would have accidentally, added up his position wrong or read a plus as a minus. I mean, I've had it where, certainly one of my bigger traders, he was a couple of hundred lots the complete wrong way. He thought he was long 200 and I made him short 200. And at 18, I had to have the confidence and surety that I'd got it right to go and tell him that actually he's 400 lots round the wrong way.
Wow. Okay. So you told us a little bit about how you met these two guys. Can you tell us a little bit about the background of these two guys? I know they're now your partners at Futex there, but what was their trading experience at this point in time?
They'd done, a little bit more certainly than I had. One of them was working at the Bank of England and sort of got introduced to what financial futures was, via that background. I'm not, to be honest, I'm not actually too sure what his role was there, and I think he'd also been at NatWest, and I know one of the other guys was trading, I think it was Japanese warrants at the time, so they did have more of a trading background and had a little bit more of an understanding sort of the industry. And I think when they eventually went onto the live floor, they were kind of mid-20s, but both of them had to give up what at that time was, you know, a reasonably well-paying job and sort of take the gamble of being a self-backed local, you know, with no sort of impending salary.
Yeah, no doubt. So from being a book runner, you then began actually trading on the floor. Tell us, how did this work out for you?
Oh, it wasn't good. I mean, as confident and as sure of myself as I thought I was, I think when you get put in that environment, it really does humble you. I mean, look, at a stretch, I'm 5'9", and, you know, I'm still leaner now. And when I was sort of 18, 19, I was probably classed as skinny. And you're shoved in this pit, and you don't know what really you're doing. You're trying to decide whether the market's going up and down. No profile, no footprint, no charts, no you know, indication or tricks or patterns on the ladder. You were with other human beings, and these guys were experts at what they were doing. The most of them were, you know, had 10 plus years on me, and they were all, you know, to an individual, all very boisterous, all very aggressive. I guess, you know, if people want a comparison, they're kind of your sort of, I don't know, highly aggressive market stall type owner. So it was intimidating. It was really intimidating, and I had nothing. The intellect really didn't matter, and I think that, you know, these weren't by any stretch of the imagination stupid people, but it wasn't the most important thing down there. And I'd always throughout my whole sort of life up until then, be it through, you know, private school or college or whatever, I'd literally always relied on my intellect. And all of a sudden, it was of very little use. And so, yeah, those early years on the live floor, I mean, I was not a successful pit trader, and I think had it have carried on, I don't think I ever would have been a successful pit trader. I don't think the way things were then, if they'd have carried on, I was a bit too late to the party, and there wasn't the same sort of time and resource to be able to learn these things. So, you know, I mean, kudos to anyone who did make a substantial living down there. I mean, that is some talent
Sure.
to be able to do that.
Okay, so you said at the beginning of your answer there that, you know, you obviously had no charts, you had no indicators, no market profile. What were you basing your decisions to buy and sell on?
Oh, a gut feeling. I mean, honestly, it was just whether you thought it was going up or not, whether the noise was, you know, a little bit louder in one direction. I mean, I think back to it now, you know, I can't possibly imagine what I was making my decisions on. I mean, there was one time, I remember it quite vividly, and I remember the trader that did it to me, and I've met him since, and he probably doesn't remember it at all, but he was broking for Merrill's at the time. And I ended up being short buns into an interest rate hike. Now, I didn't even know that there was an announcement. I mean, I didn't know what interest rates meant to financial futures. I didn't know what any of these figures meant to financial futures. I mean, that's how green I was. But by pure luck, I ended up being short into a rate hike. And as the market started coming off, I actually covered my position with this trader for 3 ticks. I mean, this was into an unexpected rate hike where I'd managed to sort of luckily find myself short. And I don't know why I did it, but I remember I hit this trader to get out of my position and take 3 ticks, and as you can imagine, it was 50 or 60 ticks lower. And I went back to kind of check the trade with him, and he was a little bit unsure as to whether I'd done it or not. He was, he knew he'd done something with someone, but until I'd gone over to check the trade with him, he wasn't sure who it was. And I'll never forget that, just the utter humiliation that this guy subjected me to, in front of the whole pit, of being the utter arsehole who, A, didn't quite know whether he had even done the trade anyway, and B, if he had done the trade, was, such an appalling trader that, he'd covered a rate hike for a 3-tick profit. And, I think when I think back to these sort of things, I think it's that sort of humiliation and that sort of character. I guess at that point it was character assassination. It's those sort of things that actually made traders what they were and actually made them what they could become. And I do think that's what we're lacking now. I mean, there's no doubt about it. The life floor would not exist because of all of the new rules that we have, and the new, health and safety rules, the new, rules in terms of, what's acceptable. That floor just wouldn't exist. I mean, there would literally be someone getting sued every day. But unfortunately, it's made people softer. And I don't think that goes hand in hand with trading. I don't think being soft is the right thing to make a trader. And that's probably what is lacking, and why people find it very hard to this day to come through. That sort of brutality that certainly I was subjected to definitely fueled fires.
Okay. Now that's really interesting, Dan. So let's talk about how things started to turn around for you. I think it was around 2000 with the introduction of electronic markets. Tell us about how that affected you.
Well, that was the big turning point for me, because all of a sudden I gained an edge, because it wasn't about physicality, it wasn't about aggression, it wasn't about who you knew, it wasn't about where you stood in the pit and whose broker you had in your pocket. All of a sudden, it put people on a little bit more of a level playing field, and you could participate. I mean, what people don't understand is, if I actually did get a trade right, or was near getting a trade right, and I went to trade with someone, a broker could turn around and say no. They could literally turn around to you and go, fuck off, I don't want to trade a 1 lot with you, because I literally can't be asked working a 99 lot as opposed to a 100 lot. And they could do that, and brokers very frequently did. They would sit there and they would say, you take the lot or you take nothing. And of course I was restricted by, the size that I could trade. But electronic trading changed that. It meant that you could actually participate, and you could at least get in, and you could at least get out where you wanted to. And it gave me the chance to be on my own, be in a room, and start to understand what was happening with the market. And people spoke more. And that's really where you got the first real bit of tutoring into, what you should be looking for and what you should be doing and how you should be approaching it. And the evolution and the move from the live floor to Eurex as well created a lot of opportunities. And really the first opportunity for me was, I was doing okay on what they were called the old DTB screens. They were black and white, no price ladder, no depth, just literally a bid and an offer. But I was doing okay. But then the Lifebund went completely onto what the older system, which was called APT. And that was the automated pit trading system that Life had. And it went 24 hours on, the Lifebund went 24 hours onto this, but at the same time you had the German Bund, and they didn't always trade within a tick of each other, because the automated programs, the algorithms hadn't quite got there yet. So it literally became